Welcome to the 18th Annual Energy Conference. I'm John Carr. I'm the Executive Director of the Alliance of Western Energy Consumers, some of the largest businesses and employers in the West. And on behalf of my board and my members, again, welcome. And before I forget it, I want to point out that you should take a look at who our sponsors are. It's from their support that we're able to put on these annual energy conference, and we really enjoy their support. On the agenda, it says that Ed Finkley, our Director of Natural Gas, will be joining us this morning. He's been set back some. Setback's the wrong word. He'll be joining us probably this afternoon. Until then, I'll turn it over to Dan Kirshner.
Well, good morning. Sorry for a little bit of technical difficulties. We're trying to figure out this platform, and I know some of you are still trying to get in. We're working through that, and we'll get you on shortly, but we're looking forward to a really good day. The good news is here, these first few minutes are mostly housekeeping anyway. So stick with us, and we'll be getting going here in just a moment. I wanted to briefly go over the agenda for you today. We always look forward to hearing from Grant Forsyth with a regional economic forecast, which I think you'll all find particularly interesting this year, given the unusual dynamics we have with the pandemic and all of that going on. And then again, another conference favorite, Josh McCall, to talk to us about natural gas market, energy fundamentals in general, an update on the 2021 power plan of the Northwest Power and Conservation Council, a great keynote panel featuring the CEOs of a handful of national trade associations representing the entire value chain from the well tip to the burner tip, wellhead to the burner tip, presentation on renewable hydrogen, and then we're going to conclude the day with with a panel of our own regional utility CEOs. So looking forward to that, to this day. This is an unusual platform. We love to do this event in person, but of course circumstances have forced us to try this new way. We hope you'll take advantage of this platform and find your way around, network. You'll see you're seated at a table. You can kind of see where you're at. You can move between floors. When we're in the networking mode, when you're in this presentation mode, which you're seeing right now, you won't be able to move around, but when we do move to network mode, you will be able to move around, and we encourage you to do that. The way you do that is if you see at any of these tables, the 6 tops, the 4 tops, or the 2 tops, if you see an empty seat and you see people there that you want to sit with, you just double click on that empty seat, and they'll take you right in there. So I'm being told that the camera is only capturing about half of me. Is that correct? Okay, we're going to try this. Is that better? I'm going back here. Okay, we'll figure this out as time goes on. I think we're looking a little better here. So again, just double click on the seats that you see there, and that'll help you move around. You'll be able to network at those tables and visit with each other. We're going to show a little video right now that just gives you that little extra bit of training on REMO. And when we come back, we'll get right straight into our presentations. So thank you. We look forward to this day, and I'm sure the technical side of things will smooth out as the day moves along. So thank you.
Hello, and welcome to the 2021 Annual Energy Conference. Before we begin, we would like to address some housekeeping notes to get you comfortable navigating the remote platform we are using for today's event. Currently, you are in presentation mode. During the presentation, you are encouraged to chat with your fellow attendees using the chat tab, as well as submit your questions using the Q&A tab on the right. You can also upvote or downvote a question to change its ranking order. Think of this as liking a question. After each presentation, there will be time allotted to answer your submitted questions. After Q&A, you will be moved to the networking mode. To get you started, you will want to ensure you have your profile set up. To change your display name and profile picture, click on the letter icon in the upper right of the page. It is most likely the first letter of your first name. From there, click My Profile and edit the fields as needed. You can upload a picture of yourself, add your company name, and even your LinkedIn profile. When you enter the event, you will automatically place at a table. When we go to networking, the room will be configured as shown. To move to another table, double-click the table you want to join. To view who is at a table, hover your mouse over the table you wish to view, and the attendee's name will appear. To the left of the main page, there is a section called Floors. Similar to a real building, you can move to different floors throughout the event. Every time you move floors, you will be automatically placed at a new table. At the bottom of your screen, you will see a dock with features. The most important features are Tile View. This enlarges the cameras of each person at your table during roundtables and networking. Camera. Selecting this turns your camera on or off. Microphone. Selecting this turns your mic on or off. Chat allows you to chat both publicly to all attendees and privately. You can privately chat within your table or privately one-on-one. There is also the option to leave the event. As you may notice, there is no scrolling feature to move up and down the platform. To move around the platform, left-click with your mouse to drag and reposition the page. Alternatively, use your mouse scroll wheel to zoom in and out of the page. Be sure to check out the video from the Partnership of Energy Progress at the left of the stage, as well as some additional helpful tips in the billboard at the right of the stage. This includes the tech support number in the event you are experiencing challenges. Finally, yet importantly, please be sure to check out our wonderful sponsors to the left and right of the floor. This event would not have been possible without them. Thank you and enjoy the event.
Okay, I think I've got my camera all set up so you're seeing more than just the side of my head. And I'm checking out this the chat feature over there, and it looks like we already have a lot of interaction going on, so that's terrific. Just one reminder as we get into the presentations, you will note off there to the right side of your screen, up in the upper right side of your screen, the chat, participants, and Q&A. Of course, you can use the chat to your heart's delight, as Antoinette said in the introduction, the virtual training there. But to submit questions for our speakers, please put them in the Q&A section. So click on that Q&A, and I'll be monitoring that. And when the presentation is done, we'll run through your questions. And so that's where we want you to put your questions. I probably won't be able to see it much in the chat, so please do use the Q&A to submit your questions to Grant and our other presenters. So without further ado, we're right on time right now. I just want to welcome Grant Forsyth, Vista's chief economist, and one of our favorite conference presenters to give us a window into the region's economic picture. So with that, Grant, take it away.
Thank you, Dan. If everybody will just bear with me for a second while I switch over to presentation mode. So this year, for this year's outlook, we're of course having to deal with the COVID economy. And I'm going to spend some time talking about the US and Canadian economic outlook, given the fact that we have this new COVID economy. Now, the great lesson of COVID is how the world can change so very quickly. So the last time I addressed this group was 2019, and I look back at my forecast that I gave for 2020 in 2019, and the forecast was essentially for a sleepy, aging expansion. And keep in mind, at that point, we were entering the longest expansion in US history, probably close to the same for Canada. And the outlook was for a low inflation, low growth environment, but still continuing on with growth. Actual 2020 looked very different. Literally, the world was on fire. Literally and figuratively, the world was on fire. So the world changed really pretty dramatically. The longest expansion that we've probably experienced in North America essentially collapsed within a few months. So let's talk a little bit about what's been happening. My goal here is to really give you a clearer picture of the COVID-induced recession and the early recovery period we're now going through. We're going to talk about 6 major topic areas. We're going to talk about US and Canadian global GDP, okay? Talk about all 3. And the outlook is actually for pretty strong growth in 2021 and 2022. We're going to spend a fair amount of time talking about inflation for the region. Inflation right now is very stylish to be very worried about inflation, but the outlook really is certainly for it to be elevated this year, but not necessarily unhinged going forward. Talk about the interest rate environment, and the main point here is that central banks are probably on hold way into 2022. Talk about employment growth. Unfortunately, what we're seeing is slower than expected, but hopefully with increased vaccinations, that will pick up in 2022. US hits a low in terms of population growth. So we're going to actually spend a little bit of time talking about population growth because this is actually a big deal for the US. Okay? And then we're also going to spend some time talking about US and Canadian home prices. And all I can say about that, it's complicated, so we'll have to wait until we get there. So let's talk about GDP growth. Okay? So let's first look at 2020 there and just point out that 2020 looks pretty bad. Canada down 5% in terms of GDP, the US down 3.5%. Global GDP, according to the IMF, was down just over 3%. But here's the good news. It was actually better than expected. At the time the COVID crisis really started, the expectation for the US and Canada was we were going to be down -7% to -10% in 2020. But in my view, the extraordinary fiscal policy and extraordinary monetary policy, in addition to the speed at which we were able to get vaccines out, probably mitigated the worst of the expectations that we had at the beginning of the crisis. Now, if you look at 2021 and 2022, because of that stimulus, because of the vaccines, but also because of the recovery in international trade, which is important, right, especially to Canada, right, we see very robust occurring over the next couple of years. And keep in mind, these are forecasts, these are consensus forecasts. And what I like to do is I like to go out, look at a whole bunch of different forecasts and average them together. I will also do the same thing for inflation and employment going forward. And so for 2021, very robust growth, essentially 6% or higher for Canada, the US, and the global outlook. The last time the US grew at this kind of rate was actually 1984. 2022 also looks pretty good, a little bit lower because we're starting to see some of the waning stimulus effects, but still very robust by historical standards. The current consensus is that by 2023, we're going to return to that pre-pandemic growth rate that you see there on the far left, that average from 2010 to 2019, where both Canada and the US is growing in that 2% range, that low 2% range, and the global economy is growing at just over 3.5%. Okay? If you look at similar forecasts from the Organization for Economic Cooperation and Development, OECD, their forecasts for global growth look a lot like the IMF's. And so again, I think everybody is weighting very heavily the next 2 years based on this trade recovery, based on the stimulus effects, and based on those vaccine effects. So let's cross our fingers and hope 2021 and 2022 are as good as the forecasts say, because we're going to need that kind of growth to kind of recover the economy on the employment side. Now, we're going to spend probably about the next 3 or so slides talking about inflation. It's of great concern to a lot of people. I mean, you have people like Lawrence Summers, other major economists being concerned that perhaps the central banks around the world, the US, Bank of Canada, the European Central Bank, are being perhaps too loose with monetary policy. Now, keep in mind, if we go again to 2020, looking at the COVID effects, we were way below the target of the US and Canadian inflation of 2%. And in fact, we were once again concerned in 2020 that we might actually get deflation, negative inflation. But again, those extraordinary fiscal and monetary policies that were put into place probably kept us from having deflation in 2020. If we look at the consensus view going forward, we do see elevated inflation in 2021. You see rapidly rising demand, ongoing supply constraints, including on international shipping services, right? Raising inflation above that target for an average rate that would normally make the central banks feel a bit uncomfortable. But the central banks have clearly signaled they're willing to tolerate slightly higher inflation, certainly in 2021, as the economy recovers from this unique pandemic that we're now escaping. Now, if you look from 2022 to 2023, the forecasts really go back down to something close to the target of the central banks of the US and Canada, which again is about 2%. And so the consensus view, not just among central bankers, but among, I think, market participants and forecasters, is the inflation that we're experiencing, what's making some people very nervous, is expected at this point to be transitory inflation. Now, you can also see this if you look at some measures of expected inflation, which I actually pay a lot of attention to pretty much every year because I think they're quite useful. And so 2 sources are, it's the interest rate spread between regular US Treasuries and Treasuries that are indexed to the rate of inflation, TIPS bonds. Okay? And if you look for June, okay, the average expected inflation rate based on that interest rate spread for the US CPI for the next 5 years is 2.6%. The 10-year average is 2.4%. Okay? So pretty clearly, they're elevated, but they're not unhinged. If you look at another measure produced by the Federal Reserve Bank of Philadelphia, they actually produce the equivalent of a yield curve, but it's for expected inflation. Their 5-year average inflation rate based on their own estimated expectation of inflation is 2.3% on average over the next 5 years, and also 2.3% over the next 10 years. So the key thing here, and I think this is important, yeah, inflation is elevated, okay? And we got some new numbers this morning. We'll talk about those in a minute. But the expectations are not that far from the long-term target, when I think that's a good sign in terms of the market believing that inflation is likely to be transitory. So let's talk about inflation again, but let's look at a little bit longer run picture of inflation. Now, people who have participated in this event know that there's usually at least one slide that I call it my smarmy slide. I like to have one slide where it at least makes me look somewhat smart. So that's this. And so what I did is I went to the OECD. They have harmonized consumer price indexes. And I looked at an annual inflation for the US and Canada since the mid-1950s. Okay? And a couple of things are just important to point out for perspective. First off, right? The US and Canada are actually highly correlated over time in terms of inflation, right? And in fact, if you take the inflation spread between the US and Canada and you put that spread in a histogram and you do a little bit of statistics, what you find out is that spread over time is roughly normally distributed with a mean of 0. And essentially what that means is so goes inflation in the US, so goes inflation in Canada. And so if we do get into a situation where inflation becomes less transitory and escalates more, we should be aware that there are transmission mechanisms where the US and Canada are going to follow each other down that road. Okay? But again, if you look at the long history of it, where we are now, what the current target is, I think fears that we're returning to the 1970s and 1980s are perhaps at this point a bit premature. For us in this group that are a bit more mature, we can remember the 70s and 80s and what that inflation environment was like. My guess is we're pretty far away from that. And keep in mind, the central banks, even though they may be signaling they're on hold for at least the rest of this year and most of 2022, keep in mind, the central banks can change their mind, right? They always leave a little bit of room open at the back of the room, right? So they can escape if they decide that inflation is maybe not as transitory as they thought, and they will simply raise rates early. So the prospect of inflation, I think, in my view, getting completely out of control, like we saw in the 70s and 80s, again, I think it's a bit premature. And at this point, I think it's probably a bit unlikely. So that filters right down to what we're seeing, though, in interest rates. Okay, so what we have here is the 10-year government bond interest rates, in addition to the policy rates that the Federal Reserve and the Bank of Canada focus on. Those are the dotted lines. Those are the policy rates, the overnight rate in Canada, and the federal funds rate in the United States. Okay, and what they have signaled, I think, is that they're on hold, certainly for the rest of this year, probably most of 2022. If you look at futures markets for the federal funds rate, what you're seeing is the expectation is that towards the end of 2022, the beginning of 2023 is when market participants start to expect the Federal Reserve will start to raise rates. And that's usually a pretty good indicator of when the Bank of Canada will also begin to change rates. Now, what's interesting, though, if you look at long-term rates, we saw rates go down, both short and long-term, at the beginning of the crisis, following each other. But we have seen a separation start to occur between long-term rates and short-term rates. And again, that reflects that impact of the recovery and a rising expected inflation being built into long-term rates. And so if you look up above, we can see on a year-over-year basis, kind of shorter term, what's been happening to inflation in Canada and the US. Now, of course, remember Canada, the Bank of Canada focuses on their CPI. In the US, the Federal Reserve focuses on the Personal Consumption Expenditure Index. That was actually what I was looking at in the first inflation slide I showed you. And we can see on a year-over-year basis that ramping up of inflation, driven by supply constraints, stimulus dollars, and so forth. And you can see that being built into rates as we get into May. But the important point is rates have actually stabilized. And just this morning, the US Bureau of Labor Statistics released the CPI number for May, right? And it's about 5% year over year, which is a little bit higher than expectations, but not that far out of alignment. The Personal Consumption Expenditure Index number, which usually is a little bit lower than the CPI, will be released on June 25th. And the Canadian number for May will be released on June 16th. But what's interesting is when the new CPI number came out, it really didn't move markets that much. Expected inflation based on TIPS bonds didn't change very much. And actually the long-term, the 10-year rate also didn't change very much. And so at least for now, it seems that even though inflation is picking up on a year-over-year basis, most investors, people in the market, are tending to accept the Federal Reserve's and Bank of Canada's view that this is transitory. And so rates are actually fairly stable, even though inflation has picked up a bit. So briefly, though, all these interest rate changes, the stimulus dollars, the recovery in trade in particular, just as an aside, has really changed the value of the Canadian dollar. It is important to point out that the Canadian dollar has probably been one of the better performing currencies in the sense of demand for the Canadian dollar. And actually, relative to the US dollar, we saw in February it was about 75 cents per Canadian dollar. It's now about 83 cents per Canadian dollar, and that's a 10% appreciation in the Canadian dollar. Okay? Even though interest rates between the two countries are very similar, the Canadian dollar has really been appreciating because, again, of that opening of trade and the demand for Canadian dollars that comes with that. The expectation, though, is that the Canadian dollar will be somewhat stable until the central bank in the US starts raising rates again, and then we'll see that Canadian dollar maybe depreciate rather than appreciate a bit. But again, the expectation is that's not really going to occur until you start to see central banks raising rates again. Now, focusing on employment, one of the reasons why the central banks have been so accommodating to what's been happening with inflation is because they're really worried about the employment side. And so what we have here is an index of employment activity, okay, starting in February 2020. So everything is indexed to February 2020 employment levels in the US and Canada. Okay, so what we can see is we go to the lockdown period, employment declines about 15% in both the US and Canada. We have that partial reopening where we get back some of that employment. But the problem has been really since the fall of 2020, we've seen really a stalling employment recovery. Okay, and so as we get to the current period, right, the US is currently 5% below where they were in February 2020. Canada is still about 3% below, with really a pretty slow recovery occurring. Now, the outlook for 2021 for Canada, okay, given they had a 5% decline in 2020, they're looking for consensus is almost 5% growth in 2021. For the US, looking for a consensus growth of about 2.5%. So what that means for both countries is we might not see a complete recovery of the labor market maybe until 2022. But the question is who's left struggling, and is there really a labor shortage? So let's talk a little bit about what's happening there, because that's been getting a lot of press, especially in the United States, because there's a lot of controversy about the impact the extended unemployment benefits are having on people's desire to work. So let's talk a little bit about kind of really who's struggling to get back to work, kind of what are the employment dynamics that are keeping us below that February 2020 number. And so this is a graph from it essentially represents data from payroll companies. It's private data, it's high frequency data, and it reflects a joint venture called Opportunity Insights between major universities in the US and the Bill and Melinda Gates Foundation. And this has actually become pretty popular data because it's not government data, it's private sector data, it's payroll data, and you can parse the data in ways that you can't with some of the government data. And so what it shows is what is the employment impact by wage level in the United States. Remember, wage level is going to be a proxy for skill level. And it's really kind of astonishing. What you see is if you look at the employment effects of the COVID-induced recession, it weighs by far most heavily on low wage workers. So the red line are high wage workers making more than $66,000 a year. You have middle wage workers making 27 to 60. And then you have those low wage workers under $27,000 a year. And it's really those low wage workers that bore most of the burden of the employment declines coming because of the COVID-induced recession. Now, what's interesting is that you also see this in Canada. The Bank of Canada has done a similar analysis. They find essentially the same thing. The IMF has looked across a broad range of more developed countries. They find essentially the same thing. In addition, what you find is a lot of these lower paying jobs are public facing jobs and are disproportionately staffed by women. And so what you're seeing is the jobs that we have not recovered are public facing, lower paid, and tend to be disproportionately staffed by women, right? Now, the question then comes is there a labor shortage because of these extended unemployment benefits? I'll tell you that the empirical evidence suggests it's more complicated than that. So it's true that the unemployment benefits may be causing some people to stay out of the labor force longer than they ordinarily would, but the evidence suggests it's mostly in those really low-paying jobs, right? But keep in mind, there are other factors like childcare at work, okay? Concerns about being sick, right, because of COVID. But also, a lot of people are exiting these lower paid jobs like in leisure and hospitality, and they're moving to other industries that maybe pay higher wages and offer more stability and less personal risk in terms of the pandemic environment. And so, really, ultimately, what's going to get us back to more normal levels of employment pre-pandemic is that we really need to see vaccines take hold. We need to see have people have confidence again in being active in public. But my guess is even when we do see that occur, some of these lower wage jobs, especially in leisure and hospitality, are going to struggle to find people because you're going to still have these people looking for jobs maybe outside of that industry. That's kind of what the growing evidence suggests, right? So it'll be interesting to see how that industry can cope with that and how far they're willing to raise wages to keep people in that sector in the long run. Okay, if we look regionally, we really get exactly the same pattern, more or less, of what we see at the national level. Okay, so the red is Alberta and Canada combined. That's the red line. The blue line is Washington, Idaho, and Oregon combined. And for reference, just because California is such an important state in the West, I also have California in there. And again, this is exactly what I showed you with the national data. It's employment indexed to February 2020 and kind of says where we are now. Okay, and it really tells a similar story. Now, what's interesting though in the US is that there's actually a big difference if you break out the states between Idaho, Washington, and Oregon. Washington and Oregon had much stricter shutdowns, which meant that Idaho had a much lower decline in employment in 2020. And it means that they have actually been actually gained employment where other states have lost employment over the last few months. The outlook for 2021, in my view, is going to be similar to the United States. We'll probably see as a group 2.5% employment growth for Idaho, Washington, and Oregon combined. But within that group, I expect Idaho to be the strong performer in 2021 and probably well above 2.5% if you look at the states individually. California remains a mystery. Pretty clearly, it's struggling the most to recover, but it's really important that California does recover at some point because, again, their economy is so important to the West. If we look at Canada, BC and Alberta have actually done a little bit better than Canada as a whole. And their outlook for 2021 is actually very strong. BC, 6% consensus employment growth. Alberta, the consensus is about 5%. Again, a lot of that is going to depend, though, on Canada catching up on its vaccinations and also international trade remaining robust going forward. The other thing, though, regionally that we're going to need to worry about, and that potentially could affect our economies, is the wildfire risk. I think at this point, most people recognize we're in one of the driest seasons on record, especially in the US West. That does pose some risk to the region. And so that's another potential drag on the forecast of 2.5% growth this year. Real quickly, if we look at metro areas, looking at employment growth, so it's looking at the employment growth from that 3-month period, December, February 2019, 2020 to first quarter 2021, right? Better performance in Canada. We see the strict lockdowns occurring in Seattle and Portland. Boise, again, not quite as bad because of a different approach, but clearly you can see the impact of those strict lockdowns on the metro areas, especially in the United States. And again, compare that to the national over the same time period. Again, it's that impact of those lockdowns. If we look at the regional small metro areas, we see, again, Idaho looks pretty good. Next is Canada with Kelowna, BC. And then you see everybody else there in Oregon and Washington. And in particular, one thing to point out is look at Eugene and Corvallis at the end. This particular induced recession, I mean, in terms of COVID induced, was particularly hard on university towns. And even at this point, universities are still struggling to get themselves back on track for the coming school year. But you can clearly see how hard this was for any small metro area where you have a high dependency on universities. Okay, population growth. Spend a little bit of time here. This is really interesting about what's happening, especially the difference between US and Canada. And this has really some big implications for the longer term and how economic growth between the US and Canada are going to materialize in the very long run. In particular, if we focus on Canada first, Canada has come out and said recently, the Trudeau administration, that they're going to actually encourage increased immigration to Canada. Okay. The US, on the other hand, remains deeply conflicted about immigration. And so we see really kind of two different approaches to immigration. One where people maybe want to see less in the US, and in Canada, they want to see more. And what's interesting about Canada's growth, population growth, is that it's pretty uniform across the regions in Canada. You don't actually see big differences no matter how you parse the data. And by the way, on this graph, ROC is the rest of Canada. So we have Canada, Alberta, BC, ROC is the rest of Canada. And then we've got Canada again, and then we have Western Canada, Central, Eastern, and the far north. But it's all just slightly above 1 or 1% roughly. And the important thing is immigration remains very important to Canada. Over the last 5 years, 65% of their population growth has due from international immigration. Okay, compare that to 40% in the US. So I think this bodes relatively well for Canada in terms of their long-term economic growth, because recall, long-term GDP growth is roughly the sum of population growth plus labor force productivity growth. If we turn to the US, it looks a lot more variable across the US. Really, we can see that Idaho is the big grower in terms of the states we're focused on. California has actually lost a little bit of population. Okay? If you look at the broader regions in the US, right, we can see a big variance across the West, excluding California, okay, the South, the Northeast, and Northwest. So what's important, though, is the US population growth really hit a low. Okay, we're now growing at a rate we had something similar to the 1930s. So this year we only had just under 0.4% population growth. I'm rounding up in this case. Okay, and what this means for the US is that there's a growing dependence on labor productivity growth for our GDP growth in the US. Right, so we're not going to allow very much immigration. Right, that's going to put downward pressure on population growth, which means increasingly in the long run, we're going to be really dependent on productivity growth, labor productivity growth for GDP growth. And so from this perspective, actually Canada is probably in a little bit better position at this point than the US is. And keep in mind, there's really a lot of evidence at this point that the COVID-induced recession caused a significant decline in births. And so that 0.4% in the US could become even lower going forward without some additional immigration into the US. Finally, okay, we're almost finished here. So we're going to talk a little bit about the housing market. One thing, this is a map. It's called GEO FRED, and it's from the Federal Reserve Bank of St. Louis. And what it shows is existing home price growth by county, where the data is available for 2020. And one of the things I just want to point out is that actually the housing market in the US and Canada are very hot right now, but in particular in the US, it's highly regionalized. And so if you look at where home price growth is really strong, it's actually more focused in Florida, Texas, Colorado, and most of the West, right? It's not that every place in the US has rampant home price growth. It's really heavily weighted toward just a few regions. Now, part of this reflects, of course, low interest rates, But going back to my previous slide, it also reflects migration patterns in the US, where you just simply have a lot of people moving to the areas in Texas, in Florida, Colorado, and the rest of the West. So one of the reasons home prices are so robust is because of this internal migration that's going on in addition to the low rates. So even if rates go up a bit, this migration is going to continue to support home prices in the areas that I'm showing you. But it actually turns out to be a little bit more complicated than that too. It turns out that there's a lot of internal migration going on around urban areas, okay, major urban areas. And that's reflected in some analysis that was done by the Bank of Canada looking at their major metro areas. And what they show here is actually happening in the US as well. And so you have a lot of people, for example, migrating to the West, but you also have a lot of migration occurring around the city areas themselves. And so what the Bank of Canada did is they looked at what's happening to home prices as you move away from the major city centers in Canada. So you've got Toronto, Vancouver, okay, Montreal, Ottawa, Calgary, and Halifax. In particular, if you look at Toronto, for example, you can see that as you move away from the city center, house prices are actually rising much faster than they are at the city center as people migrate out to this donut kind of shape where the city center is becoming less popular, but the outer rim of the donut is becoming more popular. And actually, we're seeing this in the US as well. So if we think about the West, not only are we seeing a bunch of migration to the West, but we're also seeing a lot of migration around cities where people are exiting the urban centers for those nearby suburban or rural areas. And that's also causing some interesting house price activity because of that internal migration that's going on. So ending at the beginning, okay? So strong GDP growth over the next couple of years, okay? Let's cross our fingers that's true. Elevated but not unhinged inflation. Central banks are on hold at least well into 2022, maybe 2023. Employment growth is materializing, but very slowly. Probably won't see a full recovery until 2022. Population growth in the long run is going to be a big problem for the US. We need to have some sort of rational policy towards immigration to help alleviate that. And again, housing prices, even with low rates, a lot of the housing price gains we're seeing is because of this migration activity that's occurring both in the US and Canada, and higher rates won't necessarily stop that activity. So with that, do we have any questions?
Up here. So let me, I do have a question here, Grant, for you. A couple people have supported the questions. How much is the growth or lack thereof in California due to business migration from California?
Well, that's a good question. I mean, if you look at the data, it's sometimes hard to get good data on business migration out of California. It's mostly focused on people. And so there was a very good analysis done, I think it was in Bloomberg, and it was this really interactive map where they had all these dots moving around this map of the United States, and you could see where the people flows were going. And you can assume there's some correlation between people flows and business flows, right? And what you saw in the case of California is what you're seeing is a lot of people migrating out of California. They're going to places actually like Portland, like Seattle, and like Boise. But the chances are they're really moving to those kind of donut areas around those cities is probably what you're seeing. The other thing that what you're observing though in California, and this gets much less play, but this particular analysis really showed this, is how much internal migration you're observing in California. I mean, there's a lot of people who are staying in California, but they're moving to other parts of California. There's a big part of that migration story that's being missed. But really, if you look at where people are going, which means probably where businesses are shifting to, it's going to be places probably like Idaho and Utah, where you've got a pretty favorable regulatory environment. But it also appears they are shifting to places like Portland and Seattle as well, but probably again in kind of that donut shape, those outlying areas around those cities.
So this just begs a question that I have, and that is, with the pandemic, our
Mm.
eyes have been opened a bit to how we can work more remotely. And I wonder, this is probably a question for a futurist, maybe more than an economist, Grant, but I'll let you take a stab at it. You know, what impact could that have on these migration patterns, especially around hot metro areas that are already experiencing significant growth?
Yeah, I mean, I think it could keep some of these metro areas, these mid-sized metro areas, where it's not from the perspective of where you're moving from, like a Spokane. I'll use Spokane as an example. You know, Spokane, is attracting some of the people that you're talking about. We have a pretty good technology infrastructure. We have a great hospital network. We have a great, airports, easy to get to. And so these mid-sized cities that are set up like Spokane are probably going to be very attractive to the type of people that you're talking about. And probably what that's going to do is to continue to put pressure on home prices, especially for residents who actually live here and are not necessarily moving in from a higher cost area and are carrying a bunch of equity with them when they go, right? So yeah, I think in the long run, some of these mid-sized cities like Spokane and so forth, I mean, you can, various examples around the US are going to be popular. Now, some of that actually depends a little bit about the industry you're going to be in as well. You know, you're seeing an interesting division occur in the US with this remote work, where you have workers a lot more excited about it than CEOs. And so some of it will depend on the company, the industry, and the culture and the willingness of CEOs to let this continue.
Right. Great. Thank you. So we've our Q&A section is lit up a bit here. So we got about 5 or 6 minutes left, and I've got 5 questions here. So the one that's getting a few votes, do you see any impact on the U.S. economy regarding empty buildings for businesses that will remain remote and not return to their office? So kind of a related question, right?
Yeah, and it's I've been trying to follow this as much as I can, and it seems like the biggest problem with those empty office spaces seems to be in the bigger urban areas seem to be having a bigger problem with this. The New Yorks, the Seattles, the Portlands. It's uncertain how smaller metro areas, if they're going to see a similar impact. But clearly, there's a depressed commercial market right now in some of those bigger metro areas because of that. And my guess is that where a lot of companies will, in fact, have a hybrid work environment. And so in these bigger urban areas, you might see a slightly depressed commercial environment for quite a few years going forward, as it takes time to absorb that space that's no longer being used by workers.
Next question was getting a number of votes. Will or maybe could the carbon policies being implemented force populations back to the cities? Impact of carbon policies on migration, I guess, is a different way of thinking about that.
It's possible. It depends. I mean, it really kind of depends on cost. I mean, ultimately, if the carbon policies make it very expensive to live remotely, it could increase the desire to live in an urban area. I mean, what you're seeing right now, though, is a lot of people are not necessarily exiting the urban area for super remote rural areas. What they're exiting for are nearby rural areas or nearby suburban areas. And so it kind of, that's a tough question, because it really depends on how these particular policies, by how much does it raise energy costs. My guess is for a lot of people that have migrated, it probably won't change their behavior that much.
What have you seen with regard to business migration? So here's the question: how many large factory projects are moving from somewhere else to the Northwest, Oregon, Washington, Idaho, British Columbia, I suppose? And how does the growth manifest itself in energy consumption, especially natural gas?
Yeah. Well, what we're seeing, at least in our, sort of the Spokane as an example, we are capturing firms that normally might be in a larger urban area looking at Spokane, because there's land availability is a big issue. And we also have a pretty good transportation hub relative to land availability. So you are seeing some migration of firms into, again, these mid-sized markets like Spokane, escaping the high-cost markets that you see in places like Portland and Seattle. And so what we're seeing is really kind of an internal shifting around as companies on the west side of the state look for space on the east side of the state that's perhaps more affordable.
What I guess a follow-on question to that, Grant, and then I have one more question here in the queue. So Spokane is subject to the same carbon policies that Seattle is. So is there potentially a chilling effect on what you've described as a positive for the Spokane region?
It's possible, but there are going to be other factors involved. And again, the companies that are relocating here, maybe from someplace else in Washington, I mean, they're looking at things like, again, cost of living for their employees, land costs for developing their new site, transportation infrastructure. And so if you look at these types of things, even if you are facing the same carbon policies, these other factors can push companies in your direction in that case.
Great. Okay. And last question then, can you speak to the confidence bounds on your predictions, your GDP and CPI predictions for 2021 and 2022?
It's pretty hard. I would say on the GDP side for 2021, let me focus on that one. I think really COVID still is out there. It remains an unknown. So I think really the bounds on all these forecasts are actually quite large. I think GDP, it can be, I would say for 2021, 4 to 7%. Again, depends a lot on COVID. Also, the ongoing recovery in international trade is also really important. For inflation for 2021, I mean, we're running on an average of about 3% inflation for the year-over-year basis we've seen already this year. And so I would say for this year, inflation, that bound is probably, let's say, 2.5 to 3.5% for 2021.
Great. Thank you, Grant. And that, I think we're pretty well done with the questions we have in the queue. So as we, I guess we'd have a virtual round of applause for you, Grant. That's one of the downsides of these kinds of events is you don't get to see 200 faces. By the way, let me just share with our audience and you, we were at, I think the last number I heard was 196.
Oh.
That is our largest registration ever. Virtual makes that possible. Of course, we love getting together too. So we're hoping 196 of you return when we come back next year in 2022 to in-person events in the Bend region, so Bend, Oregon. But yeah, so thank you, Grant, very much for your time and of course your expertise. We love this, and we got some good questions out of the deal. So as we move now into the networking section, one of the things we'd like to do is just pose for you a question to discuss. And this is kind of the fun part of this particular platform, Remo. Again, as you remember from the training video, if you can go search for people, find out what table they're at. If there's an empty seat at that table, just double click on that seat and you'll join that table. So we'd love for you to spend some time networking the next 10 or 15 minutes. We'll give you a cue, 30 seconds to go before the next presentation is about to start. So please take some time to visit with friends, acquaintances, and new people. I'd encourage you and even challenge you to exchange contact information with one person, at least one person in this break that you don't know or didn't know prior to it. The other thing we'll ask you to do is just think about here's a question for you to discuss at your table. What jumped out at you from Grant's presentation in particular, and how will that affect your business? So it's just an internal conversation for you to discuss at your table. I'll put that up in the chat for you, so it's just a prompt if you want to have that for conversation. In the meantime, I will turn this back over to the producers and let them take us into networking mode. We do have Josh back, and it looks like he's got his screen ready to go. So without further ado, one of our, I think every presenter is one of our conference favorites, but we really appreciate all of them. So thank you, Josh, and the floor is yours.
Hi there, Josh. Looks like we can see your content, so that is all set. However, if you can just turn on your camera and microphone, we can't hear you just yet. Oh, there you go.
Sorry about
Appreciate it. Thank you.
All right, hopefully we're set now. Apologize for those technical difficulties. Get the camera going here. All right. Hello, everyone. Sorry for the delay there. Let me go ahead and get started just to try to make sure we stay on time. Fundamentals update on what's happening from not only a U.S. perspective, but Pac Northwest as well. All right, I think most folks have probably seen the disclaimer slide for informational purposes only. Hopefully we'll generate a good discussion in the Q&A section after this. Okay, so I want to start off by talking a bit about storage inventories, just to kind of get everyone acquainted with the format of the charts here in case you haven't seen those before. The gray is the range of where we've been the last 5 years. Red is where we are this year. Blue is last year, and then the white is the 5-year average. And we have somewhat similar trajectories between the U.S. and some of the U.S. as a whole, rather, and some of the Western markets, although there's a little bit of a difference when we go in the winter. So let's just kind of run through that. If we look at where we entered last winter, we're relatively full on storage towards the high end of the 5-year range and we stayed at a surplus to the 5-year and the previous year level until about February. So there's a little thing called a Winter Storm Uri that happened around that time, and I'm sure we all read and heard quite a bit about. At that point, U.S. inventories started drawing at a fairly rapid pace, at least compared to what they had done up to that point in the winter. And we saw inventories drop below the 5-year for a short period of time. And fast forward to where we are today from a U.S. perspective, we're below where we were last year, so 386 BCF from a U.S. total perspective. It does not include the number that came out today, if you're keeping track of that at home. So pretty decent deficit versus where we were last year, right about the 5-year average. I'll get into the end of season projections a little bit farther down the line. So it'd be interesting to see where we end up and go into this coming winter compared to where we were this past winter. If we look at the West in particular, so somewhat similar trajectory for Mountain and for Pacific, probably the region that corresponds to most of the folks on the conference here today. So somewhat similar trajectory in that stayed at a surplus versus the previous year. The West entered the winter a little bit closer to the 5-year. And then, you saw things draw down in Feb and March, but the weather was really concentrated in, we'll call it the eastern half, the eastern 2/3 part of the country. So that's really where a lot of the big draws came from a storage perspective. So right about the 5-year now, and that's a similar theme, whether we're talking about for Mountain or for Pacific. 5-year a little bit above, I should say. If we look at these dashed lines, these show the trajectory based on, the max and mins. If we take sort of the high end or the low end of storage injections over the last 5 years, where does that leave us? The short answer is if we took the max or the average, it would get us to pretty full from a West perspective. And again, I would say relatively similar story for Mountain as well. So, perhaps end the season fairly healthy from a Pacific Mountain perspective. So kind of the western part of the country, maybe a little bit different story for the rest of the U.S. And again, I'll get into that in a little bit more detail as we start progressing through the slides. Okay, so I wanted to do a little bit of a recap. Being a fundies guy, always focused on supply demand fundamentals. Sometimes it's helpful to break those into components or smaller parts to give you an idea of what the different components are doing, and then mix all the ingredients up and try to figure out what happens when you bake that into the cake. If we look at production in the top left, the blue line is where we are this year. Red is last year, and the 5-year average is this gray range here. You'll notice if we rewind back to the winter, we did have a pretty decent downtick in production during Uri. You hear the term freeze-offs thrown out there quite a bit, so we had pretty significant freeze-offs. Ended up being a relatively short-term event. Production recovered to pre-storm Uri levels relatively quickly. It's been pretty steady state since then. We've continued to hover around, call it the 90 to 91 BCF per day. So if we look compared to where we were last year, we're actually up quite a bit. For a lot of these different components, COVID gives us a bit of a tricky comparison. If you remember on the production side in particular, prices got really low. You had a lot of, both on the oil side and the natural gas side, that's probably an important point to make there. Commodity prices as a whole got really low because of all the stay-at-home orders having an impact on demand. You actually saw producers talking about shutting in wells, so turning off the operation of wells for a short period of time because prices were so low, it wasn't really covering their variable costs. So that's what explains a lot of the dip last year in 2020, especially around the 2Q timeframe when we were at sort of the largest impacts from the stay-at-home orders. So definitely higher year over year, but I guess in terms of a sequential trend, pretty flat really, even compared to the beginning of the year. I'm just going to kind of make my way clockwise around these charts here. If I look at power sector demand is pretty comparable to where we were last year. There tends to be a lot of noise. The power sector in particular tends to be the most price sensitive of the different demand sectors that we look at from a natural gas perspective. And the fact that it's even flat to last year, I think, is an interesting point. Again, being price sensitive, I'm sure all of us are aware prices are quite a bit above where they were last year. So everything else being equal, I guess maybe you'd expect that to cause your power burns to be lower year over year. We're seeing them pretty flat. So I think that's probably a pretty decent indication of maybe some economic strength. I know Grant kind of ran through the overall economic outlook, but as the economy continues to reopen, presumably people will get back to the office, although that is a bit of a debate these days. That's starting to boost electricity demand. So as that happens, then we tend to see demand in the power sector for natural gas in particular get a bit of a boost from that. So prices are higher, but demand overall is pretty similar. LNG, I would say, very similar trends to production in terms of, just like we saw production drop off with Uri, we saw LNG exports drop off quite a bit. We were at 11 plus BCF per day pre-storm, dropped all the way down to call it 2 and change in terms of feed gas demand, and that rebounded pretty quickly to at or above pre-storm levels. There was a short period of time where we got to 12 BCF per day. Has been dropping off a little bit as of late. I'll get into a little bit of the pricing dynamics between the U.S. and the rest of the world, and what might drive exports and how the ARBs look versus maybe how they looked last year, ARBs being the spread between the US and the rest of the world. I would just point out here, yes, we're dropping off, but we're also moving into maintenance season. Just from a price signal perspective, transport costs and more are being covered. So really we should be exporting kind of the max we can from a capacity perspective. And then just to round out the story, we'll hit on industrial demand. Again, another maybe sign of economic recovery. We consistently see industrial demand has been stronger year over year, so blue line over red, and pretty close to the 5-year range for the most part. We did see an impact from the storm, so when it got really cold, lots of different facilities had to shut down for operational reasons or other reasons. We saw that bounce back, but really, I would say for most of this quarter, we've seen industrial demand performing pretty strongly, definitely a solid trend above where we were at previous year's levels. Again, maybe points to signs of underlying economic recovery. Okay, so I'll start off delving into the supply outlook a little bit here. A couple things to point out. I think there's a couple of key themes in the commodity sector as a whole that are impacting producers, clearly impact or have the potential at least to impact balances in the story for consumers. So you hear a lot of producers in their earnings calls talking about capital discipline and focusing more on growth, or focusing more on returns in the form of dividends and buybacks and things of that nature, as opposed to production growth. Now, that doesn't necessarily mean production doesn't grow, but I guess maybe another way to phrase it is not focusing on growth for growth's sake. And that has kind of manifested itself in a couple of different ways. So again, if we do a bit of a recap, we look at where rigs were coming into the beginning part of 2020. Oil rigs were 700, 750, somewhere in that neighborhood. Gas rigs were kind of around the 100 plus level. You saw rig counts for both oil and gas drop pretty sharply. Oil got down to, I think it was 180 rigs, I want to say, at the trough here, just looking over here at my notes, and gas went down to about 70. The good news, bad news story is, and it's a similar story for the U.S. and Canada as well, right below here. You've seen rig counts recover, so there is still the price sensitivity there in terms of producers. As oil prices and gas prices began to increase, you saw people increase from their capital spend and deploy more rigs and start drilling more. It is still well below where we were, we'll call it pre-COVID levels. So, a bit of a good news, bad news story, and a bit of a debate in terms of what that means for, supply overall. Should we expect declines? Is production going to start growing again? Again, I'll delve into that in a little bit more detail in the next couple slides. A couple of regional stories to point out. Again, I talked about Canada. I'm sure a lot of folks on the call source at least all or part of their gas needs from Canadian imports. Gas rigs are I want to say about double where they were last year. There's a bit of seasonality in the trends of Canadian drilling, so it's a little bit more difficult to discern. But I believe Canadian rigs are around 34, so that's again over double where they were before. And oil rigs are kind of in the low 40s. So that's a more modest increase versus where we were before. So increased drilling north of the border. Rockies is probably another basin of interest for folks. You've seen a rebound, but pretty modest. It's a similar story for the Bakken and a lot of other oil basins where we got down to say a minimum of around 10 rigs last year in the 2Q time frame, and then we rebounded some to 15. You compare that to we'll just call it 40-ish going into the beginnings of COVID last year in 1Q of 2020. A lot of the oil rebound has really been in the Permian. That's what I'm depicting in the lower right here. A pretty good chunk of the overall total oil. You see the trajectory there falls along pretty well. Perm's up about 90 rigs versus where they were at the lows. And really the story sort of evolves to, if you're looking or hoping for production growth going forward, it's probably most likely to come from a few specific plays. The Permian, Canada, Haynesville, perhaps from the U.S. Haynesville rigs are up. Ran out of space here to show graphs on the slide here, but Haynesville rigs are definitely up as well. Northeast, maybe a little bit less so than what we've seen in the previous years. Strategies shifting a little bit there. Pipeline capacity is not constrained, but maybe becoming a little bit tighter than what it's been the last couple of years. So, a bit more of a modest rebound from a Northeast perspective than what we've seen in past years. Okay, so let's talk about production. Then if we look at this particular graph, we've got the blue line here of history. This is coming from the EIA. And then I've got the gray range of outlooks. I tend to do this where, it's different people have different opinions on what's going to happen, just to give folks an idea of what some of the different thought processes or outlooks are in the market. I think the way I would summarize this slide is, everyone seems to agree that 22 over 21 growth probably picks up. Probably a good time to mention these aren't necessarily based on the forward curve. These are usually based on the different price forecasts underlying. Most of the forecasts have a bit of a bullish bias versus what the futures are indicating, although I would say that gap has shrunk pretty considerably over the last 3 to 4 months or so. EIA is showing production relatively flat over the summer, and then growth starting to pick up into the winter. 2022, getting us to, from call it 90 to 91 Bs today to closer to 95 by the end of next year. But this is where the divergence happens. You have some school of thought that, rig counts haven't recovered enough to get us flat or growing from here. Maybe production declines a little bit over the next couple months before it rebounds into next year. But, the opposite side of that is some folks think, okay, well, rigs have rebounded. They've rebounded in the right place. Again, clearly, crude prices being up, drives a lot of the associated gas drilling in the Permian and elsewhere. We talked about rig count increases there. And there is some school of thought that maybe we grow from here and continue to grow into 22. So I think the positive story from a consumer perspective is producers have responded to the price signal. Most folks are thinking at some point growth resumes. I'd say maybe a bit of a point of caution or thing to watch is rig counts haven't rebounded to pre-COVID levels. It's focused in a couple of key basins. There's still a bit of a debate around, is that alone enough to really drive growth for the U.S. as a whole? Shift gears here and talk a little bit about LNG, since that's a pretty decent size of the U.S. market. We've become connected with the international market over the last couple of years as we've added export capacity. What I have on the left-hand side of the screen is going to be pricing. So the dark blue line, HH, is Henry Hub. JKM, the orange line here, that's Japanese Korean marker. I'm using that as a benchmark for Asian LNG prices. And I've got MBP, which is National Balancing Point. I'm using that as a benchmark for European LNG. So US versus Europe and US versus Asia. And one of the things that maybe stands out is if we look around this time last year, we were at parity or almost there, pretty close to it, at least anyway. And you compare that to history, it's a relatively rare phenomenon. And that was a combination of a couple factors. Just as we had stay-at-home orders in the U.S., clearly COVID was a global phenomenon. You had the entire global economy impacted. You saw global gas demand fall off, and the market started to feel a bit oversupplied. The gas market overall, I would argue, is relatively efficient from a price signal perspective. I would sort of sum this up as, well, if the globe already had enough supply last year because demand was off, the only way you're going to shut off LNG exports is to send that price signal. So that's essentially what this is when you're seeing global pricing really move down to kind of come in parity with U.S. pricing. It's a relatively short-lived phenomenon. As we went into this past winter and this summer, you can see if I just look at the difference between international pricing in the U.S., we're back to levels we were at in the 17 to 18 time frame. And we did have a bit of volatility in the early winter. There's actually some early cold in Asia, as if we don't have enough to worry about now we got to worry about not only U.S. weather, but global weather. So we had a bit of early season volatility, early season cold in Asia that caused prices to spike a little bit relatively quickly. But I think that the thing to take away from this is, if I look at the differential for the U.S. versus the rest of the world, pretty robust compared to historical trends, and certainly much wider than where it was last year. Just in terms of where we saw the flex in the cargoes, if I look at my plot on the right-hand side of the screen here, the dark blue wedge is Europe. So we actually saw Europe is one of the bigger swing destinations in terms of pricing to shut off exports when storage was relatively full and supply demand conditions were relatively loose last year, trending towards oversupplied. And then we've seen those turn back on again. European storage inventories are much lower than they've been the last couple years. So that's another story that's driving that wide spread between the U.S. and the rest of the world. Probably the other thing to point out too is if we look at we'll call it the royal blue wedge on the bottom here. And we had a period of time when U.S. and China were going through some pretty intense trade negotiations where China really wasn't taking any cargoes from the U.S. That's since reversed, and we're starting to see cargoes going to China again, which is, China's probably the single biggest, maybe in tandem with India, demand growth driver going forward in terms of LNG. So interesting to see that cargoes begun to flow again into China as some of those trade tensions were alleviated. Okay, so in terms of the outlook, again, another one of these range charts here to give you an idea of some of the different thoughts in the market. For IA, and we kind of went through this, but big drop off last year when global prices were at parity, recovered pretty quickly into this winter. EIA actually happens to be towards the bottom end of the range, so they're showing exports continuing to grow into 22, but I would say modestly so versus 2021. If I compare that to the range and maybe compare that to the capacity line, starts to give you a bit of an idea of what people are thinking in terms of, you hear the term shut-in thrown around. Basically, all that means is, our facility is going to operate at less than 100% of capacity. The consensus seems to be that's going to be the case. I would say, if you think back to a couple charts back, Currently, we're running at pretty much full utilization when you take into account potential maintenance implications. But the consensus seems to be that maybe there's going to continue to be some of that shut-in dynamic going forward. Again, I would say it's not necessarily consistent with how the forwards are pricing. The other thing to point out would be that we're starting to come to the end of, to use a bad pun, the big wave of LNG export expansions we've seen in the last couple of years. There's a third train of Corpus Christi that should come online this fall, and then Calcasieu Pass will probably come online either in the fourth quarter of this year or 1Q of next year. So that's what you see that's driving these two step changes here. And that's probably it for a while, just in terms of how long it takes to build facilities. You'd maybe be looking at, call it mid-decade when another potential round of export facilities might come out of the U.S. Golden Pass seems like they're sort of in the driver's seat there. And this is obviously U.S. centric, but call it mid-decade would also be around the time when you'd probably expect LNG Canada and potentially wood fiber to come online out of British Columbia as well. All right, so where does all this leave us? If we throw the ingredients in the cake and bake it, it comes out with the EIA telling us that they're expecting inventories to be around or below the 5-year average. I kind of foreshadowed that a little bit. Again, maybe a little bit of a different story for the West. The West does look a bit more full relative to the rest of the country. I don't know how many folks are looking out on the curve into 22, but I think it's just sort of interesting to point out, the big story the EIA is talking about here is production growth slowing this year, starting to pick up again next year, and they're expecting demand growth to pick up next year, exports to pick up next year. They actually have a 3.43 TCF inventory number for the end of 22. So they're actually expecting inventories to draw going into 22. And I know that, maybe for some folks seems like a long ways away and lots of stuff can happen with the economy and weather. But I think it's just interesting to point that out. It's a bit of a different picture from a fundamentals perspective versus, maybe what we've been used to over the last couple of years. And then if we talk about price calls, the EIA is sort of right around that $3 mark for the next 2 years from a Henry Hub perspective. Looking at futures is what we're doing here in this next chart. If we look at where the forwards are versus where they were last year at this time, solid line versus dashed, prices are quite a bit elevated where they were last year. Obviously a ton of uncertainty around COVID. How long do those impacts last? What's going to happen from a producer financial perspective? But we've seen the economy recover. Balances seem like they've tightened a bit. Futures are reflecting that. The forward prices show futures getting a bit weaker over the next couple of years, somewhat consistent from 21 to 22 and then getting a bit weaker. I think, if I wanted to pitch a bear story, it would be focusing on, crude prices are up. So maybe we get a lot of associated production growth from the perm. If that LNG story shows up in terms of shut-ins, maybe that means less export demand from the U.S. So perhaps that's some of what the futures have baked in and the reason why prices are getting a bit weaker over the next couple of years. And if I look at the outlook from the consultants, the bullish view is probably, the producer discipline story, production not growing as aggressively as it has over the last few years, strong export story. If I need the economics to matter for the Haynesville and Marcellus folks, maybe that's more of a 3+ world from a Henry Hub perspective. Okay, so just hitting on a couple trends here from a regional perspective. If I look at the West as a whole, drilling from gas wells has really been in decline for quite a few years. It's almost entirely been a Permian story and a DJ story. Niobrara might be a play folks are familiar with. They've heard it from a tight oil drilling perspective. And we talked about rigs and Rockies haven't really rebounded a whole lot. Perm has those, so maybe gives us a little bit of a foreshadowing in terms of where that growth comes from. All right, from a demand perspective, we've got a bit of differing stories here between the Rockies and the Desert Southwest and California and the Pac Northwest. The way I would sum this up is demand overall from a natural gas perspective has been growing in the Rocks and the Desert Southwest. And a lot of that's a coal retirement story over the last few years. You get a bit of the opposite trend for California and the Pac Northwest. There's a lot of seasonality, so it's a little bit difficult to tell the trends, but if I drew a trend line through there, it'd show you a bit of slanting downwards there that all the renewables builds coming in the stack, relatively modest electricity demand growth for the last couple of years has certainly impacted gas burns in California and the Pac Northwest. going forward doesn't mean demand declines forever, but pretty robust renewable portfolio standards in both the California and the Pac Northwest. So that'll continue to influence. But any year to year, this year in particular, hydro's down quite a bit where it's been before. I was just looking at Platts report before the presentation this morning. I think they're showing Pac Northwest power sector demand up somewhere around 300 million a day year over year to about half a BCF per day total. So year to year economic conditions, hydro is still going to matter. Okay, looking at the Permian in particular and talking a bit about what trends look like there. If we look at production overall today is around, I think, 11 BCF per day and change. If we look at how it's evolved over the last couple of years, we've basically doubled from 4.5 to 9. At the same time, if I look at my pricing here, which is my orange line on the right-hand axis, pricing got very, very weak locally. What that did was that drove pipeline expansions, which are what are depicted here in kind of these stair-step shapes over the next couple of years. Final investment decision on 3 rather large pipes. The commonality between all those is all those pipes are pointed east. So they're pointed east to more of a ship channel type market as opposed to west into California, the desert Southwest, to try to meet growing LNG demand growth, industrial demand in the ship channel, et cetera, et cetera. I think maybe not a lot of Permian gas going directly into the Pac Northwest, but still, I would argue the West overall is very interconnected. So there is still, impacts from what's happened from a Permian perspective. If forwards are telling you that the diffs at Waha will get weaker over time, but not really pricing and constraints, if we look at production, the consensus seems to be that production is going to continue to grow, and we'll need to continue to add pipeline capacity to be able to facilitate that. Okay, rounding out the story here and talking a bit about trends north of the border. Canadian storage, I would say somewhat similar trends to the US. If I look at West Can, we're a bit below where we were last year, basically towards the bottom end of the range. If I look at Eastern Canada, similar story, maybe more towards the middle end of the range, definitely below where we were last year. Tend to finish in a relatively narrow range for Eastern Canada. In terms of, inventories usually get full, relatively full, utility-driven storage for the most part over there. West Can is where you got a pretty wide range of outcomes. I think it's going to be interesting. Does pricing sort of react this summer to fill up storage for the winter, or do we go into this winter with a bit of a deficit? And that's something to watch for sure, not only for Pacific Northwest consumers, but really for the whole of the U.S. Right? The U.S. does tend to lean on Canadian imports in the wintertime as a balancing mechanism. There is maybe a risk, depending on what production does this summer, that maybe inventories aren't quite as full as they have been the last couple of years. Again, not unlike the total U.S. story. Okay, production. The story here for the most part is the expectation, not unlike the U.S., that production growth may start to ramp up as we go into next year. For this year, generally the consensus is growth of around 0.3 to 0.4 BCF per day, and we're talking about using a base of a 15 to 16 BCF per day market here. Again, the year-over-year comparisons get a bit tricky, just like the U.S., where we had shut-ins when prices got really weak. But the expectation seems to be that growth returns this year, which maybe isn't totally surprising given what we talked about in terms of rig counts and prices being stronger. And then the expectation, or the range of the forecast, at least anyway, is similar growth for 22, maybe accelerating a little bit. If you like to think about things in terms of percentage, the consensus here is about a 2 to 2.5% growth, 21 versus 20, and that shifts to more like a 2 to 3.5% if I use the high end of the range here in terms of growth into 22 versus 21. On the demand side of the equation, we're seeing demand recover in Western Canada. Year is 2021. We started off the winter in winter demand, absolutely influenced by weather as well, but relatively flat to where we're in 19. We're actually showing a bit of a surplus. I would argue, just like we're talking about from the U.S. perspective, with power sector demand being flat and industrial demand being up, I'd say we're seeing signs of economic recovery on both sides of the border, at least using natural gas demand as a bit of a benchmark for that. Been a bit of a shift in the power sector for Alberta in particular. AESO is the Alberta system operator. Historically, much more generation coming from coal versus natural gas. We've seen the shift over the last couple of years where I would call it co-baseload generation. And you've had a number of trends that have driven that, whether you're talking about carbon taxes or coal conversions, cheap natural gas helps facilitate that. And we've seen another number of coal plants, and really pretty much the entire coal fleet in Alberta is going to be converted to natural gas over the next couple of years. And that could continue to drive natural gas demand, which is what I'm depicting on the left-hand side of the screen here. We just do a little bit of basic math and say, if these plants that convert, if those are run at sort of a generalized utilization rate and heat rate, then you're looking at, as these retirements ramp up, and again, 22 and 23 are when you see the big step changes, you could see another incremental half a B plus in terms of power sector demand specifically in Alberta. Flows have generally been up year over year. West is probably more of an interest in the folks to the east, probably of more interest to folks on the call versus eastern flows. But really, both sides of the equation, production's up, exports have been up. Whether you're talking about flows to the east or the west, West in particular, month to date, right, not a full month sample here, but up 12%. So pretty robust increase, 21 versus 20. And that sort of begs the question of what's going to happen going forward, which is always interesting. We saw exports peak when it got really cold at 6.5 plus BCF per day versus the U.S. I would say export forecasts, a lot of noise from a seasonal perspective. But if I look at it from an annualized change, I believe it was around half a B a day of increases. A lot of that probably weighted more towards the winter versus what we would see going forward, and then pretty flat from 22 to 21. So maybe gives you a bit of an idea of the expectation of some folks, at least anyway. I would read that and say, okay, well, if exports are expected to be flat from 22 to 21, then probably underlying that is the assumption that the production growth I was talking about before is offset by demand growth in either Alberta or BC. There are a number of pipeline expansions coming, both into the west and into the east. We talked about how perms evolved the last couple of years, had a lot of weak local pricing in AECO that drove a lot of expansions, had quite a few delays from a COVID perspective getting those expansions online. But those are really going to start ramping up as we go into this winter and next summer. Again, it's really both sides, right? There's more expansions coming. Another 100 plus TJ and Novi 22, and then the numbers continue to climb as you go into 23, which is good from a consumer perspective. More ability to get molecules out of Western Canada, and it's not just an NGTL story. T-South expansions later on this year as well, so more ability to move gas out of the West Can Basin into the Pac Northwest. I thought this story was a bit interesting, maybe something to watch from a consumer perspective. There's quite a bit of decontracting or FT contracts expiring over the next couple of years. And, whether I'm talking to the east or the west, it's a very similar story where once you get sort of into the back end of next year, a lot of the contracts that were signed start rolling off the books. Doesn't necessarily mean all these go away, but it is, I would say it's a risk. It's something to watch for sure from a consumer perspective. To the extent you're talking about flowing full cost economics versus variable costs, that absolutely can have an impact on basis. Which takes me to my last slide here. If we look at the forwards for basis, the thing that stands out to me is pretty flat structure. If I look at AECO, there's very little seasonality and really staying at it gets a little bit weaker into the end of 22, perhaps corresponding with some of that contracting, but much tighter versus Henry Hub compared to where we were when we were seeing constraints on NGTL in 18 and 19. If I look at Malin or Sumas, which should probably be of some interest to folks, continuing to see that seasonality trend going forward, but getting a bit weaker over time. So perhaps kind of following the general trend there of AECO. And then Rockies overall, again, I'd say very, very flat, maybe slightly weaker over the next couple of years. Again, if we talked about where production growth is potentially coming from, maybe it's more skewed towards the Permian and West Can as opposed to the Rockies. All right, with that, apologies for the technical difficulties up front. Hopefully that was an informative presentation, and I think we're going to move to Q&A.
I think I'm live. Okay, great. Josh, thank you very much. And wow, I'm impressed. We had 10 minutes of technical difficulties, but you finished almost exactly right on time. So congratulations.
It's the least I
Virtual
could do.
applause. Yeah, virtual applause for you. I do have a number of questions here. A couple of them were posted in the chat, which I just copied and pasted. So I'm not, for the audience sake, I'm not asking all these questions. I'm facilitating them. But the first question we have is, and you may have answered this, but maybe just go right at the question. Is there an expectation that power industry gas consumption will drop as renewables get built out? Or is that too much a longer term question for this analysis?
No, I don't think it's too much of a long term. I mean, I would argue we've already seen that, right? That was kind of what I was trying to illustrate with the California and Pac Northwest plots.
Mhm.
So I think those trends are in place. I mean, any year versus a previous is going to be a function of weather and the economy. So again, I talked about Pac Northwest. Looks like demand's actually up year over year because hydro's down, and it looks like electricity demand, the underlying electricity demand is growing. But yeah, I think, if I look at the renewable portfolio standards, I think California is 60% by 2030. Washington, I think, is 100% by 2045. Oregon, I believe, is 45% by 20. I don't want to quote the wrong number there, but point being that, a lot of the states where, folks attending this conference are going to be located have pretty robust renewable portfolio standards. So yes, I would say in the Pac Northwest in particular, the risk is probably more skewed towards power sector demand continuing to fall. Maybe with Centralia retiring in 25, it's a bit of a, it is a little bit different depending on which region you talk about. Obviously, somewhere like Texas, where I'm from, their renewable portfolio standards are based more on capacity, and they're a bit more dependent on gas-fired generation. But yeah, I think for the Pac Northwest in particular, it's certainly a accurate statement, or certainly the risk is skewed towards that way for sure.
Thanks, Josh. Another question: Are the majority of rig count gains in the Permian coming from private operators? Do you see consolidation and capital discipline in the public E&P space constraining rig count additions in second half of 21?
Back half of this year. Yeah, that's interesting. The short answer is yes. A lot of them are coming from private operators. I think there are some increases from public as well. In terms of M&A, yeah, that's absolutely been a pretty common theme. One thing that's really interesting from my perspective is, I think, or maybe at least I do anyway, you tend to think of M&A and think about, okay, one Permian operator buying another. One of the trends we've seen over the last couple months, I guess, is we've actually seen a couple Northeast producers look to diversify their portfolios and go from pure play Northeast to bring in some Permian acreage. The common theme from the M&A activity we've seen, I think, has been, more of a focus from the public producers on maintenance capex versus more of a lean or bias towards growth from the private folks. So yeah, I think, getting to sort of the heart of the question, that is a bit of a risk that the more consolidation you have, public spend versus private seems to be a little bit more measured.
Thank you. Josh, could you take down your, quit sharing your screen there, and then
Yes.
you and I will come up live a little bit. Not that they need bigger pictures of our face out there, but it's just a little easier to work with here. Next question, we've got just a few minutes left. A lot of good questions coming in. How do you see demand changing from the power sector day over day or even hour over hour as renewables in the West continue to grow? Substantial increases in short-term demand volatility?
Certainly the potential for that to be a risk, right? And I think we saw that, we've seen that in California. We've seen that in other areas where you can see pretty big swings short term in terms of what happens from a renewables perspective, whether you're talking about wind or solar or whatever the case may be. So yeah, I think, continues to be a risk from a volatility perspective. Continues, here's where I give my plug, continues to be a space and a role for natural gas in terms of, being able to turn on quickly and be able to respond to that volatility if you lose generation because of weather or outages or whatever the case may be. Really the big next shift in technology is going to be electricity power storage. So it's going to be interesting to see how that evolves. I think we're probably a few years away from that becoming, really kind of utility scale, really large from that perspective. But yeah, so in the interim, as you continue to add more renewables, continues to be the risk of volatility.
Okay, another question. How are localized carbon policies state level affecting fundamentals, or are they?
Yeah, absolutely they are. Yeah, I mean, that's really the route we've gone, right? It seems like far be it for me to try to predict politics, but up to this point, it seems like it's been pretty difficult to get a national carbon policy in place. So a lot of it's driven by a state. Absolutely, it impacts fundamentals. So again, hopefully relating this to locally, to the extent you're putting a carbon price into California, that changes the dispatch order. Alberta was another example of that, right? Where you get a carbon tax, and all of a sudden that kind of shifts how economic coal looks versus natural gas. Absolutely, that has an impact in terms of renewables builds. Whether you're talking about it from a carbon price perspective or from renewable portfolio perspective, as more renewables get added to the stack, generally what we've seen is that's outpaced the pace of electricity demand growth. So in areas where you've got really strong renewable portfolio standards, it tends to reduce that call on thermal generation, be it coal or natural gas.
Great. Do you have any thoughts on renewable natural gas demand and production forecast?
I don't follow that super closely. I'm sure if the person asking that question needs some specifics, I can get them in touch with somebody. But yeah, I think from an overall U.S. perspective, relatively small part of the portfolio. Although I think our take would be we'd see that growing over time, especially as consumers are looking at how they want to manage their emissions, or whether they want to try to sourcing more green gas.
Two last quick questions. How do you see the Montney Basin in Western Canada evolving?
Yeah, I think the short answer is growth. I mean, that's where a lot of the focus is in terms of where producers are deploying more rigs. Montney economics in particular, the wells are really prolific. A lot of the wells are pretty liquids rich too, and condensate prices historically, at least anyway, in Western Canada, tended to be close to parity with WTI. So I think with the commodity price rally where it is, economics look pretty good for those folks. Again, they're still saying the same thing in terms of capital discipline, and we talked about rigs increasing, maybe not fully to the point of where they were pre-COVID, but we're seeing growth on the Canadian side of the border, and the Montney in particular is where a lot of producers are focused.
Okay, one last question. As some states are forcing natural gas out of the mix and other states allowing natural gas to be used, do you see any fundamental change to basis pricing in the future?
Yeah, potentially. I think about the Pac Northwest in particular, and we talked about the seasonal shape of Malin and Sumas. To the extent that comes to fruition, and I know that it depends on how far out we look on the curve, right? Is that something that's going to happen this year or next year? Probably not. But if we move to more of an electrification trend and start taking some of that peak demand out, then yeah, there's the possibility that maybe some of the seasonality at Malin or Sumas starts to get eroded a bit as some of that peak demand goes away and goes to electricity. I guess the big question is, I guess making that assumption, the underlying premise is, well, if it goes to electricity, you're not just replacing that with gas-fired generation. It's actually coming from renewables.
Great. Josh McCall, thank you so much. That sound you don't hear is thunderous applause from our virtual audience for once again another stellar presentation. We so appreciate your time. And of course, this conference, once again, just appreciates the support of BP and IGI as one of our longstanding platinum sponsors. So Josh, thank you very much. And folks, we're going to take you back to the networking. And I just ask you to contemplate that one question at your tables. What jumps out to you from Josh's presentation today? And what does that mean for your business or what you do for a living? So just have that discussion or interact with each other. If you find yourself on a floor where there aren't many people, click to another floor and find a table where you can interact with folks. So we'll be back in a few minutes. You'll see a notice when we're about to get back to our presentation, a 30-second announcement warning. And we look forward, our next presentation will be John Carr introducing Ben Kuyala from the Northwest Power and Conservation Council. So we'll see you in a few minutes. Thanks again, Josh.
Thanks, everybody. Thank you. Thanks for having me.
Greetings, everyone. Welcome back to the presentations. I want to take this opportunity again to thank our sponsors. When we're in network mode, you can see the sponsors on both sides of your screen. If you want any information about any of them, and I hope you do, just click on them. I want to give a special thanks to our new platinum sponsor, Spire, and I want to thank our new gold sponsor, United Energy Traders. So with that, let me introduce Ben Kuyala from the Northwest Power and Conservation Council. He's going to talk about the new power plan, and it's a special introduction for me because it's very, very seldom I get to introduce another mathematician. So with that, let me turn it over to Ben. Just remind everybody, if you have questions, I hope you do, just go to your Q&A on the chat function and type them in or vote for the ones you see there. So with that, Ben, it's yours.
Thank you. And technically I'm a statistician, but I'm sure that that gets close enough. All right, let me share my screen and make sure that this is going to work well. All right, so I know the last presentation had a lot of kind of short-term and fundamentals in it, and that's not what I'm going to be talking about. I'm looking out pretty far into the future. And one of the things that kind of has come up over and over again throughout the course of the conversation about what we are seeing in the energy industry, well, especially in the electric sector, is there's a sea change on the horizon, a profound and notable transformation. And I just found out that that term comes from a Shakespeare play, so I had to put the quote where it was first used up in this as well. But it's a good lead-in to tell you kind of what I'm going to talk about. I'm going to talk about the changes that are on the horizon. There we go. So I'm going to talk about a couple of different things that we did in models, but I do want to be clear about when we are running models, we aren't doing maybe what most people are expecting. Most people think that we're trying to come up with a forecast of what is the most likely outcome that we think is going to happen in the future. And that's not really the exercise that the council is undertaking. We are interested in kind of what are the resource strategies, what are the ways that the system is going to develop. But oftentimes what we're doing is exploring something under a certain set of assumptions. And so I'm going to talk a little bit about what we see under kind of our baseline conditions, but our baseline conditions are really asking the question, what does it take to meet the kind of currently stated and out there policy objectives throughout the West? So again, this is just emphasizing it's not a forecast of what's likely to occur, but it tells you what it takes to meet those policy kind of settings and gives you a sense of kind of what is the texture of the change in the electric industry that we're seeing. So one of the first things that you have to talk about is the complete change in the cost of resources. Really, when you look around the sector, we did the 7th power plan, released it in 2016, and what we had were renewables being more expensive than the gas resources that we tested, more expensive than combined cycles, and more expensive than simple cycle resources. And that's completely flipped in the narrative. And really, since the 7th plan, the price of renewables has come down precipitously, and the price of natural gas resources has also come down substantially. So we've seen really lower costs for new resources throughout the entire electric sector. But really, that has been driven by a fall in pricing from the renewables. And as you look around the various different locations that we can have renewables and the kind of assumed capacities that we would see them perform at, you see that that cost, the levelized cost of energy, comes down to a very low cost overall. The other thing that you have to look around at is all the different policies that are aggregated together, driving us into a particular solution for the West. So if you take a look at the RPSs, the Renewable Portfolio Standards that have passed, you add in the clean policies that have passed in states like California and Washington, where they have a requirement for a certain percentage of the generation to be non-carbon emitting. And then you look at the utility and community goals, and some of those utility goals are really large drivers of this result as well. So for example, Idaho Power, being the major utility in Idaho for our region, has a clean goal out there, and that is a big part of what we see in terms of this drive towards renewable resources and to resources that are not emitting. You know, other examples around the West are I believe Xcel Energy and other utilities have similar goals, and certainly some municipalities have goals and things like that. We tried to capture all of that, putting it together, saying, what do you get when you add these together? And the lines here kind of show you that we went state by state throughout the entire West to try to put this into a cohesive picture. The thing to focus on is the table. Really what you see is, as of 2030, the jump between 2025 and 2030 for these clean resources is pretty substantial. And the end point in 2050 gets to a 80% basically implied generation that has to be meeting these requirements. So again, you know, we want to be clear, there are different requirements that we're trying to put together here. So if you look at just the RPS, it only gets you to a certain point. But when you add in those clean requirements, that adds on top of that a certain amount of load that we would expect to be looking for resources that do not have any greenhouse gas emissions associated with them. And then when we add in the utility goals, the municipality goals, and the other goals like that, those are even kind of further above and beyond. Now, of course, the RPS is law, the clean part is law. Those sort of additional goals that you see here, that additional 6% all the way up to the additional 12%, that's not necessarily law or something that's a requirement, but it gives you an indication of what different utilities and other areas are looking to. When you put that all together, what you see is a really large build of a lot of renewables. So to meet those requirements, to keep the system adequate, and to the best of our ability to estimate, we see a build that exceeds the installed nameplate of the current Western electric grid. So again, I want to emphasize, this is not a forecast of what is going to happen. This is what it would take to meet the policies and the requirements that are currently on the grid. You would see a very large build of solar and a large build of solar with storage, and frankly, a pretty moderate build of new natural gas. And we had a lot of back and forth talking to advisory committees and talking to our council members about what might be possible in terms of new natural gas generation being added into the grid. And we had a very limited view. And I'll talk a little bit more about what the implications of that were, but let me just kind of start out with, when we are seeing the sort of build of renewables that's required to meet all these policies, we're seeing something that is a fundamental change in the way that the Western grid operates. A lot of that build comes into California. So comparing this to the SB 100 draft that California had out, really the main difference between our work and the work that California is putting forward is that they had a better fidelity and view of what would happen in behind the meter solar in their state. So we probably are overrepresenting the utility scale solar a little bit in our results because we don't necessarily have the same expectation on the behind the meter incentives and the way that California works with that. But overall, we were very close. We're in the same neighborhood of what they were saying or projecting would happen to meet SB 100 down there in California. The other aspect when you look around the West is that there's a lot of coal retirements happening in kind of the desert Southwest. So when we look at what's happening in the desert Southwest, we see this as more of a phenomena on replacing a lot of retiring resources, as well as building to meet those clean policies and continue to be exporting into California. So the desert Southwest has kind of that dual requirement of both retiring the resources, but also we made sure that we captured in the models that the clean requirements in California mean the imports have to be associated with resources that do not emit greenhouse gases. This results in what you might expect. The entire grid cost usually closer to kind of parity on a fixed cost and a variable cost basis. What we see is a rapid acceleration of the amount of fixed costs to run the grid, and the variable cost stays relatively low by comparison. Both of those have increasing costs through time, but really the fixed cost into the system is the far bigger driver when you're looking at these builds. So what does that mean for the amount of natural gas generation, or actually just a usage of natural gas? So in our models, we have some general sense here of what we have for the region. And so I'll give this as kind of a regional perspective of just the Pacific Northwest, used in terms of natural gas to provide generation for power generation. So you can see that we are in kind of that 231 neighborhood of, I think it's 231 BCF. In our models, we see something that starts very close to that same historic sort of build. But as you see these renewable builds build into the system, if things go that direction, we see a quick crash in the amount of natural gas used for the electric generation, getting down to around, I think it's 100 B. So that's under our baseline conditions, meeting the current policies as set out. But we wanted to also explore what would happen if you were aggressively going after decarbonization. So just to give you some context for what are the goals and the objectives that are stated out there, currently Oregon has a stated target of having an 80% reduction below 1990 levels by 2050. For emissions for the economy, and Washington has a target of being 95% below 1990 levels by 2050 and at net zero emissions. So those are aggressive goals within our region. Under our baseline kind of conditions, where we were looking at those renewable builds and all the things that go into that, there's a lot going on in the electric sector, but we don't really see that resulting in a reduction in the overall emissions for the region. Relative to 1990 levels, we actually forecast the emissions would be higher than what we had in 1990 for the region, with the electric sector dropping substantially, but a lot of the difference being made up in especially the transportation sector. So to work towards decarbonization, we need to do something about transportation. And what this is showing is that if you look at our reference case, we certainly have electric demand for transportation as part of what we are forecasting. And that's that red line on the very bottom of this graph. If you, on the other hand, aggressively push just batteries as a mode of transportation, so you're looking at just turning more transportation to electric, you get to this orange dashed line, and that builds load much faster. And has a moderating effect on the tailpipe emissions, but does not get really to a point where there's substantial reduction. To really have a reduction in the transportation emissions, it takes doing something else. Our proxy for doing something else here is hydrogen. So in this case, what we have is electric load that's required to produce hydrogen through electrolysis, and then the associated emissions go down as you change your heavy duty vehicle fleet over to a hydrogen fleet, whereas probably the predominant amount of the light duty vehicle fleet is electric. So we do have some heavy duty plug-in here, but you can see the vast majority we've turned over into something like hydrogen. Now, I want to say hydrogen it's out there a little ways. This is not necessarily us forecasting or saying hydrogen is the technology that's going to take off. It's a good proxy for looking into the future. It might be that battery technology gets to a place where the weight of the batteries really can respond in the heavy duty vehicle arena. I think the challenge here is for the electric sector. Either way, you're talking about a very large growing electric load to accommodate the decarbonization of that heavy duty vehicle transportation. Now, what we see from sort of the natural gas consumption as well, in a lot of these policies, we see a demand destruction in natural gas, and it's not just within the electric sector. The sort of policies that we put together show a very sharp drop off in natural gas consumption. Now, I think this could be replaced by, this is traditional natural gas, so this could be replaced by renewable natural gas, could be replaced by hydrogen, or it could be replaced by electrification. Which technology wins out is hard to say at this point, but it is something that we are continuing to look into, and dig into. So if we take all the heavy duty vehicles and we kind of push them at the limits of our assumptions towards what it would take to decarbonize the system. So you're doing a full turnover of light duty vehicles by 2030. You're pushing towards having 100% of sales in heavy duty vehicles being zero emission vehicles by 2050 or close to that. And there's a lot of other assumptions that we worked into this work, really aggressively going after decarbonization. What we see is it is not really possible to get, we can get reductions from 1990 levels, but to get down to the targeted levels is not something that we saw is possible within just the intrinsic energy sector. So really looking at the energy sector, the sector falls short of the targets that are put out there. Of course, this is a regional amount of emissions and the targets change from one state to the next. So overall, we would imagine that 80% is just a point of comparison, but an 80% reduction from 1990 levels would be just under 30 MMBTU of CO2 equivalent emissions. Our models show that by 2050, we're around 90. We do the electric sector modeling through 2041. So if we could continue to do reductions in the emissions for the electric sector between 2041 and 2050, we could maybe push that down towards 60. But we're certainly nowhere near getting a target of anywhere close to 80% reductions from 1990 levels. And that's with really aggressive assumptions on what it would take to decarbonize. So the other thing that we've kind of been looking at through this work is adequacy assessment. There's been a lot of conversations about where adequacy is in the electric sector. Do we have enough resources? And so stepping away from the decarbonization work, this was one of the things that Dan had invited me to talk about. And so I want to kind of take you through a little bit of our view on what we see for resource adequacy in the electric sector. Again, that large build is part of the results that we're looking at. So in our baseline, we see about 70 gigawatts of non-Pacific Northwest build by 2025. We had a lot of conversations about that, and certainly it is something that people are still debating. So whether the build will be that fast and that large is something that we want to test. So when we look at the implications for adequacy, we do see it can move the adequacy of our region depending on how large that build is, but not a lot. Really, when we look at the build external to our region, if the rest of the West goes very short by not building resources, that does turn into a challenge for us on the adequacy side. And that can have implications for the Northwest, but moderate implications, not severe implications, because we already have limitations on what we allow in our adequacy assessments for transmission into the region. And of course, just physically, there's only so much transmission space into the region, and that already is basically being used often in import and export balances. And so there's a certain point where you could build a lot of renewables and you're pretty much fully utilizing that transmission, and it's not really going to change the story when it comes to resource adequacy past that. So one of the things that we wanted to be clear about is we're seeing a lot different texture of how we see deficits coming up in our resource adequacy work. And this is really a function of kind of that reduced market pricing coming from a large build of solar resources. So really throughout the West, prices are driven by solar. They're really low during the middle of the day. Extreme prices tend to be during the ramps, when the sun is either before the sun comes up or right after the sun goes down. And the events we see where we have any sort of deficit tend to be really short in duration and kind of in those ramping periods, although really they can be all over the place. Our largest deficit event that we saw in our simulations was 7 hours. Most of the deficit events we saw really were more like 1 hour shortfalls. So when we do see shortfalls, they tend to be really small. We have some large problems that are part of the simulations that we ran, but overall, when you look, our standard is to be looking around a 5% loss of load probability, although from this graph, you can see loss of load probability is not a necessarily good measure of the size of the problem, because it's a very flat graph for a good chunk of it. And really the problems that we see are pretty moderate and can be solved by moderate additions into the region or changes in the way that you do operations. Energy is the same picture. So a large loss of load probability in the past might have implied to people that there were a lot of problems around, and it would take a lot of things to resolve those problems. Our current analysis really says that the loss of load probability can be relatively large because there's just a lot of small, very short-term problems that are likely more related to operational challenges than they are related to the actual shortfall or not having enough steel in the ground, in essence. In fact, when we look at the deficit events in our simulations, what we see is that often our thermal generation in the region is not utilized during those deficit events. It's not at full capacity. So oftentimes what happens is the prices are extremely low throughout the day and thermal units do not commit. And so they are not available to respond if there is a adequacy issue that comes up, in this case a deficit, because scheduling is not basically, you have scheduling error or forecast error that is not able to be covered strictly by reserves. And so if you do not have additional resources committed, you end up in a situation where there's a deficit, but it doesn't show that the system is necessarily at its maximum output. Oftentimes the thermal units might even be completely decommitted, and that is part of the driver in the problems that we see. So one of the things that we've tried to do to kind of ground truth this and really compare to some previous work was look at the load resource balance. Prior to us having loss of load probability, prior to probabilistic assessment, a lot of people used load resource balance as a way to kind of judge how much resource do we have relative to the load, and are we in a good place? Originally, when we started the adequacy assessment, we had kind of a load resource balance showing a massive deficit. Our loss of load probability back in those days, given a very different set of models and a very different way of making those assumptions, but it was around 24%. And we were showing basically that we were deficit on a load resource balance basis, about 4,000 average megawatts throughout the year. I apologize for anyone who's not used to the Northwest. Average megawatts is a unit that we use here almost exclusively. I've rarely seen it used anywhere else. That just means 1 megawatt throughout the entire year is 1 average megawatt, or over whatever period you're interested in. So our load resource balance now in 2023 and in 2025 shows a actual surplus. So we're not seeing the loss of load events are not really the same problems that we saw leading up to 2001. They're very different events where we would have a deficit. And that's true both in the winter and in the summer, although certainly the winter we see a little bit higher load resource balance and in the summer a little bit lower. One of the other things to note is that we are seeing a lot of similar issues coming up in California. So California already has been going after this. I understand there's currently conversations underway in how they formulate both their market and the energy imbalance market. You can see that they've got conversations going on about the flexible ramping products, but one of the things they for sure have is a lot of curtailment as well and uplift for resources to make sure that they have enough stuff online. The Northwest is probably going to start seeing more and more of these types of problems, although the solutions that we will have to use would have to be different because, of course, California has an organized market. So hopefully that gives you a general sense of where we are in the power plan and some of the results that we've been looking at. Be happy to take any questions at this point.
Yes, we do have a series, sort of get it started here. I don't know if you can see the question too, Ben, but the first one is can we build the amount of new high voltage transmission that's going to be needed given the significant environmental issues involved around trying to construct new transmission?
Yeah, transmission is always challenging when it comes to building new transmission. I will say what we've assumed in a lot of these cases is that this renewable build fits within the existing transmission system. That being said, I think there's two things you need to keep in mind for that. That there's a lot of times renewable builds are coming in and removing current generation from the stack. They're cheaper than any of the thermal generation there. So if you add in a bunch of solar into an area, the thermal generation gets pushed off. And so you have more room on the transmission system, basically because it's able to undercut the existing generation at the variable cost, because that's the way the markets work. The second thing is there's a lot of curtailment. And so oftentimes you're building for the shorter periods, you're building for times when those renewable resources aren't necessarily at their maximum output because you need it for resource adequacy. So overbuilding is often the strategy it takes, which means that you might not have enough transmission to get the renewables out. And when you get to that point, you curtail the renewables because it's the shoulders that you really care about. And so it's a very large build, and transmission would relieve a lot of problems with it. But really our baseline assumption in our work is that the transmission system is not changing through time.
Okay. Another question is, what does the model do when there's periods of low wind in the winter that can last for a week or two? The questioner said that Germany sees a 2-week low wind event occurring every 2 years.
Yeah, I have to be careful here because I think the problem of what happens in the entire West is different than the Northwest. So focusing on our region, we have generally been a region that has exported a lot of hydropower. And what we see in our models and kind of what we are still exploring and trying to do a better job of really pointing out and explaining to people is when the solar builds start getting really large, the hydro generation no longer has a market. And so a lot of the problems that you might have seen in the past would have been under a hydro operation where we would have been exporting power a lot of the year. And then we get into a short sort of period or a period where we don't have as much fuel. And that changes the dynamic. So a lot of what we see is the hydro operations are really fundamentally shifting under this world. We have our current Fish and Wildlife program incorporated in. We certainly have all the biop restrictions incorporated into our hydro models, but there's still substantial ramping, and there's probably some good questions that we need to take back to the hydro operators and consider in our next Fish and Wildlife program to make sure that that's a possible operation. At the same time, under the market prices that you see in a large solar world, you don't really have an option because there's not going to be anybody interested in taking that hydropower during the middle of the day when solar is at its absolute peak. And so I think there's just a really changing dynamic in our region, and hydro has always been the fundamental answer to anything related to resource adequacy for the Northwest. It will continue to be, and how the hydro system interacts with this world is going to be the thing that drives adequacy in the future.
And just following up on that, there's another question about, did you assume the loss of any federal hydro power, like the lower snake dams, or more restrictions due to just flows around adult salmon returns and those kind of things?
So again, we have the current biop restrictions, and we have our Fish and Wildlife program. So any of the restrictions that are in the Fish and Wildlife program are certainly in our hydro system. We did not assume either the removal of any resources or further restrictions that exceed what is currently in the Fish and Wildlife program. So for those who are familiar with that setting, I would just point you to our current Fish and Wildlife program. Those are what we have in the restrictions.
So from your modeling standpoint, it's just another one of those risks that affect the results.
Yeah, absolutely. It could be down the road that there are operations that get added into the future Fish and Wildlife program that could change the amount of generation that you would see out of the system. You know, when that happens, certainly we will incorporate it into our projections. Right now, you know, maybe that's overstating where the hydro system will be 10 years hence, but we kind of have a statutory tie to looking at kind of current circumstances on the ground and certainly making sure that we are implementing our Fish and Wildlife program as drafted. So if there's not something out there 10 years into the future in the Fish and Wildlife program, we're not going to put that into the power plan either. And that's something to keep in mind when you're looking at these results for sure.
Okay, just a couple more. Another question is, does the WEC renewable resource build assume the conversion of natural gas customers to electricity, or would that be incremental, for example, like gas payments?
Yeah, so under our baseline conditions, when we're just looking at the policies out there, we don't assume anything about the end use natural gas customers. So we're assuming that basically there's a lot of demand destruction for natural gas in the power sector, because you're just seeing so many renewables being built into the region and into California and the rest of the West. So in the power sector, you see the demand for natural gas go down really substantially. But in the end use, we're assuming that that would stay kind of in a steady state. Now, when we looked at decarbonization, we saw that to get anywhere close to the goals that have been stated, and we were really kind of focused internally on the regional goals, but certainly there are goals beyond the region as well. That ended up in a world where you saw a lot more natural gas destruction. As I said, I think you could say that that's not using, you know, fossil fuel natural gas. So it could be that you have a gas system that's moving to cleaner fuels, or it could be that you have electrification happening. I think depending on what those cleaner fuels are, if it's hydrogen through electrolysis, it's still going to be a big impact on the electric sector. And so that's one of the things that we're trying to keep in mind, is that it's not necessarily saying that you should switch everything to electric, or that you should switch it to a different type of fuel. It's saying either way, you're still in a world that's going to have pretty broad implications for us as the electric sector. And frankly, if you look at the decarbonization work, the current electric grid becomes a small part of a bigger machine made to produce hydrogen to accomplish this. That's really the only way you even get kind of close to the decarbonization goals, which is so much beyond any of our current power system modeling or the way that we think about these things these days.
Okay. Oh, another one is, can you speak to the electricity requirements on a peak day with given a renewable build and increased electricity demand?
Yeah, I mean, again, in our region, and again, not taking that sort of heavy decarbonization path, I think what you would say is that those needs we see being met by a restructuring of kind of the hydro system. So we do see the hydro system playing a big role in meeting those peak needs, and a lot of the energy demand and times when you might have used water in the past are changing. So it shouldn't be thought of the same way that maybe you previously have envisioned where hydro responds. I think our historic sort of view of what the hydro system has done and when it's been available for capacity events might not be as informative into a future where you see this high of a penetration of renewable generation. And so hydrogen, I mean, certainly the hydro system can do a lot. And if you do get past the hydro system, there might be some circumstances, and certainly we did see a few where you'd see some things like storage coming into play. Solar plus storage is another product that might be out there. We see a lot of those in the queue. And we did look at things that were a bit beyond. So we had emerging technology that we took into kind of the later half of our plan. For that, we used a proxy plant that is based on a small modular reactor. So there's different types of technologies that can kind of help you depending on the circumstances you're exploring. But overall, I do think that there's also, you need to be very intent on understanding the hydro system before you go start investing a lot of capital into other resources for capacity.
Let's have two more questions here. You've stimulated people's mind here, that's for sure. Do you sense there's an appreciation of the broader costs of renewables, the backup power, the transmission, or does the popular perception remain focused on the units themselves?
Well, I said I was a statistician, but I'm not a social scientist. I'm not really sure what the popular perception might be on these. You know, I think again, what we are saying is you take the current policies on the books and you say, we're going to meet those policies, and it builds you into this world. If those policies aren't met, then that means that people pass laws that aren't going to be achieved, and there might be some backing off. Certainly, we've seen some regulations and some moderation of regulations happen through time. I guess I would just say the direction of all of this seems to be going in one way, and solar is extremely cheap. And so it's a technology that's going to get very pervasive very quickly, based strictly on economics. And then with the policy levers that are pushing it forward, I think really what we're going to be looking at is an electric grid where everything we're doing is basically accommodating around solar as a resource, because it's just basically going to take over and be so pervasive.
Okay. Well, one last question here. Does the analysis take into account the utility's past performance compared to the goals and models moving forward?
Our analysis looks at the existing system, the physical system, and what you would have under some cooperative markets. And so I will say, certainly we have things like contingency reserve pools reflected as those reserve pools. We're not assuming like some sort of copper sheet or amazing market throughout the West, but we're not also assuming that anybody's going to be trying to do something to hold back power or create some sort of market friction. We're assuming that trading happens per normal. The other caveat I like to give, and I will say I've cut out a large number of caveats from this presentation, was the way I kind of got it within the time I was allotted. The markets that we have today are designed mostly to deal with things that are more like fuel swaps, where you have a less efficient plant that is displaced by a more efficient plant. When you add a bunch of renewables into that system, do we even have a market that looks like the markets we see today? I don't know. I think that you end up in a situation where you have to ask yourself, would we even continue trading power in the same way? And in that world, what happens is anybody's guess.
Well, thank you very much. And like Dan keeps saying, if we're in a real, in person, you'd be here, and I'd be asking for a great round of applause for you. But I guess we'll have to wait till next year for that. But you certainly deserve it. That was very thought-provoking. And I'd ask at this time, we'll be moving to a networking event again. And as like Dan has been suggesting, sort of take one of the questions or concerns that have come up, that have arisen from Ben's presentation, and use it at your table to have a good roundtable discussion. So with that, we'll go into roundtable discussion and networking. We'll be having a lunch break coming up too. We'll shoot for the next panel. Dan will be introducing them to start at 11:45. But again, we'll keep you anytime there's a presentation coming up. You'll see something on a screen saying you got 30 minutes to get ready. And with that, let's go to networking. Thank you again, Ben.
Well, good afternoon. At least, well, it's still morning here on the West Coast, but for several of our panelists, it's mid-afternoon for this upcoming panel. We're really pleased, even though the title slide there says the Northwest Power Plant update, we're actually into our new panel, our keynote panel, featuring a number of really great guests, and we're really glad they're here to join us today. I just want to introduce your moderator for this panel, and that's Teresa Acosta with Calpine Energy Solutions. Calpine Energy has been a proud sponsor of the annual energy conference for, gosh, at least 15 years, but a platinum sponsor really for the last 5 or so years. I think I'm about right with that number, Teresa. And Teresa, I just want to thank you and Calpine Energy Solutions for making this event possible, joining your other platinum and other sponsors in making this event possible. So with that, I'll let you take it away. Thank you.
I'm sorry, can you hear me?
We can hear you.
Okay, sorry. Said I was not on my mic. So we have a distinguished panel of experts today. I'm going to start with Amy Andrzak. She's president and CEO of the Interstate Natural Gas Association of America. Hi, Amy.
Hi, how are you today?
Just fine. How are you?
Good,
We
thank
have
you.
Marty Durbin. He's president of the U.S. Chamber of Commerce's Global Energy Institute. Marty? Hey,
Thank
Marty.
you, Teresa. Happy to be here, Teresa. Thank you.
Welcome. We have Karen Harbert. She's president and CEO of the American Gas Association. Hi, Karen. And direct from Canada, we have Tim Egan, president and CEO of the Canadian Gas Association. Hey, Tim.
Hey, Teresa.
Okay, so let's get right to it. Let's kick it off with our first question, and this will go out to all of our panelists. How is the part of the natural gas value chain represented by your respective trade association facilitating a transition to a clean energy future? And we can start with Amy.
Great, thank you, Teresa. And just good afternoon, everyone. I am on the East Coast, so it's good afternoon. And thank you to the Northwest Gas Association for inviting me to join you. For those I have not yet had the chance to meet, my name is Amy Andrzak, and I'm the president and CEO of the Interstate Natural Gas Association of America, or INGA for short, as well as president of its foundation. INGA represents the U.S. natural gas transmission pipeline industry, operating approximately 200,000 miles of interstate pipeline that serves as an indispensable link between natural gas producers and consumers. It is a defining time period in the natural gas industry as the conversation around natural gas shifts and the new administration moves forward with new priorities and goals. Our role advocating on behalf of natural gas and its infrastructure has never been more important. And this is what INGA works hard to do. We promote the significant role natural gas infrastructure plays in our nation's economy and energy landscape as we move forward towards a low carbon future. INGA members recognize that climate change is a critical issue and that our sector has a role to play in addressing it. Approximately 1/3 of U.S. energy consumption travels through natural gas infrastructure. This natural gas is clean, largely domestically produced, and serves as a critical foundation to the further use of renewable energy. And it's because of this that natural gas is essential to the clean energy future and achieving our national and global climate aspirations. As the U.S. continues to move towards the greater adoption of renewable forms of electricity, there is an increased need for natural gas and related infrastructure to enable flexible, on-demand power generation and energy storage that is necessary to ensure electric reliability. In 2020, natural gas accounted for approximately 40% of the total U.S. electricity generation, while renewable energy sources made up about 20%. Also, 19% of electricity generation is still being provided by coal. So there's a lot of opportunity for displacement of coal and in turn, CO2 reductions. Additionally, our nation's pipelines make up a vast transportation network. There may be opportunities to transport alternative fuels through that network if demand for those fuels grows in future decades. The natural gas transmission industry is also committed to minimizing its impact on the environment by reducing GHG emissions across operations. In January, INGA's members released a set of climate change commitments that outline our mission to help address climate change. We've been working for years to reduce our methane emissions, and with our climate statement, we went a step further by committing to identifying steps and working together as an industry to achieve net zero GHG emissions from natural gas transmission and storage by 2050. Additionally, many INGA members participate in voluntary programs and initiatives like the EPA Methane Challenge Program, One Future Coalition, focused on minimizing methane emissions, communication and collaboration across the natural gas value chain, and driving new and innovative technologies and processes. it is clear that natural gas pipelines, and related infrastructure are all part of the solution to achieving our nation's climate and economic aspirations as we work towards a lower carbon economy. The natural gas industry also plays an invaluable role in helping President Biden achieve his commitment to good-paying jobs. Between 2016 and 2019, the United States natural gas industry grew by almost 5%, creating more than 28,000 new jobs in just 4 years. Natural gas industry workers earn a median hourly wage, which is approximately 59% higher than the national average. So as the natural gas industry works to contribute to our national and global climate goals, as well as national jobs goals, we will continue to advocate for a fair, balanced, and predictable permitting process while promoting regulations that enhance pipeline safety and reliability, minimize methane emissions, and ensure the productive use of operators' resources. INGA and its members look forward to furthering this mission and playing an integral role shaping our nation's clean energy future. Thanks, Teresa.
Amy. Marty, same question.
Well, thank you, Teresa. I appreciate you being here. I not only want to for the invitation to be part of this panel today, but let me also thank the sponsors of the conference, all the member companies of both Northwest Gas Association and the Alliance, and also special thanks to all of the chambers in the region there, state, local chambers that we partner with on an ongoing basis across all of our issues. Of course, the U.S. Chamber represents all segments of the business community, which means that in this space, we represent all parts of the value chain for natural gas. We've got natural gas producers. We've got some of Amy's members on the pipeline side, some of Karen's members on the LDC side, but also manufacturers and users of natural gas in the petrochemical space and elsewhere in manufacturing. So we bring a very broad view of how to support natural gas. Because I should be quick to point out that because we represent the entire business sector, we also represent some competitors of natural gas and other fuel sources, or others that are simply focused more on moving toward different types of power. But even with that, we've staked out a very clear position that natural gas is critical to developing a clean energy future. Amy laid out much of that on how natural gas, not only is critical to clean energy future, it is enabling a clean energy future by being there as a backup source. In fact, it's far more than a backup source now. I say it's not a bridge, it's a foundation. As far as the overall economy, and we wouldn't be able to bring in as much renewable power into the system now if you didn't have natural gas backing them up. So I think those are important things that just focus on the fact that natural gas is both a clean, reliable, and affordable source that will facilitate greater use, and also helps us meet global needs as energy demand is going to accelerate around the world. And I'm sure we'll get into more of that later. But what I did want to do is take a detour for a minute and give a little bit of a description of the evolution of the chamber and our members and our approach to the overall climate, sustainability, and environment direction out there. This is an area where the chamber, of course, as all the other associations, we're member organizations, and our members help determine where it is we're going. Well, I think we've seen over the last many years. You all are living this as well. The pressures that are out there, the external pressures on companies to do more, however you want to define that, on sustainability and on climate. And those pressures are coming from institutional investors, from shareholders, from your own workforce, from the public, and of course your supply chains as well. So as part of that, the chamber, working with its membership, we have a task force on climate action, which again, not just talking to our energy companies and our industrial companies, but we brought in the entire membership from financial services, insurance, transportation, you name it. And so as you can imagine, trying to find consensus among such a broad group isn't always the easiest thing to do, but we have succeeded in staying focused on the fact that what we need What we can get behind and support are market-based approaches to decreasing emissions across the entire economy. Now that means a lot of different things to a lot of different people. I can tell you that some of our member companies thought we went too far in saying that. Many others thought we didn't go far enough and wanted to hear us specifically cite support for a price on carbon or specific targets and timelines that many companies and of course countries and others are establishing. And of course, President Biden recently set a goal for the United States to have to cut emissions in half by 2030. Our view is that regardless of what target you set, so whether or not we can meet that 2030 target or a 2035 zero in power generation or a 2050 net zero, I don't want to stand here and say we won't be able to meet them. What I can say is there's no chance we're going to meet them if we don't have the technology, the policies, and the market signals in place that allow us to get there, which kind of brings us full circle back around to we're not going to get there if we don't have natural gas as part of the equation. So I'll just kind of come back very quickly to say that we in working with our partners, with Amy and Karen and many others and other associations, there's a lot of effort out there to help promote and defend natural gas. And we've put together an effort called Natural Gas Natural Advantage that does seek to use some of the unique features of the chamber to be able to convene at both the national and the local level, and to use that network of state and local chambers to focus on the economic, environmental, and national security benefits that natural gas brings to us. So again, I think it's not an effort where we're trying to boil the ocean on our own. We know we can't. We need to be working in concert with everyone out there, individual companies, chambers, associations at the state and national level. And I think that's what's going to help us moving forward. So there's the long but quick answer to your question, Teresa.
Thank you. It does seem to me like it's going to take a team effort. Tim, would you like to talk about how you facilitating it towards a clean energy future?
Sure. Thank you, Teresa, and thank you to the association for the opportunity to join you. I'm interrupting this American broadcast with a bit of a Canadian perspective, but it's going to sound very familiar because the messages are very much the same. My message is the same as Amy's and Marty's. I mean, I guess the quick snapshot on the CGA. We're the American Gas Association of Canada. We represent the downstream, the utilities, and all the service companies associated. We actually do have a certain overlap with some of Amy's membership on the Canadian side as well, because we have some pipeline members as well. About 7.25 million Canadians are using natural gas in their homes. It's roughly half the homes in the country. We meet 35% of the energy needs of the country, and that's growing very quickly. We're approaching 40% in the next 15 years. So we'll become the largest end-use source of energy in the country. And we've got about 500,000 kilometers of pipes, and I'll translate that at roughly 350,000 miles of pipes across the country. So that's transmission and distribution lines moving natural gas. And it's overwhelmingly Canadian natural gas, although we do bring US gas in certain markets where there's good movement back and forth, because we've got an extraordinarily integrated gas system across the continent. That's one point I want to make for your audience, is that the integration of the gas system is really a wonderful North American achievement, and it contributes to the economic well-being of each of our regions, because we take advantage of one another's resources at various times. Specific answer to your question, though, Teresa, I'll say three things. Natural gas contributes to a clean energy future by, one, being clean in its own right. We often forget the fact that natural gas is an extraordinarily clean burning fuel in its own right, and has contributed significantly to reduced emissions by its expanded use across Canada and the US. Two, it's a partner for renewables, as my colleagues have mentioned. We're in the middle of a heat wave here in central Canada, and there's lots of wind and solar on the electric system. But if you look at the power flows, the gas generators are being used to an extraordinary degree, because the wind and solar aren't delivering in these temperature extremes. And it speaks to the value proposition of gas in that partnership with renewables. And I think people often forget that. And third, I mentioned that we're on the distribution side of the value chain, pathway for other fuels. So the gaseous delivery system, and increasingly that's the language we use, the gaseous delivery system, because we're moving renewable natural gas. That picture behind me used to be described as a scene of the Canadian boreal forest. I now call it a renewable natural gas reservoir. Renewable natural gas is an increasing part of the energy mix in the country. And of course, we're also a pathway for hydrogen, which is, the fuel du jour. And I was listening to some of the earlier sessions and there was lots of talk of hydrogen. So what we have is an energy delivery system, which is adaptable for a variety of purposes. And I'd say the biggest threat in the clean energy is the assumption that you're only going to choose one energy pathway in order to achieve your goals. And we think that that's a very dangerous approach. We've got a great pathway with the gas distribution system we have. And part of how we're emphasizing that pathway is by a focus on innovation. And I guess that's the last sort of substantive point I'll leave with you, Teresa. I think the industry as a whole needs to continue to demonstrate its commitment to innovation. We've been innovation leaders for decades and decades. At CGA, we've made it a new priority again. We've started a natural gas innovation fund, and we've invested in dozens and dozens of new technology startups that are delivering energy efficiency, that are delivering carbon capture technologies, that are helping develop alternative fuels, that are bringing new technologies to the fore. And I think we need to continue to emphasize that to show that we're part of the solution going forward. Final point, our customers, they care about three things. First and foremost, and it's always their most significant concern, is affordability. And we have the most affordable fuel option out there. And we have to continue to emphasize that fact, because in the face of the policy frameworks that are emerging, electricity prices are rising much faster than natural gas prices and gas delivery prices. So we have a core advantage there. Second, reliability. I don't need to talk to you about reliability. You had a significant incident in the US. I'm sure Karen will touch on that one. But it underscored the value proposition of the gas delivery system and its reliability, its resiliency in the face of weather events. And then third, our continued emphasis on environmental performance. And it brings me back to that innovation point and how we can lead going forward. So with that, I'll turn it over to Karen.
Okay. Thank you, Tim. Go ahead, Karen.
Thanks, Teresa, and thank you to the Northwest Gas Association for the invitation. I just want to give a shout out to the title of this conference, Embracing the Clean Energy Future with Natural Gas. We do embrace it. The entire industry from wellhead to burner tip, we're all in on reducing emissions, and I'll talk about how we're doing that and the progress we're making in just a minute. But I think it's important for everybody to know that right now 180 million Americans are using natural gas in their homes. We heat over half of homes in the United States, and we support 6 million businesses. So we are a significant part of the economic and energy foundation of this country. And we're growing. We're adding a customer every minute of every day. So remember, I'm on the consumer end. So I'm the one, our members are the ones that are getting the gas from Amy into homes and businesses, into industrial facilities, and some of Marty's members, and sometimes even Tim's members. We are improving our pipeline system. We either improve or add 50 miles of pipe a day. So those that want to write the obituary of natural gas don't really look at the facts and figures. We are putting our money where our mouth is. We're investing $91 million to improve the safety and tighten up our systems every day. And that means not only can we continue to deliver it safely, including through weather events, like Tim mentioned, I'll get to that at some point. But we're also investing $4 million in energy efficiency every day. So that $95 million that we're investing every day is making the system safer, more reliable, tighter, and lowering our emissions. And we can't forget that we do support a lot of jobs, as Amy pointed out. Over 4 million jobs are attributed to this industry, and about 83% of those are local. So the communities in which we serve are really important to us because that's where our labor is. And you don't want to do anything bad to your neighbor. So we take our responsibility seriously to be safe and to help our customers, our communities, reduce their emissions. So right now, if we look at the emissions picture of the United States, greenhouse gas emissions are at 27-year lows. And we have a big part that we have played in that, but we're going to do more. We are, as people have pointed out, a great partner to renewables, which is a growing source of electricity. We're backing that up when necessary. The investments we've made in energy efficiency, and of course, the switching from coal to gas. So over the last 20 years, we've added about 12.5 million customers to our system, but demand has remained flat. And it's not because they're using less or demanding less, it's because we're becoming more and more efficient. And we're investing in that energy efficiency. And we're demonstrating it to Wall Street about how we are improving our system. And we're reporting on our own emissions. The ESG phenomenon is not new to our industry. We have uniform reporting mechanisms that we share with analysts, with the Wall Street, with stakeholders, shareholders, because we want people to know that we're all in. And we see ourselves as a solutions provider for a clean energy future, a partner in that clean energy future. And we've made significant commitments. And I know we'll talk about how different parts of the country might be different. You know, Oregon and Washington might be different than Mississippi and Alabama, but that doesn't mean that there's any less of a commitment to continue to be part of that clean energy future, enable it, if you will, and invest in it and innovate. Thanks, Teresa. Oh, but you're on mute.
Thank you. Thanks, Karen. Amy, there seems to be agreement on this panel that natural gas is part of the clean energy future. What resistance or impediments are you seeing to that from the federal government or federal policymakers?
Great, thanks for that. As I mentioned in my opening remarks, to achieve a clean energy future, we must work together with policymakers to establish constructive energy policy that will continue to utilize the unique advantages of natural gas and support a robust energy delivery system for all Americans. Now, on the campaign trail, President Biden acknowledged the importance of natural gas, so I remain optimistic that throughout his time in office, new natural gas infrastructure project improvements will be able to continue. But what I think we're seeing is a lack of understanding from policymakers on how natural gas and its infrastructure can be part of the solution for a more decarbonized energy future. The problem with this is that if as a policymaker, if you don't appreciate that natural gas will be a vital part of the energy generation for the next 20 to 30 years, which I'm fairly confident my fellow panelists would agree, if you don't believe that, then you don't believe there is the need to continue to invest in pipeline infrastructure. And, for example, FERC's recent orders really undermine well-established precedent and create significant uncertainty regarding the standards FERC will use to evaluate proposed natural gas pipeline projects, as well as FERC's timeline for evaluating proposals. Now, developers who may commit tens of millions of dollars to a project before ever filing their FERC application, they need that regulatory certainty to continue investing in needed infrastructure. On the congressional side, we've seen legislation introduced which would potentially make it more difficult to construct pipelines, with legislation to limit the use of eminent domain. Now, eminent domain for interstate natural gas pipelines dates back to the Natural Gas Act of 1938, when it was determined that natural gas pipelines serve the public interest. Section 7 of the Natural Gas Act authorizes FERC to issue certificates of public convenience and necessity for interstate natural gas pipeline projects. Once issued, that certificate provides the project developer with the right to use eminent domain along the pipeline route. This is critical for building additional pipeline infrastructure. And keeping that system, what is work to develop our current infrastructure system in place, is vitally important. But I will just say that regardless of the administration in the White House or the majority in the House or Senate, INGA is committed to advancing safe, reliable, environmentally responsible, and affordable natural gas transportation through predictable and legally sustainable permitting processes and regulatory requirements. And we look forward to continuing to engage with the administration, regulators, and lawmakers from both parties to find efficient, practical solutions that will both protect the environment while also ensuring continued investment in critical natural gas infrastructure.
Thank you, Amy. Karen, can you give us some insights into the regional differences and varying perspectives influence policy? We'd like to know what investors, regulators, customers are saying about natural gas and how their plans to use it. And if you could give us some regional perspective on that.
Thanks, Teresa. Would be delighted to. You know, we are 50 states. And as Tim would agree, in the provinces, there are different ambitions and resources depending on the state or the province. And energy policy reflects that. I mean, for so long, energy policy has been a regional issue, not a political issue, because it was based on what's on the ground and what resources are available and the economic condition of the states. So as I look across the 50 states, you know, we're seeing different commitments in terms of greenhouse gas reductions, different ways to do that, different policy levers. But at the end of the day, 180 million Americans are using natural gas, and you can't flip a switch to change that within a reasonable time frame at a reasonable cost. And as my panelists have pointed out, our delivery system, I love Tim's gaseous energy delivery system, although it's kind of a mouthful for us Americans. We are a delivery system of solutions. The solution today is very affordable, clean natural gas that is allowing us to reduce our emissions. But we can and will deliver renewable natural gas. I know in the state of Oregon and Washington, they've got great programs and projects underway to deliver, you know, to resolve the agricultural waste problem and turn it into an energy solution that's carbon negative. Will that work out as well in a different part of the country? Maybe not. So they are regional differences. And the Pacific Northwest, where you all are, you've got a lot of hydro as well, which is a solution for you. But you still have this very valuable, 750,000 miles, I think, of pipeline there that can deliver today's solutions and tomorrow's innovations. In a place like Texas, which is very different, it has, you know, it's one of the largest producing states, but also has the most amount of wind. And why is that? It's because our natural gas system is backing that up. And in the weather event of February of this year, what worked and what didn't work? Well, the natural gas industry delivered. Now that may surprise you because you're reading headlines, but for anyone that had signed up for natural gas to heat their home, cook their food, heat their water, turn on their fireplace, they had gas. We have that underground delivery system that is resilient. And I think that's very important. That's a value that we really need to be tuned into as we talk about the clean energy transition, is how do we use existing paid for valuable infrastructure going forward? And we're all in on that, right? There's opportunities, whether it's in the Northeast. Now, the Northeast uses a lot of heating oil to heat their homes. That certainly is not as clean as natural gas. And they import natural gas from all around the world, including Russia, rather than getting it from next door. We think that that probably makes more sense to have a 100-mile pipeline than a 100,000-mile LNG tanker tour. So as we look going forward, there are regional differences and there are different solutions. But at the end of the day, the common denominator is use clean, affordable. Affordable is still important. We have a long way to get out of this economic hole that the pandemic has put us into, and helping families continue to afford their bills. We are that other part of the stool on the environment and energy. We always talk about the 3 E's. Well, the miracle of natural gas is we address all of those 3 legs of that stool: energy, the environment, and the economy. And that's whether it's the Pacific Northwest, which has different challenges, different policies, different ambitions, to a place like Oklahoma. The end result and the common denominator is us.
So do you see opposition being different in different regions, opposition to using natural gas?
So I think the opposition is an interesting thing to dissect a little bit. What is the motivation for the opposition? If the motivation is we want to reduce emissions, we're all in and we're doing it and we're proving it. If the opposition is because, you know what, I just don't like you, well, then you haven't taken the time to understand the facts quite as well as we'd like you to, because we're proving it in every single day that we can reduce emissions. We just stood up a 5-year, $125 million program to really take a deeper dive in technology on hydrogen. Europe's a little bit ahead of us. We certainly know that, but we have the ability to have the most prevalent source of energy, hydrogen, come through our systems. So the opposition, I think, needs to take some time to get informed, and we want to be a partner to those emissions reductions goals. We're not opposed to it. We're not the problem. We are the solution. And we have seen now 16 states pass legislation that says, no, we want to preserve natural gas. 3 more bills are sitting on governors' desks. 4 more are working through the state legislatures. So there you have 23 states, that's almost half of the country, that said, we're in favor of natural gas. And when you poll natural gas, it's in excess of 70% approval rating of natural gas. I think any politician would like to have that approval rating. We're popular, we're affordable, we're cleaning up the system, we're helping our customers reduce their emissions, and we're helping the country meet its goals. It's hard to be against that. So we're really taking our time to get out into our communities, talking with our customers, ensuring that they understand that we're all in.
Tim, Canada is a federation like the US with constitutional authority for energy split between federal and provincial governments. Your federal government has been advancing an aggressive environmental agenda along the lines of President Biden's agenda for several years now. How is this playing out with your provinces, and how is the industry responding to it?
Teresa, Karen kind of answered a bit of my question, making the point about the different dynamics that exist state to state. It's very similar on the Canadian side. As you noted, there's a division on energy. Provinces have the larger portion of responsibility for energy matters in our country, then does the federal government. But the federal government has a frankly still evolving constitutional authority around environment. I say still evolving because when our Constitution was drafted in the division of powers, environment wasn't a title. And so it's playing out in a variety of ways in the courts and elsewhere how it's managed. But the current reality is that the environmental issue is the highest profile public issue, and it's an issue on which our current government positions itself very, very aggressively. They were elected, they're in their second term. They're now in a minority government. They had a majority government in the first term. As you know, we have a parliamentary system, so we have this idea of minority governments, which means government is somewhat more dependent on opposition politicians than it might otherwise be. But it also means you're always just sort of waiting for the next election around the corner. And we think we've probably got one in a few months. And the positioning on environmental issues around that is very, very significant right now. So you're seeing a lot of jockeying on it. If I can give any advice, as you now are hearing things from Mr. Biden that we've been hearing from Mr. Trudeau for 5 years, I'd say stay the course in the value proposition. And Karen just articulated it extremely well. The core values that we're delivering on as energy companies are values that are fundamental to the well-being of our society. I don't think we should shirk from them. We're leaders on delivering on emission reductions. We're leaders on a host of other environmental challenges. We're also leaders insofar as the economic contribution of an affordable, reliable energy system is profound. And it's why people want to come to our countries from around the world. It's why our economies grow through difficult times, because we have the fundamentals, and those fundamentals come down to the energy system. So I'd say, 5 years of tough slogging has said to me, don't shirk, stand up for the core values you have, but continue to constantly innovate, continue to constantly drive to show how you can get better still, you can do more still. I guess the last point I'd raise on this, and it goes to a question that I see that has just popped up about Keystone. Pipelines are also front and center, quite apart from natural gas per se. Pipelines are front and center, and Amy is probably more central to this one in the U.S. than I am in Canada. But the opposition to pipelines has been a tactic used by those opposed to our industry. And I think, like I said on other issues, we should not shirk from defending the value proposition of pipelines and what they bring. And I think we just have to get better at articulating that value proposition, be it about affordability, be it about reliability, be it about environmental performance. And I love the state-to-state engagement that Karen and her members have been doing on this. We're doing the same thing in Canada, province by province. We shouldn't assume when people say the opposition is local that it's not sophisticated and coordinated. It is. And we should similarly be coordinating our efforts in an effort to respond to it, because I think we're on the side of customers, and ultimately it's customers who are at risk by some of the challenges that are being put forward.
Thanks, Tim. I'm going to shift over to Marty with a different type of question. Then we can go back and talk about some more policy if you'd like later with some of the other questions that I'm seeing come up. But Marty, in looking at the aggressive global goal of net zero by 2050, how do you see the current U.S. standing worldwide? How well are we doing? And what are the challenges that are holding us back, if there are any?
It's a great question, Teresa. And it really, in some ways, it comes down to perception versus reality. And I'm kind of building on some of the great themes that my colleagues have put out here on part of innovation and outcomes. We really want to focus on what's the outcome we're all looking for. We want to be able to meet growing global energy demand with fewer emissions. How do we get there? And I think the United States has actually shown the model of how to do it. You know, more than any other country, we've been able to reduce greenhouse gas emissions here in the United States more than any other country in the world. It's because of natural gas, because of the role that it plays in power generation. But take one step back from that, it's because of the entrepreneurial spirit and the risk taking that goes on. It's the market-based approach here that allowed for, again, risk takers in the oil and gas industry that got out there and put horizontal drilling together with hydraulic fracturing. Nobody 12, 15 years ago was predicting that we'd be producing as much natural gas as we are here today. And natural gas became a total disruptor to the power generation industry, to that whole sector. And we've seen how that's played out. As Amy pointed out, we're producing more electricity with natural gas than any other fuel. And again, at prices no one could even have imagined, at the time. At the same time, we've got to be humble enough to know that, if we continue to focus, if this is the model we want to use, as I mentioned before, we need to make sure we have technology, policy, and market signals. This free enterprise market-based system is what gets us there. Then, it could be that something else is going to come along. And Karen and Tim and others, they've already pointed out the innovations that are taking place in this industry for other gaseous energies or what have you, other solutions that are out there. I mean, I love the today's solutions and tomorrow's innovations. But back to your question a little more directly, the world, or at least if you read the headlines, you'd think that we're way behind. Everyone else is so far ahead of us, and it's simply not true. And I think that we, as not only the industry, but our customers, businesses here, and frankly, elected officials have to be a little more unapologetic about saying, hey, wait a minute, we've actually figured out ways to make this happen and to effectively move toward that overall objective, that overall outcome of meeting energy demand affordably. If we really want to look at this as a global challenge, and it is, then the answer is we have to have the developing world able to implement technologies at scale and at cost, and affordably. They're not going, they are going to put energy in place to meet the needs of their constituents. If we as the United States and Canada can come up with the technologies and the innovations that allows them to do that at scale and affordably, then now we're all in the same game. We're moving toward toward what the outcome is we're looking for. And by the way, in doing all of that, the U.S. companies, North American companies, stand to maintain their leadership role in technology and exports and competitiveness. So I do believe, and just to be blunt, and the previous administration, I think, did end up there was a cost to looking like we didn't need. The perception was we don't need to do anything, and we don't want to play with our allies overseas. And we saw things like LNG contracts canceled going to Europe because of the perception that we weren't producing it cleanly here. Not true, but that was the perception. I think as we've now seen an industry willing to take serious steps voluntarily, industry, both I can tell you from the U.S. Chamber, from API and others that are willing to now say, yes, let's go ahead and look at how can we effectively and directly address methane emissions, regulate methane emissions. we are now going to be in a position to make sure that the U.S. is providing this critical resource to the developing world as they are going to have to meet growing energy demand in their own countries.
So Marty, from a worldwide perspective, the role that the U.S. fills, how important is it to our national gas production in regards to the LNG exports in developing countries? And who would feel that need if the U.S. is not growing production and infrastructure?
So again, another great question. And the fact is, we are, because of our ability to produce cleanly, safely, responsibly, and more than any other country in the world, we're positioned with the export facilities we already have and those that are going to be built to be the world's leader in providing a clean resource to this developing world. I will, divert for just a moment here to say, if anybody's been watching the news and seeing where you've got activists that are believe they're scoring victories against the oil and gas industry by getting members on the board of one company, of a court decision in Europe that's forcing another company to reduce emissions further, and shareholder resolutions that are continuing to push the industry. And these are all, these are enormous companies, like they're called the super majors, and that's for a reason. The fact is, though, you take all the super majors, they only produce 15% of the crude oil for the entire world. If those companies start investing less and producing less, it's not like the demand goes away. The demand is still there, and it will now be filled by national oil companies from other countries. Again, that's at least one of the unintended consequences, where it may not be produced in as environmentally responsible way. So you may get some of our companies to restrict or become smaller, if you will. But that just means that the national oil companies, the demand goes somewhere else, which means the emissions go somewhere else as well. So back to the LNG, that's why it's so important, and we need to keep our focus on allowing the U.S. to continue to provide that critical resource to our allies and friends and others around the world. We know energy demand is going to accelerate, especially China, India, Southeast Asia, other areas of the world. And if not the U.S., it will be Qatar, Russia, and others that fill that gap.
Thank you, Marty. I wanted to ask this question generally to the panel. What innovations or technologies are gas utilities most excited about? And do you see the natural gas utilities positioning themselves to be part of a much lower carbon future?
Unequivocally, yes. I mentioned a few of the technologies, renewable natural gas, hydrogen, but there are so many. Every other year, AGA hosts an exhibition. Unfortunately, we didn't get to do that last year. We're doing it this year. We're doing it in person. Come one, come all. It's in October. But we're already oversubscribed with exhibitors because of the cool technologies, drones, artificial intelligence. We've got trucks that have sniffers on the front that are going down every American street to sniff out methane and deploy technology to tighten up the systems. So it ranges everything. I mean, we now have smart pipes, right? I mean, you've got sensors in there that somebody all the way across the country can be watching remote work. We're getting familiar with that, and can shut something down. And so the folks that want to say this is the fuel of yesterday or the utility, your grandfather's utility, just don't simply understand the significant investments in innovation. And frankly, we're not done yet, right? I mean, just because we know we can use RNG, because we know we can use hydrogen, because we're making our pipes safer, we're going to continue to innovate, partner with the government, partner with national labs, partner with our colleagues in the electric utility industry as well, to continue to help the entire energy chain reduce emissions. So as we just finished, all the quarterly earnings calls. My members fielded all kinds of questions, but it was fascinating for the analysts and the buy side and the sell side to hear about the innovation agenda. So they feel positive, upbeat, and they're rewarding it with capital.
Teresa, in some respects, we're victims of our own success, right? I remember having a conversation with a politician one time who said, Tim, I've got problems. Gas isn't a problem. Why are you meeting with me? He said, you work, you're affordable, you're reliable, like you're wasting my time by being here. And I said, well, I think we can help you with some of your other problems. And that's how I kept the conversation going. But now we have some politicians who might feel a little bit differently. But I think to Karen's point, it's incumbent on us to show them the kind of innovation that's going on that can help address the things that they say are challenges. And in addition to some of the technologies Karen has mentioned, I think of them as sort of upstream, midstream, and downstream technologies, right? On the upstream, we have technologies around methane recovery. We have technologies around the sort of drone technology that Karen was talking about. We have a host of things on carbon capture and sequestration technologies that are coming forward. On midstream, some of the smart pigging technologies, some of the new pipe technologies, a whole host of things. Downstream, AGA and CGA are working together on gas heat pump technology, which amongst other things would dramatically reduce the amount of natural gas a home might consume, but by allowing it to consume it much more efficiently, integrating your hot water tank with your furnace and possibly with your air conditioner, actually taking market share from the electrics potentially on what's going on. So some very, very cool things going on that are very exciting that we think are cutting edge, but we do have to get better at advertising them, because as Karen noted, some people do still think it's your grandfather's utility, if you will, and we're not.
I'm really happy to hear that there is continued progress with natural gas. For some reason, I think out in the world, people think that no one's really focusing on keeping that infrastructure modern and efficient, since we're all focusing more on the renewable side. So I'm happy to hear that that's still a big focus. I do have, is it time for questions and answers? I'm looking at the time. I'm not sure how much more time we have. Dan, are we out of time? Let's continue. So I do have a question from the audience. What does the Keystone XL experience augur for natural gas infrastructure?
Well, maybe I'll go first on that because I'm the Canadian, and
okay.
it's TC Energy. One of my members, I know it's one of Amy's members as well, but one of my members in a terrific Canadian company. Keystone's an oil pipeline, of course, but we were very disappointed by the decision of President Biden when he was elected not to allow it to go forward. And of course, you saw the decision yesterday from the company after really.
Needless to say, investors can't sustain the roller coaster of continued uncertainty on this, and that's a great loss.
It's a great loss for Canadians, great loss for Americans, workers, and citizens who are energy consumers. What does it mean for nat gas infrastructure? Well, look, there are a bunch of activists who are very happy about this decision, and they're very loud right now. And I think we should all take note of that. And as I said earlier, I think that we should be prepared to be much more aggressive in our response to them. And that means articulating more clearly just what the value proposition is of the infrastructure we have. We're a very polite industry. And when there's a severe weather event, invariably the energy system that's hit hardest is the electric system. And what do? We run to the assistance of the electric system. We work with them because we're all concerned about meeting the needs of energy customers. But the natural gas system just isn't as susceptible to weather events as the electric system is. It's delivering much more of the time. Maybe citizens need to have a better understanding of that. Maybe we need to speak to that much more clearly. There are a number of things like that I think the cancellation of Keystone draws into focus, and we need to start thinking about as an industry and speaking to.
What's going to happen to the pipeline if nothing's restarted? Is it just going to sit there?
Well, look, they'll try to repurpose whatever portion of the assets they can in various ways. It's in segments, as you know. There are parts in the U.S., there are parts in Canada, parts that are built, there are parts that are in process. The company will manage those assets as it sees best and in the interest of its shareholders. But the bigger issue is, as I say, just the lost opportunity of having the whole thing completed.
Teresa, maybe I'll jump in on this.
Okay, go ahead.
We have to have a much more complete conversation about energy infrastructure, because the energy demand is not going away. All of a sudden, we're not going to stop using energy, or we're not going to considerably use a ton less. And so if you're going to replace the natural gas system, you have to replace it with something. And to take away our system, you would need 3 times the amount of infrastructure to deliver the same amount of energy. So if you can't build a pipeline, do you think we're going to be able to build all these transmission lines all over the country? I don't think so. We've got one that's already bought and paid for and invisible and underground. So that infrastructure has a huge value to deliver, as I said earlier, today's energy and tomorrow's innovation. To think that we're not going to have opposition to putting transmission lines and distribution lines to communities all over the country to deliver more energy is just fallacy. If you're opposed to, it's not that you're opposed to a pipeline. If you're opposed to energy infrastructure, then we'll never have the type of transition that we're looking for if we had to build it all on the electric side. We can't afford it, and people won't tolerate it, and the communities won't want it. And therefore, we've actually set back the transition rather than accepting today and improving. If you want to eliminate it, you're going to retard progress.
Thanks, Karen. Amy, how will consumers react to the notion of decarbonizing the energy delivered through the pipes, though it may be more costly than conventional natural gas?
So in some respects, I think the consumer question, Karen is probably better able to answer truly than I am, just because her members deal more directly with the consumer. So I'm gonna turn it back to her for that specifically. But I just wanted to add one thing on our last point, which I think is really important, that all of the net zero projections that are out there currently, that many of our member companies have made commitments on or striving to reach. But right now, all those projections rely really on things that are not yet built. However, in the case of natural gas infrastructure, it already exists. And I think that's really an important point. And I think it's something, it's very important to keep in mind that there still needs to be a lot of research around moving alternative fuels through natural gas infrastructure. There's still a lot of work that needs to be done. There's still technological advancements that need to happen. And there will eventually need to be regulatory changes that will also need to take place before we can get there. But I wanted to just point out, it's another example of how I think all of our member companies are part of the solution, because we already have a lot of the infrastructure that will be needed to go to that next level. But I'm going to pause there and let Karen answer more on sort of the consumer response.
Yeah, thanks, Amy. And I'll get quite granular about it. We've been looking at what would it take to electrify fill in the blank. And I'm going to use Columbus, Ohio as just an example, because that's one that we recently completed. If you wanted to electrify everything, replace all of the natural gas in Columbus, Ohio, that would cost about $7.5 billion, which when you translate that out and who bears the cost, the average home, if it was a new home, the energy bill for that home would go up $440. And if it was an older home that had to be retrofitted, it would be $630. So that's not insignificant money. And that's every year that they could be using for education, for medicine, for whatever else. But that $7.4 billion to do that would only result in an 8% reduction in emissions. And so we're talking about inordinate costs for not significant environmental gains. And so I think we, and policymakers have to get a lot more creative and innovative in our solutions, rather than just saying, here's the single shot. If we electrify everything, everything's going to be great. The reality is that's not the case, and somebody pays the cost, and it ultimately is the consumer. So, we want to be thoughtful about how we approach the transition, and we are a viable solution today. And consumers, poll after poll after poll, show that they are not willing to pay extreme amounts of money for this transition. They think it should be free, in fact, and nothing's free, as we know. But we have to be able to do this in a way that is practical, pragmatic, and achievable, and actually has demonstrable results. And I think we've shown that by using our systems, we are an essential part of the clean energy transition. And we don't have to do it on the back of consumers or taxpayers. I think we've gotten to a place, at least in the United States, I won't speak for Tim, that we think, well, just government's going to pay for it. Well, the energy industry is the private sector. You're not going to have government come in and pay us or pay for a transition. It's on the back of the free enterprise system. And so it has to work. And so Columbus, Ohio shows you right there that there's significant cost associated with little gain. And oh, by the way, those industries that were in Columbus, Ohio, that depend on affordable energy and natural gas, they leave. I mean, we looked at the hospital industry and there would be a 24% shrinkage in the hospital industry in Columbus, Ohio. I don't think that's the outcome that people in Ohio would like to see.
So how can we better educate? Oh, go ahead, Tim.
Well, I was just going to say, because Karen, I'll just underscore the point, because it's the very same thing. We've done the same kind of analysis. We're doing it presently, province by province, on the inordinate costing that are represented by some of the things people are suggesting. And it gets, the numbers just get kind of silly. We're not just talking about thousands of dollars per homeowner in increased electricity, in increased energy bills, which in this case would be electricity bills if they were to go off natural gas. But the cost for business across the country are profound. And to Karen's point, businesses will leave. And in our case, they'll leave and they'll go to your country, which, I love the United States of America, not a big fan of some of your hockey teams, but love the country. But you know what? We don't want to lose businesses to you. We want to be competing with you. And so we don't want that to happen. And I think it goes to a point which is, if I may, is a bit controversial, but I think we have to say it. And I was thinking about it earlier in the day in the session. We're all talking about net zero by 2050. But how many times have you seen somebody, when they talk about net zero by 2050, talk about how much it's going to cost? And if we don't start telling people how much this is going to cost, people will blithely go along thinking, okay, this is doable, let's do it. And I think for a more realistic conversation on whether it's achievable, you need to talk about how much it's likely to cost. And I think that's something that, again, we all need to do as industry representatives.
Yeah. I just to say, I think you and Karen have really hit an important point here on how we have to tell the story. So the data to be able to say this is what it will cost in a particular area. I do think they'll get into it. One of the other questions about the consumer, how they will see it. Unfortunately, these are areas where if you look at polling, I know how you ask the questions and what have you, but it's like not only do they think it should be free, they think it will be free. And so. But we've got to be able to tell the story in a way that we're not telling them they're idiots, right? We've got to be able to say, this is the outcome we're all looking for, right? We all want to be able to have reliable, affordable energy, and you'll be cleaner as we go forward. Now, here are the realities. I can say net zero by whatever date. This is what it will cost given the current constraints. And this is what it will mean to you, to your local community. This is what. So there is a tone in here that I think we've got to be. We've got to be cognizant of, and we want to make sure we're getting the point out. But I mean, again, Karen and Tim and Amy have done a great job of saying this is an industry that's ready to be part of the solution. They already are part of the solution. But how do we get that across in a way that it's like asking? We were talking about the infrastructure debate in Washington. Well, how do we want to pay for it? Well, we'll just raise taxes on corporations, right? Oh, okay, I'm for that. Because that doesn't cost me anything, right? Anyhow.
So that was a question that came in. How can we better educate the general population, on this? And where are we missing that? We're not doing a very good job at that.
Well, again, I think Tim and Karen hit a lot on the what needs to get across. We do need more work on the how and the who. And everyone who's listening to this is a messenger to be able to get these across to your family, to your local community, to your businesses, your local chambers. They need to be the ones that are saying, hey, wait a minute, that's a great idea as far as what the outcome is, but this is what it's going to cost us to do that. And here's what it'll mean to the hospital on the edge of town. Here's what it'll mean to the manufacturing facility in the county. Here's what it's going to mean, fill in the blank.
I have another question from the audience. How are producers responding to the decarbonization movement? Is it a risk?
Well, we're talking about natural gas producers and oil and
Yeah.
natural gas producers generally. I mean, look, you've seen an enormous evolution of I mentioned the super majors earlier, but even all the independent oil and gas companies. They are feeling the same pressures themselves, but they are also making strategic business decisions so that they are successful in the market that exists not only today, but 5, 10, and 20 years from now. So in many cases, you do see some of them supporting a price on carbon, setting out zero emission or net zero goals, not only on their own emissions, but on the emissions that come out of the products that they make. So a lot of significant, serious efforts that are underway. Methane emissions is another area where they've made enormous commitments and willingness to say, yes, let's figure out how to directly regulate methane, because it is a product that we sell.
We have another question from the audience. We have about 10 minutes left, I guess. Do you want to expand on that conversation, or can I go to a different question? I'm going to shift gears then. Are you all in agreement that the newly leased portion of ANWR should be freed for systematic exploration and drilling, and further that the proved deliverable natural gas at per hose should be delivered? That was a long question. Did you guys understand that?
Yes.
Okay.
And the quick answer to the question is yes. Certainly the Prudhoe Bay should continue to produce. It's been critical, a critical supply for the country. ANWR is going to continue to be a tussle back and forth. They did some leasing. The Biden administration now paused those leases. They were limited at the moment, but clearly it's a little bit back to even the Keystone question on why we need to let the environmental reviews move forward, and if it can be done safely, responsibly, then we should allow those to move forward.
And again, if we don't produce it, somebody else will. The demand is not going away. We know for sure it is only going up. So I think it would be really unfortunate and short-sighted if we were to say, you know what, we're not going to produce it here. That would only cede the advantage to Russia, Iran, Qatar, and I could go on and on. Definitely some countries that don't share our values and certainly don't have the same stringent environmental standards for production that we do. So we would be ceding competitive advantage, and we would be probably making emissions go up. And that doesn't sound like a resolution for climate change.
Not at all. I have one final question from the audience. Going back to this, okay, how can the industry groups representing the various value chains better collaborate to advance natural gas and combat the efforts of the other side? I guess the other side meaning, people who don't want natural gas to be in existence, I guess. Who wants to take
Well, I think
that?
the good news is that we are all working together. I mean, I talked to Amy, she's probably tired of hearing from me, right? Tim, you and I talk all the time. Marty, we've known each other forever. And so the entire value chain is talking to one another. But to Tim's point, we need help. We need allies. We need consumer advocates. We have the labor unions with us because these are good paying, labor union jobs. One of the labor unions, the IBEWs, the International Brotherhood of Electric Workers. Well, guess what? They represent 65,000 gas workers, and they're all in on this. The home builders, they want to build homes that they can sell. What kind of homes are those? They're the ones that have high-end gas appliances. And so we need more friends, but importantly, and everybody in this audience too, I think Tim pointed this out earlier, or somebody did, sorry, that you guys are our best ambassadors, the employees and the industry. You're a trusted voice in your community. You don't want just some talking head on TV telling you how good it is. You want your neighbor, you want the person that you see in the grocery store, at church, at the 4th of July barbecue. Our customers can be invaluable ambassadors for the industry. And I just encourage all of you in the audience to think creatively, because we live in the communities in which we serve. Nobody gets up in the morning and says, what can I do bad to my neighbor today, right? And so I really think there's huge opportunity there for our customers, our employees to have a much more, have a bigger part and a louder voice in this debate that we're having. And that we see ourselves as a solution, not the problem.
Amy, did you want to comment on that?
I do. I mean, Karen pretty much covered it. I think the point that we all work together, certainly I would say that is true if you're looking at how we approach, regulatory and legislative advocacy. I think we're very much aligned as an industry on a wide range of topics. And I think that's really useful. It's actually, I've said this a few times, I'm relatively new to my role. It's one of the things that I have been most pleasantly surprised by is actually how closely the energy trades do work together collaboratively. But I also would just, to echo a point made, I think we do need to find, as an industry, we need to find sort of alternative spokespeople and supporters to help us, because these issues have become so polarized that unfortunately, even when we are quite frankly speaking the truth or just trying to educate or using points that are based in science, sometimes those are dismissed depending on the messenger. And so again, in the same way that I think Karen and Marty have offered up that everyone in the audience is a messenger, but I also encourage everyone in the audience to think about when you are kind of hearing maybe a voice that you're like, wow, it sort of surprised me that person was outspoken or that entity was outspoken. Let's find ways to really embrace that. A recent example that I'll use for those in the audience that maybe haven't seen, Columbia University's Center on Global Energy Policy recently did a very interesting report about the need to continue to invest in natural gas pipeline system to support getting to our net zero goals. If you haven't read it, it's a great report. I encourage you to do so. But the industry had absolutely nothing to do with the generation of that report. And so it has gotten additional attention. I think it's carried a bit more weight. And so I think we are always looking to find new friends and spokespeople that maybe don't appear to be traditional allies. So I just throw that out to the group.
Appreciate that.
And from Canada's perspective, Teresa, I'll just again underscore the point. We're two countries with very economies that have delivered an extraordinary quality of life to our people, and we've done it largely because of the affordable, reliable energy delivery we have, and natural gas has been a big part of that. But in order to maintain it, you've got to make sure people understand it, and they've got to be prepared to stand up and defend it. Small gas. Everybody's making gas appliance
As a potential ambassador for gas. Very often, the assumption is that the industry itself is its only advocate, and that's not the case.
Everybody's benefiting from the things we're delivering as a potential advocate. We need to encourage them to be advocates.
Good point. We're used to a certain standard of living, and I can't imagine changing that just to be, trying to reach some unattainable goals. I do have one more question from the audience. I don't know if we're out of time, though. For some reason, I don't know how much more time we have left. Does anyone know? I think, do we have time for one more question?
No, I think we're out of time.
Okay. That was a fantastic panel. I really enjoyed everyone's perspective. Thank you all.
Yeah,
Thank
Teresa,
you.
thank you for a great job moderating. And I think I don't know if you can hear the crowd cheering. So there you go. That was a terrific panel. We appreciate your contribution, Teresa. Again, thank you for moderating, and thank you, Calpine Energy Solutions, for
pleasure.
being a sponsor of this event. I think we're going to go into networking here shortly. You heard a lot of discussion around working together and equipping yourselves to be advocates for our industry. I know that's hard. I know I even have a hard time with it, and I'm going to try to find. By the way, Amy referenced the Columbia University report, and I have a link to that. I'll put it in the chat for you all. But it's difficult to be an advocate, you know, when you're at your neighbor's house or something like that, and the issue comes up. But think of yourself more as a teacher and educator, and have good, solid conversations with your neighbors. A lot of your neighbors don't even know this stuff is happening. We know it because we live in it every day, and our polling shows that many of our neighbors don't know about some of the policies that are being promulgated in some of the places across our two countries. And so it's incumbent on us to, I think, help them understand the contributions we can make to our aspirations as two countries to be even cleaner than we are already. So on that note, I'll say once again, thank you to the panel. I'll encourage you to look up there when we go back to the networking, just to the left of the stage, there's a little video that you can listen to. That's the Partnership for Energy Progress, which is a regional pro-natural gas campaign supported by labor and business, and lots of there's more than 60 organizations that are part of that. It's a great campaign, very, like I said, very positive, and you can point people there too, if you like. So thank you one last time to the panel. Thank you one last time to Teresa, and we'll let the producers take us back to networking, and we'll see you in about 15 minutes.
Bye. Thank you.
Welcome back. We're excited to bring you the next presentation. You heard, but before I get there, I do want to give a shout out to our newest platinum sponsor, Spire. And there are a number of Spire representatives in the audience. I'd really encourage you to look them up. Usually what we'd have them do is stand up at their table and wave them so you could see their faces. But if you'll look around the tables for John Elmore, John Grass, Chris Wilhite, Stephen Heath, Scott Smith, Matt Walton, or Chad Whitehead, those are the guys that are here supporting this energy conference, and we just want to give a big shout out and thanks to Spire for sponsoring this event. So you heard a lot in the last panel about how virtually every part of the value chain is of natural gas. Certainly the midstream, the infrastructure parts of it are focused on how to contribute to a cleaner energy future that we all aspire to. And in that regard, we're really pleased to have David Brown and Ken Dragoon here to talk to us about renewable hydrogen. Both of these gentlemen, if you haven't met them before, they're both right here in the Northwest. And we'll give you a little bit of their background, I think, as they go through this. But this is a great topic. Renewable hydrogen is part of that future that you heard the previous panel talking about. And I really look forward to hearing from Ken and David. And with that, I will turn the mic over, Ken and David.
Okay. Let me see if I can share my screen. Okay, good. We'll go to presentation mode and see if that works. Do it twice. Hopefully you see the presentation slides.
They're all muted, Ken, but I see it.
Okay, great. Thanks. I'm Ken Dragoon. I work for David, actually, at Obsidian Renewables. I'm the Director of Hydrogen Development. I'm relatively new at Obsidian. I started in January. Just to give you a little bit of an overview of what we're planning to present, relatively briefly. We hope that we have a lot of questions. There ought to be a lot of questions, but it's a very broad topic, and so people have different interests. We'd like to tailor it to your interests. So talk a little bit about what Obsidian Renewables is and Renewable Hydrogen Alliance. You'll hear why that is there in a moment. We'll give you a short introduction into what we mean by renewable hydrogen. And then, you may have been hearing about hydrogen. We certainly have today. Maybe you didn't hear about it a year ago. So we're going to try to answer the question why this is happening now. Then that'll be my part of the deal, and then David's going to take over and look at it from a more business perspective, the opportunities and challenges, and then looking ahead. You may notice I changed out the word obstacle for challenges. I don't think there are obstacles. I think there are challenges that we will overcome. So just a moment about Obsidian Renewables. It's the largest locally based developer of utility scale solar projects in the Northwest. It's not a huge company, but it has a lot of weight. Obsidian's first solar projects came online in 2012 and been working on others since, growing to the current 400 megawatt Fort Rock solar project under development in Central Oregon. Very exciting project that is. So Renewable Hydrogen Alliance is partly why I'm here. I founded the organization. It's a trade association whose mission is to promote using renewable electricity to make climate neutral fuels to reduce dependence on fossil fuels. I was executive director of that organization for 2.5 years until David hired me away in January. It has a very diverse membership, which includes electric and gas utilities, Puget Sound Energy and Northwest Natural among them, other electric utilities in the Northwest as well, like Portland General and Tacoma Power, and of course Douglas PUD, Klickitat PUD. Electrolyzer manufacturers, you'll hear what electrolyzers mean in a moment if you don't know. Hydrogen vehicle manufacturers and advocates for hydrogen vehicles, energy developers, law firms, consultants, clean energy advocacy organizations, and even a tribal organization. And it's really quite amazing that such a diverse group of folks have interests that align on this topic, and in many cases, little else. So what are we talking about? There's a device called an electrolyzer. It sounds like a big word. Maybe it has something to do with cosmetics, but in this case, it doesn't. What it means originally was putting a direct current through water to split the H2O into hydrogen and oxygen. It's really virtually as simple as that. You can take a cup of water at home and a battery, as long as it's 1.5 volts or higher. The 9 or 12 work really great. A wire from each end of the battery into the water, a little bit of baking soda in that water, and you'll start to see bubbles coming up off of each of the electrodes. One of the electrodes will be hydrogen and the other oxygen, which can be separated. And the hydrogen has a lot of uses that you may know about. We'll talk a little bit about in a moment. Usually the oxygen is just released to the atmosphere. It doesn't have a high commercial value enough to capture it and use it in most cases. The technology, as I just described it, is called alkaline electrolysis. There's kind of a newer kid on the block. Is called the proton exchange membrane. It's virtually a solid state version of the alkaline version. These are the two commercially available, kind of at scale, technologies. There are others that I'm not really going to talk about that might come along in the future, but these are both commercially available today. It was discovered 200 years ago, literally 200, in 1800, they discovered that you could split electricity about a week after they discovered how to make a battery. So it's been around for a while. Now, actual industrial application of this technology is a lot newer than that. It's only 100 years old. These are two utility scale projects that were built in Norway. The first on the left ran from 1927 into the 1970s, and the other one says 1953 to 1991. 30,000 cubic meters per hour. It's about 3,000 kilograms or 3 tons per hour of hydrogen. Why were they doing this back then? Well, they discovered in around 1917 that you could make ammonia, which is necessary for fertilizer, by combining hydrogen with nitrogen. And Norway is heavily hydro powered, and they had surpluses of hydropower they wanted to have something to do with. So they actually used it to make hydrogen. The hydrogen was combined with nitrogen out of the air to make ammonia and sold as fertilizer. The company that did this is basically the state utility of Norway. They've spun off 2 companies that are still in existence today, Nel Hydrogen that makes the electrolyzers and Jara that makes fertilizer. So hydrogen seems so new. I keep hearing that hydrogen is this new thing. Well, I don't totally understand it. It isn't really new, as I've described. And not only is the technology not new, the use of hydrogen isn't really new either. The US makes and consumes 10 million metric tons of hydrogen a year. That's a $10 to $20 billion a year industry today. About 2/3 of that hydrogen is used in the process of oil refining. About 1/5 of it is used in creating fertilizer, just as they did in Norway with those earlier projects. So that's not new. The hydrogen that's created today is not made in the way that I just described, using electricity to split water. It's made primarily from natural gas, combining natural gas with steam in a reactor with a catalyst, strips the hydrogen out of the methane, leaving carbon dioxide and hydrogen. So it has a significant carbon footprint, but it's a big industry already today. And the least cost way of making hydrogen today is that process. So why are we talking about this? Why are you hearing about it now? This slide says green hydrogen and not renewable hydrogen. We kind of tend to use them interchangeably. But there are a couple of things that are happening. It's really instigated by the world decarbonizing. And as part of that, the development of wind and solar power have been integral. And they are integral to why we're talking about hydrogen today. Wind and solar become lowest cost sources of electricity, certainly zero carbon electricity, but just electricity in much of the country and much of the world today. If we are going to rely increasingly on wind and solar for our average need or our moment-to-moment need for electricity, sometimes, there's just not going to be a lot of wind and sun, and other times there is going to be a lot of wind and sun, more than there's currently demand for. So we are increasingly seeing these big surpluses of renewable electricity in the wholesale power markets, and even having to turn the renewables off at times when there's just more than we know what to do with. Well, they've seen this in Europe ahead of us, where the penetration of renewables is higher and the value of the hydrogen is greater because the cost of natural gas is higher. And they started investing in this technology and started deploying it at increasingly large scales. And the manufacturers started to scale up. And the cost of the electrolyzers have dropped about half in 4 or 5 years, not really through any technological breakthrough, just by economies of scale. And recently, Nel Hydrogen, the ones that had the spin-off that I showed you before, those older versions, announced that they're dropping their prices another 75% by 2025, I think. And Siemens and others, ITM Power, have more or less followed suit with that. So we have this confluence of two things. They're not unrelated. The increase in the availability, it takes a lot of electricity to make hydrogen. And if you don't have a low cost source of it, you're not going to do it. And of course, if you, there's a great book, The Hype About Hydrogen, by a guy named Joe Romm, who talked about, well, gee, if you're going to go through all the expense and trouble of making renewable electricity, the best thing to do with it is to displace fossil sources of electricity. Absolutely true. But what happens when they're all displaced and you've got extra? And that's what's beginning to happen now. So we have this increasing supply of low cost, low carbon electricity, which has really sort of caused the capital costs of the devices to decline. Now, you can't just run them today on those few hours where we're actually curtailing the renewables, but the costs are coming down to the point where you can probably do that in a few years. In the meantime, there are other niches that we're finding for this. And the confluence of those two things, of course, is what we think of as affordable clean fuels. Not terribly cheap today, so we're still looking at niches, and the probably lowest hanging fruit happens to be in transportation, because hydrogen fuel cell vehicles are twice or 2.5 times as efficient as internal combustion engines, and the cost per BTU of gasoline and diesel is a lot easier to compete with than natural gas. So that I kind of teed it up there from a more or less theoretical sense. And I'm going to hand it to David now to talk about the opportunities and challenges in making this happen.
Okay, thank you, Ken. We've attended the entire conference today, and I've been quite impressed with it. I've enjoyed getting to meet a number of you through this process, and I'm eager to talk to you about what we're doing. So, a couple things about hydrogen that I'm sure most of you know, but I want to emphasize that they're very important to understand. First, water likes to be water, and it takes a lot of energy to dissociate the oxygen from the hydrogen. So the amount of energy it takes to produce the hydrogen is less, excuse me, is less than the amount of energy that sits in the hydrogen once it's produced. So if there's a direct way to use the electricity instead of making hydrogen, it's probably sensible to do that directly. Second, we think that in today's market, with today's costs, we can produce hydrogen that comes out of the electrolyzer at about $3 a kilogram or less. But that's just kind of a small part of the cost picture. Hydrogen is very expensive to store, and it's very expensive to transport. It's the smallest molecule, H2, and it occupies a lot of space for its energy value. So it's a little bit like, it's more expensive to move a ton of feathers than it is to move a ton of steel. So what we're looking for are hydrogen users that can be nearby to the electrolyzer, and an electrolyzer that can be nearby to a purpose-built solar farm, which would act as the anchor electricity supply for the electrolyzer. If I can build the solar farm without having to interconnect to the utility, where everything stays behind the meter, that's the lowest cost electricity that I can find. And so that's what I want to have as the base for the electrical supply. And then the next slice of electrical supply would be what are called low load hours, overnight electricity that would be mostly wind and hydro. And together, those two pieces are going to supply about 65% of the hours of the year. We expect an electrolyzer to run about 80% of the time. So we'll be in the market opportunistically when power costs are low. When power costs are high, we'll shut off the electrolyzer. So the things that we're looking at would include manufacturing ammonia and then fertilizer. Glass manufacturing has become kind of controversial in Oregon for some air quality reasons, and so maybe a new glass facility that utilizes hydrogen would be a good user. Of course, transportation. but we run into the storage and transportation of hydrogen costs. And then other manufacturing, corporate customer backup, the data centers, Oregon has lots of them, all major flavors, and they're all looking at their diesel backup generators, wishing they had a more environmentally responsible choice. Microsoft, I think, is kind of leading the way, exploring hydrogen. But again, to be able to provide a data center with 40 megawatts of hydrogen backup requires a huge amount of storage, and storage is expensive. Next slide. So sort of an entry-level idea that makes a lot of sense is to do a blend. So switch from natural gas to a natural gas hydrogen blend. An example would be a gas turbine. People are working very hard to explore how much hydrogen can be blended with the turbine, but people are pretty comfortable at 10%. And a lot of people are pretty comfortable up to 20%. And Mitsubishi's made a commitment to have 100% hydrogen turbine available by 2030. And they're working hard on pathways towards that using their existing combustion turbines. The other thing that's being looked at pretty hard is renewable natural gas. That's CO2 maybe that comes out of a landfill, or CO2 that comes out of an industrial source that gets combined with hydrogen to make methane. It has the advantage of no blending issues, no pipeline injection issues, because it is natural gas. It, of course, is expensive, but there also are definitely utilities in the region. Both Northwest Natural Gas and Puget Sound Energy have committed very recently to renewable natural gas contracts. Next slide. So this all has to come together kind of at the same time. There's right now almost no large electrolyzers in service in the United States. And by almost no, I think I mean none. Lots and lots of action. If you want to talk to Siemens, you want to talk to Mitsubishi, you want to talk to Plug Power, you'll be told that everybody's talking to them, but still the order book is thin and the actual construction is still on the horizon. So electrolyzer production needs to catch on and needs to step up to get significant economies of scale. Also, the market for zero carbon hydrogen today is really small. There's a lot of interest in it. Fertilizer companies have a lot of interest in it, but in terms of who actually is buying it and using it, it's pretty much data centers to operate fork trucks, some ports to operate fork trucks and handling equipment, but still not a big use. And lots of transportation pilots, but again, not a really big use. It seems very, very likely that Biden's energy proposals will include hydrogen. All of them do as proposals. And it has bipartisan support, the idea of encouraging hydrogen. So that will help. If hydrogen gets a investment tax credit or a production tax credit, it would be much more competitive in price with gray or with natural gas hydrogen. Next, please. So fossil hydrogen, natural gas hydrogen, is made with a process Ken described, steam reforming, where the H2O in steam is combined with NH4 methane and results in the hydrogen being released and the CO2, I'm sorry, CH4 for methane, excuse me, the CO2 being released into the atmosphere. So to compete with that, it's extremely important that electricity costs are low. Electricity is far and away the largest cost component of hydrogen. But if you think about Ken's map a few slides ago, there is no natural gas hydrogen being produced at volume in most of the Pacific Northwest. There's a facility to serve the oil refineries up at on northern Washington coast. There's a plant in Billings for the same purpose to serve oil refinery. But there's very little in Idaho or the rest of Washington or Oregon. And so we can compete very well with gray hydrogen that has to be delivered because those delivery costs are high. So we're kind of looking at this inner mountain area from Spokane through Hermiston down to Boise as being an area that can compete against fossil hydrogen very effectively, unless we're so successful that a fossil hydrogen plant is also constructed. Electrolyzers can be shut down on very short notice. It's a big advantage to a utility that makes it a demand response asset. Electrolyzers can also serve as spinning reserve. And so there are creative ways that utilities can collaborate to extract benefit from an electrolyzer as a customer. But so far, utilities aren't doing that, with the exception of Tacoma City Light, which has a electrolyzer tariff that they're experimenting with. But you know, we need utilities to think about why they want electrolyzers as customers, and they can shape the product to serve the customer with the lowest possible cost electricity. The big idea is to have a hydrogen pipeline. That's what we need. We need a hydrogen pipeline that goes from Salt Lake City all the way through the Cascades and then up to Seattle and down to Portland and on to Eugene. And maybe another one that comes down the back of the Cascades through Bend and goes to California. But that's the big idea, and it's a ways out. But as you all know, because this is your industry, the storage and delivery and safety advantages of a pipeline are at the very, very top of the available technology. Trucks hauling hydrogen can be safe and effective, but nowhere nearly as inexpensive as a pipeline. And then, of course, the cost of movement through a pipeline using compression is a lot less than the cost of driving a vehicle. So that's kind of the big idea, is to get that pipeline in. It also then would allow hundreds of independent solar producers to produce hydrogen to feed into the hydrogen pipeline, which would make that a very, very competitive and granular market, which I think has supply chain advantages. It's good to have hundreds of farmers rather than just a couple of producers. Next slide. So looking ahead, the European countries are way ahead of this. Japan is an absolute leader in hydrogen thinking and hydrogen development, though a lot of the development that Japan is doing isn't in Japan because they don't have the wind and solar resources to form the backbone of the production of electrolysis hydrogen. So Japan is looking at a very, very big partnership with Australia, and they're also looking at places in the Northwest and other parts of the world for sourcing large production of hydrogen. The current thinking is that'll probably be converted to ammonia. There's more hydrogen in a cubic foot of liquid ammonia than there is in a cubic foot of liquid hydrogen, which is kind of funny, but there is. So ammonia is a more dense and much less costly way of transporting hydrogen, though again, you lose energy in making the conversions back and forth. We think hydrogen should be looked at as a feedstock for hard to decarbonize industries. We've talked about fertilizer because it's just the easiest example, but there's other examples in steel, in semiconductor manufacturing, cement production. There are numerous places where hydrogen could become a low carbon feedstock and help decarbonize hard to decarbonize industries. And the Biden administration so far is a very strong green light on this. Next slide. So one of the things that we're working to develop is this regional network that I described, but also to create a hydrogen industrial park. So a share of a large industrial park that is dedicated to attracting hydrogen users and to attracting companies in the hydrogen supply chain. So right now there is no hydrogen supply chain because there are no electrolyzers, as I described, but we're going to need to have one. Hopefully we're sort of waking up that we don't want everything to be made in China. China is very aggressively building electrolyzers, and the US is not, Canada is not. But we hope people sort of wake up to that, and we're going to try to create this hydrogen industrial park as kind of a big idea on how to bring that together. Also, if you have multiple hydrogen users, then that helps solve the storage problem, because instead of trying to match your production to a single user's use, if you have a group of users, then it's easier to schedule production so that it runs all the time. And then from that industrial park, we would propose building a regional pipeline that would then connect into other industrial parks along the way. An obvious pipeline for us would be from the Hermiston area, where there are many Amazon data centers, to the Dalles, where there's Google data centers, and then a branch down to Prineville, where there's Apple and Facebook data centers. These data centers will be early adopters of hydrogen if we can solve the storage problem, and the pipeline would solve the storage problem. So that's what we're thinking about at Obsidian. Next slide then. And I've left 10 minutes for questions. So please, we're happy to talk about our company and our ideas.
I think I'm about to become live there instead of just an icon. I do have one question for you as we get a couple others that are coming in. And forgive me, I should probably know this, and I could probably make the calculation myself. But can you, for my sake, tell me what's the energy content in a kilogram of hydrogen in an MMBTU basis? I think it's 33 1/3 or something like kilowatt hours.
Kilowatt hours, yeah. Multiply by 3412 to get BTUs.
Okay, so what is that, about 100,000 BTU maybe? So a therm maybe?
Yes, it's close to a therm. It's about, it's within about 15% of a therm.
Okay. Okay. Well, we do have some questions here, and let me get to those. We've got several, actually. So question one, you mentioned that hydrogen production costs will decrease from electrolyzer economies of scale. How? Will technology improve production costs, or is this technology known today?
So we have seen, and the federal government has proposed intention to get the cost of hydrogen down to $1 a kilogram. By our modeling, that really can't happen. Even if the price of electricity were zero, it would still be about $1 a kilogram. So they are expecting efficiency improvements in the electrolyzer. Though the electrolyzer is not that bad. It's what, Ken, about 70% efficient? Yeah. So maybe that can get to 80, which is a lot, but it takes a lot of energy to get water to dissociate itself. So it's not all going to get recovered by the electrolyzer. The key really is very low cost electricity. And as all of your members know, retail electricity is way more expensive than wholesale electricity. And so the challenge for those of us in this business will be, how do we get to wholesale pricing? And the PUD in Central Oregon is getting to wholesale pricing because it's producing the hydrogen, and it's a utility, and so it can produce, it can use its own electricity at its wholesale price. But that's really going to be the challenge, is how to get to very low cost electricity.
So electricity is the big part of the cost today. But if you can get the capital costs down lower than where they are today, which isn't particularly low, then you can afford to run the electrolyzer on fewer hours and take advantage of the smaller number of hours where the prices are really low. So although I may be a minority voice on this, I think getting the capital costs down is really important. So the industry, so the question being, how does that work? Well, it works through economies of scale. I asked the CEO of one of the manufacturers, in fact, Nel Hydrogen, the one in the pictures, about the costs. I observed that the cost had dropped by a factor of 2 in just a few years. And he said, yeah, we're going to drop it by a factor of 10 from where it was. And I said, well, when is that going to happen? He said, it's not about when, it's about production levels. That was 3 years ago, and now they are talking about, the industry is making, like 100 megawatts a year of electrolyzers today. But the manufacturers are scaling up to 1,000 megawatts per year manufacturing facilities and 2,000 megawatt per year facilities. And it's those economies of scale. When you're making one of these things every 5 years, it's a lot different cost. One of the manufacturers said, hey, Ken, today we're still largely making these by hand. If we were making them at scale, we'd be printing them. And that small company at the time is now bought by a Fortune 500 company with the wherewithal to do that. So really looking to mass production. It is a very small industry today, but it is very scalable.
Great, thank you. So we do have a number of questions here, and we could probably go a little bit over time on our Q&A because we had a little bit longer break. So from a pipeline perspective, how well does hydrogen blend or diffuse into the gas stream? How big of a threat is hydrogen embrittlement, and has there been any large-scale examples of it working safely?
There, I don't know of any examples of interstate pipelines injecting significant amounts of hydrogen. In the UK, there's a distribution system running on 20%. They think that you can get to 30% without having to change out appliance burners. The embrittlement question is a big question. So the amount of hydrogen that you can introduce into a pipeline, and there are people on this that will know this far better than I only know what I've read. Embrittlement can be an issue at low levels. Most people think that it's not a big issue at a few percent. But from the electrical side, even a few percent of the gas coming from hydrogen would take like a doubling of our current wind fleet in the Northwest. So it's a big deal on the electrical side, even if we only got to 5 or 6% hydrogen mix. And then beyond that, there are embrittlement issues. You may have to line the pipes. You may have to make methane, synthetic natural gas. Then there's no limit, but you need a source of CO2 for that, or you need hydrogen pipelines. There were questions about the odorant. Those don't seem to be a big deal, as it turns out. And all of the gas companies seem to be, well, many of them, I can't speak for all of them, Northwest Natural, Southern California Gas, and we've been talking with Williams Pipeline, all very interested in blending hydrogen into the gas system, which we think is really important to solve the storage issue, the storage cost issue.
So you may have addressed this question, but let me maybe get at it more directly. Are many of the risks that you identify with green hydrogen being transported by pipeline mitigated with methanated hydrogen? So I think you actually alluded to that, Ken, in your last answer, but maybe you can talk a little bit more about that.
Yes, methanated hydrogen is methane, and the risks they go away. The methane's a lot more expensive because you have to have another industrial process to make it, but it does eliminate those risks.
Okay. Any chance that blue hydrogen plus carbon capture and sequestration would be viewed the same as green hydrogen on an environmental or carbon intensity index basis, carbon index basis? Sorry.
So I would say that as the former executive director of the Renewable Hydrogen Alliance, I have a hard enough time getting people to accept hydrogen from renewable electricity, especially if it goes into a pipeline. And I wouldn't touch blue hydrogen with a 10-foot pole personally. Politically, it's a third rail with those people, the environmental community. Hydrogen itself is something I worked for years now trying to get them to accept. And I think I've gotten closer. But that's my view. And I'm also not clear that blue hydrogen is very realistic in the Northwest.
Yeah, I would say there are parts of the country where blue hydrogen could play a significant role. If an oil refinery has carbon capture all figured out, then it's not difficult for them to add the CO2 stream that comes out of their steam reformer. So in parts of the country, yes. Here, I don't think so, and the politics would be very difficult.
Brutal.
Okay, so here's an interesting question, given that we're seeing drought conditions in the West. As H2 production increases, is there enough water to support the emerging market?
Yeah, it's amazing. It takes, as we said, it takes a lot of electricity to split water. The flip side of that coin is it doesn't really take as much water as you might imagine to store the energy. A little bit of water stores a lot of energy. We looked at it. It takes somewhat more than the steam methane reformation hydrogen, but not much. And if you look at the water consumption that goes into a gallon of gasoline, compare that to the hydrogen it would take to drive a car the same distance, the amount of water needed for the fracking and the refining and the getting the gasoline to where it goes, they're about the same. In some cases, the hydrogen looks a little bit better. Some cases, it looks a little bit worse. The water used to make electricity from coal power is like 10 times more than the equivalent energy in hydrogen. So it's a significant user of water, but kind of a surprisingly modest one.
Okay. Can you go a little bit deeper into the storage challenges with hydrogen and possible solutions?
Well, there are so many possible solutions. It's hard to decide, and it's really application specific. So, converting it into ammonia to ship it overseas, that's what they're planning to do in Australia, sending huge amounts. And in Saudi Arabia, there's a huge project planned to use solar power in Saudi Arabia, and they'll have to start out with seawater. They're going to make ammonia and ship it to Europe. Australia is going to ship their ammonia to Japan. If you're looking at, storage in a car, it's compressed hydrogen at the moment. Everyone's sort of settled on 700 bar, 10,000 PSI or so. And that's for that. The storage on site at a fueling station is probably also compressed hydrogen. And then liquefaction is a possibility depending on how far you need to move the hydrogen. And it can be stored that way. But I think by far the cheapest thing is to crack the nut on leveraging the existing infrastructure in the gas system to store it there.
So in that, I have two more questions. I actually have three more questions, but two of them are quite closely related. So quick answer to this one. Roughly what percent of the cost of getting hydrogen into a pipe, for instance, is compression? Is that a big part of the cost, or does it?
No, it's a pretty modest amount. Pipeline pressures aren't that high. The PEM electrolyzers, the hydrogen comes out at 30 bar. It's not a big part of the cost.
Okay. And then here's two questions related. First, it sounds like maybe we're thinking about ammonia as the way to transport hydrogen going forward. That's 1A. And 1B is, if ammonia production ramps up as an H2 carrier, will it depress or boost fertilizer markets?
So first, we think the best answer for storage and transportation is a pipeline. And we think the federal government should pay for it, or at least there be a federal public-private partnership to pay for it. That seems not that difficult as these things go, but here I just said something in Washington, D.C. isn't difficult, so how ridiculous, how ridiculous am I?
We're not listening to you now.
So, but yes, from my perspective as a hydrogen developer, what I would like to do is have a baseload customer that I could just rely on to take my hydrogen if, when, and to the extent I approve it, with the right for me to sell hydrogen to a value add customer who's going to pay a higher price as best I can. So if I had an ammonia production facility that was willing to take all the hydrogen I could give it, then I think I'd be in a great position to attract a fertilizer manufacturer to come and build a fertilizer plant right next door.
Okay.
Yeah, the storage thing, ammonia appears to be in the lead for huge quantities of hydrogen shipped over a marine vessel, across the ocean. Even that's not for sure. That's the current plans that we see. But there are other options even for that. methanol, for example. We have a local company in Washington that's betting on formic acid. Ammonia is great in the way that David described. It has a high energy density, and the process for making it is 100 years old. So those are the pluses, but it's also quite toxic. So there are pluses and minuses to all these things, and it still sort of needs to be shaken out.
Great. Okay. Well, I want to thank you both, Ken and David, for your time today and for your expertise and lending it to this crowd. We sure appreciate that. That sound you're not hearing is the applause you heard. You would have heard if we were in person. And hopefully you can join us next year for our conference where Lord willing, we will be in person. So
well, this has been great. Thank you.
Yeah, good.
Yeah,
good.
Thank you. We'd like to do that.
Great. Okay. Well, I think our event producers will take us to networking now, and we'll reconvene about 2:25, folks. So enjoy some networking over the next several minutes.
Thanks, Dan.
Thanks, David. Well, welcome back. We hope you had a good break and have continued to do some good networking. I hope throughout this day that you've had the chance to visit with old friends or young friends, for that matter, new friends and old friends, let's put it that way, as well as maybe you found one or two or a handful of people that you didn't know before, but can establish a relationship with because of this interaction today. I'm really excited about this next panel. And this is our capstone panel for the day, Embracing the Future, talking to 4 of the leaders of our industry that are really charged with helping us achieve the clean energy future that policymakers in our region have envisioned for ourselves. So I'm really pleased to introduce one of my board members, Camilo Amezquita, who will moderate this panel from Williams Northwest Pipeline. Camilo, the floor is yours.
Great. Thank you, Dan. And you can hear me okay?
Yes, sir.
All right. Well, appreciate it, Dan. And first, I want to thank everybody from the Northwest Gas Association for the opportunity to moderate this panel. And as you mentioned, the topic of the panel is Embracing the Future. And I'm really excited about, the opportunity to host this panel from an idea and a sharing of a vision. And we have a very distinguished panel of Nicole Cavisto with MDU, Mary Kipp with Puget Sound Energy, Jason Thaxton with Avista, and David Anderson with Northwest Natural. So you won't see Mary initially. She's got a conflict, but she'll be joining us a little bit later. From a logistics standpoint, each panelist, we'll kick it off and I think everybody has received the bio, so we're not going to go into full bios of our distinguished panel, but I will introduce them and have them take about 5 minutes to provide an overview or introduce themselves and then provide an overview of their companies and perhaps cover 1 or 2 areas where their respective companies are embracing the future. And really it's driven by the changing landscape that we're seeing in the electric and the gas side of our businesses. After the introductions, we have some prepared questions for the panel, and they're really grouped into 4 distinct buckets. We've gotten, I solicited feedback and information from some of my peers. It was very clear that the level of interest is really in 4 major areas around decarbonization, around electrification and resource adequacy, around regulations and legislations in the Pacific Northwest, mainly Washington and Oregon, and then hydrogen. We've heard a lot about hydrogen today. So we will have around 15 minutes at the end of about 10, 15 minutes at the end of the Q&A for Q&A. So I think everybody's been very well versed in the Q&A box and how to put your questions in there. And if you don't want to ask a question, but you see somebody that has a really good question, go ahead and push the vote button, and that just will continue to elevate it. And I'll moderate the Q&A panel there at the end. So again, I'm really excited, and I hope that we get some really good. We know we'll get some very good information from our distinguished panel. If there's any questions that we ask that are not covered in the panel, again, please utilize that Q&A box. So we'll get started, and we'll start with Nicole Vista with MDU.
Okay, thank you very much. So as Camilo said, I'll introduce myself and a little bit about my company, and then a couple of the key things that we're focused on here as we transition and embrace the future. Before I get started, though, I have had the opportunity to listen to a lot of the presentations today, and I just want to say kudos to Northwest Gas Association and the presenters, as well as the panelists, for your really well done presentations. The benefit of going last in a day full of activities is you can reference some of the great speakers ahead of you, because there's been some very good dialogue here. So Nicole Cavisto, as Camilo said, I work for MDU Resources, is our parent company, and we are a little bit different than some of the other panelists here today in that we operate a very diverse business mix. And so we actually operate under a two-platform model. One is construction, and the other is regulated energy delivery. So of course, I work for our regulated energy delivery platform. In that platform, we have our utility companies represented under 4 brands that I'll talk about in a minute. And then we have our sister company, WBI Energy, that is the natural gas pipeline, FERC regulated pipeline. So I won't spend a lot of time on our construction businesses, but just know that as we make corporate policies and make corporate decisions, certainly we are weighing not only just our utility industry, but also our construction industry. So in terms of our utility, we do operate across an 8-state territory. We have electric in 4 states serving 143,000 customers. We have gas in 8 states serving 1 million customers across an 8-state territory, going from Washington all the way over to Minnesota. And so I won't name each of those states, but as you can imagine, the political landscape across that 8-state territory is different as we navigate that with our 1 million natural gas customers. We do all that with a great team of employees, and I would be remiss to not mention our 1,600 employees that work hard every day to help me get my job done. So specifically, you asked about a couple topics in terms of, what would we touch on how we're embracing the future. And it's kind of hard to just pick 2 as we think about everything we're navigating today in our space. But I will touch on renewable natural gas as one of those, as well as some of the things that we're doing to explore R&D efforts with respect to future potential. So touching on RNG first, we actually for many years have been and own a renewable natural gas production facility at a landfill in Montana. So again, not in the Pacific Northwest. We've owned and operated that for many years. But we have been taking renewable natural gas at, I think it is 3 locations in our Idaho market, and are continuing to pursue in the Washington, Oregon markets, as well as most of you are probably aware in the audience, as well as my fellow panelists, the price point has been changing quite a bit here recently. And so we haven't been able to secure that as of yet, but certainly renewable natural gas is a focus, has been, and will continue to be for us. And then embracing R&D and supporting R&D efforts. We are a member of the Low Cost Resource Initiative, which I can talk about a little bit later. Certainly, as we talk about our electric and gas presence across 8 states, one of the benefits that we see is we're going to have to leverage our industry in total to move forward with R&D. We are not a big enough utility in of ourselves to be funding some of these major initiatives. And so we did join the Low Carbon Resource Initiative, and I can talk about that in a little bit more detail. So if I had to pick 2, Camilo, those would be the 2 I'd pick, is really RNG and also looking at, we got to continue to invest in the R&D side of this, as well as renewable natural gas. So those would be my opening remarks, and look forward to the discussion today. So thank you.
Great. Thank you so much, Nicole. And I'll definitely come back to the Low Carbon Resources Initiative, because just navigating through the website, there's some really, really good stuff there on the R&D side. Okay, David Anderson, do you mind going next?
Not at all. Thank you, and good afternoon, everybody. I know it's been a long day. David Anderson, President and CEO of Northwest Natural. I've been in this position for 5 or 6 years now, and was CFO before that. And then I spent 17 years in the electric and gas business down in Texas. So about half my career in the gas business, half in the electric. And before that, I'm a recovering CPA. So we'll take that for what it's worth. I'm lucky enough to lead Northwest Natural. It's the 3rd oldest locally owned company in Oregon, about 162 years old. And we've seen a lot of change during that time. About 770,000 customers, 2.5 million people, 1,200 employees, and they're like you, Nicole, they're great employees, and we couldn't get this done without them. We also, when I became CEO, we started expanding into the water business. So we have water distribution and wastewater facilities in 4 states, Oregon, Washington, Idaho, and now Texas, and hoping to add more to that platform. I can also address you as I agreed to be the chair of the American Gas Association, so I can talk on behalf of the industry here too, if you'll let me. And I think very similar comments to what Nicole's saying about the future of our industry. We are in the crosshairs right now with all things considered, and it's really important that we get our story out there. For the industry, it's the infrastructure that we all manage is critically important to the communities that we serve, specifically on those coldest days. I think everybody knows in this audience that that's why gas LDCs exist. And I know we got electrics and things like that in the audience, but on the coldest days, the majority of the energy, in fact, if I use Northwest Natural as an example, 90% of the energy is going to the household. And everybody knows that our peaks are different in the north and then in the northwest. They're longer, they're colder. So they're not really subject to the battery discussion. And so that's a lot of discussions. I've been on 4 different panels today trying to articulate this at various facets. The industry does need to continue to make its systems as tight as possible. The replacement of bare steel and cast iron is critical to our future success as an industry. And I know a lot of our peers are still doing that. Some of us have removed all of our cast iron and bare steel. I think energy efficiency is also another item that we need to continue to push very hard. In some of our jurisdictions, we have the responsibilities. Others, like here in Oregon, the Energy Trust of Oregon takes that responsibility. But that's a critical facet to the world of what we call decarbonization as we go forward. The next stage, in my opinion, is to ensure that we're buying from responsible gas producers. And I can share a little bit more about that, Camilo, and what we're doing along that front. And then last but not least is what Nicole said, is to decarbonize as much of our product going through the pipeline as we possibly can. And that is going to be through more renewable natural gas, which is from biogenic sources. And then hydrogen is a major factor along all that. With all that said, if we don't do it safely and reliably, we're not doing it correctly. And that's something that we cannot lose at the forefront of everything we do. And I think there's lots of distractions right now, and that's something that all of us need to keep our eye on, is making sure that our customers and our employees continue to deliver this essential service as safely and reliably as possible.
Great. Thank you so much, David, and really appreciate your leadership through AGA and really highlighting in this discussion and your opening comments around the safety and reliability. Those are key. Jason, thank you. I know we had some difficulties, but just wanted to see if you could introduce yourself and provide a little overview of Avista and some of the things that your organization is doing on embracing the future.
Happy to. Can you hear me all right, Camilo?
Yes, sir. Just fine.
Okay.
Thanks.
Deep breath. Yeah, everything was working fine. And then as soon as we got on the stage, all of a sudden my camera died and I was panicking. So glad to be here and part of this CEO panel. Dennis Vermillion, our CEO, really wanted to be part of this panel with the others and had a personal commitment come up that he had to attend to. So I'm here on his behalf. And I think many of you know Avista. We have about 400,000 electric customers, about 370,000 gas customers, with operations in 5 states, including a small utility in Southeast Alaska. And much of what we're talking about is very similar to what I heard from Nicole and from David around a couple of things that we're focused on quite a bit these days, as you all are as well. The first is what you've been talking about, what we've been hearing about all day today, which is a cleaner energy future. And how do we navigate through that, both on the electric side and on the gas side? 2 years ago, we announced our aspirational goal to be 100% clean by 2045 on our electric side and carbon neutral by 2027. And a couple of months ago, we announced for our natural gas business a goal to reduce our greenhouse gas emissions by 30% by 2030 and carbon neutral by 2045. And we recognize for both our electric business and our gas business, that's very aspirational. We're trying to find that intersection of what's clean, what's affordable, and what's reliable, making sure that we're being very intentional about the steps we take toward those goals. And if we can achieve those goals and keeping affordability front of mind and reliability, then we'll push the goals out. So the clean energy future, and I know we're going to talk some more about that in a minute. The other thing that we're focused on quite a bit, as you all are as well, is what does this pandemic mean for us and for our employees and our customers as we move out of it? And what opportunities might we embrace? And knowing that there are some challenges and some stumbles that we'll have along the way in having a workforce that is more flexible in the arrangements we have with them than we've had in the past. And we've learned a lot from these past 15 months, and we look forward to experimenting some more and finding ways that we can still serve our customers well, but also help our employees have a better employee experience. So looking forward to more of that conversation.
Great. Thank you so much for that, Jason. And Mary, welcome. I know you had a conflict, but thank you so much for joining us.
No, thanks for having me. Sorry I couldn't be here earlier.
No, that's okay. You haven't missed much. What we've been doing is just each of the panelists has been introducing themselves, providing kind of a high-level overview of their organization, and then 1 to 2 key areas that you'd like to share around what Puget is doing to embrace the future. So if you don't mind covering that, and then we'll get started with some of the questions.
It would be my pleasure, and hopefully my dogs won't bark. So like many of the companies here today, we at PSE have announced some pretty aggressive climate goals at the start of the year, and our aspirational goal is to be a beyond net zero carbon company by 2045. And that means a few things. It means that we're going to target the reduction of our own carbon emissions to zero, and then go beyond by helping other sectors like transportation to enable carbon reduction across the state of Washington. And we're a dual utility. So for us, that means both electricity and natural gas. But it doesn't mean that we're abandoning the natural gas side of our business. It means we are decarbonizing that side of the business. We have highly skilled employees, and our customers have invested in the infrastructure. We call it our pipes and our people. So we believe what we need to do is to innovate around it so that we can continue to provide clean energy without compromising safety, reliability, and of course that affordability, which is so important for so many of our customers.
No, and thank you for that, Mary, and really appreciate kind of for the entire panelists, all of the opening remarks. I think everybody has really got a good understanding of the efforts underway within the organizations, your respective organizations. So I'm going to go a little bit more into detail on just some of the movement that we're making on some of these efforts. So, Nicole, I'll start with you. And you mentioned the Low Carbon Resources Initiative. I think that's being done out of the Intermountain Business Unit, and it's very driven by R&D. And in a lot of the presentations that we heard today, there's a lot of uncertainty because of the lack of, technology continues to improve, but there's uncertainty about the future. And so when I read a little bit about the Low Carbon Resources Initiative, a lot of companies are supporting that through funding for R&D. Can you talk to us a little bit about some of the top 2 or 3 near-term options that they're looking at that may be scaled up? That's something that we can incorporate into our organizations to really start moving the needle on a low-carbon future?
Yeah, so in case anybody in the audience isn't familiar with the Low Carbon Resource Initiative, maybe just a little bit of background. It's relatively new. About a 5-year collaborative effort led between EPRI and GTI. So certainly Intermountain, as you mentioned, is our subsidiary that's actively involved and has been involved in GTI for a number of years. This was brought forward through our GTI representative in terms of now a collaboration between electric and gas, which obviously piqued our interest. We do have electric, not in Idaho, but we do have electric in other states. And the emphasis on R&D was certainly what was an important aspect for us. As I mentioned earlier, we are unable probably to fund that kind of level of research on our own accord, right? We're a smaller player in the overall utility space on a national level. And so certainly partnering with others in providing those funding dollars. For us, what I would highlight that we expect to see coming out of here are a couple things. One is really research as it relates to natural gas heat pumps. And that work had been done, and had already been started with the GTI. So I think we're in another stage, I would say. It's been upped a level as part of this overall research and development effort as it relates to the Low Carbon Resources Initiative. So that's one area. And then another area that I would highlight, they're looking at a lot of things here. So I don't want to discount all the work that group is doing, but the 2 that we have a lot of interest are the natural gas heat pump, as well as the hydrogen, and what's on the come for hydrogen in the future, and what does that blending look like? How technically feasible is this? Those sorts of things, and they bring these things to scale, obviously on a smaller availability, and then obviously as a member we get the benefit of what comes out of those development opportunities. So certainly we're excited about it. It's an area where we can dip our toe in without funding it on a larger scale.
Yeah, no, thank you for that, Nicole. Great explanation, and my apologies for not laying out what the Low Carbon Resources Initiative is, but thank you for that background. David, I'll challenge you a little bit, and really it's something that is very visible, and that's Northwest Natural is an energy transition leader in the Pacific Northwest. A very visible, very vocal. We've seen some very strong initiatives, a lot of movement in the region to drive low carbon renewable energy in the future, a lot of visibility around the low carbon pathway. Can you provide a little bit more detail on what that pathway is, and then any progress that you're making as you establish some of those interim goals?
Sure. So in 2016, we kind of came out with our strategic plan, and that's when we announced a 30% reduction by 2035, which includes Scope 3 emissions, which includes customer emissions. That was unique at the time. So not only company operations, but ensuring that customers use less. We've learned a ton. We're on track, frankly, to make that happen. I think the gas industry has been doing good in general in this area for a long period of time. Declining use per customer has been going on for a long period of time. We're encouraging efficiency and things like that. We've learned so much from that that we do believe we can be carbon neutral by 2050. And we're going to come out later this year with specific pathways there. I want to make sure that when we come out with something, it's not in the world that we're hearing now, greenwashing. I want it to be laid out. I want it to be factual. I want people to see how we are going to do that. The way we're doing it now, and frankly, it's evolved. Hydrogen wasn't even in the discussion back then, right? So this is, we talked about energy efficiency. Clearly, transportation is going electric, at least on the personal vehicle market. The larger vehicle market is still, when I say larger, trucks and things like that, it's still a little questionable where we're going to go there. We talked a minute ago about the pipelines and things like that. We also are using the Subpart W emission informations out of the EPA guidelines to determine which upstream providers we buy from. We get about 2/3 of our gas from Canada and about 1/3 from the Rockies. For those of you that don't know, Canada is a little bit stricter. And so the emissions profiles of our upstream providers are better than the US, but we can at least use the data to pick and choose who we buy from and not pay any more from the gas, because the gas is the cost of the market is in the gas. And then of course, Camilo, we really push people, and like in your segment, to make sure that the entire value chain is as clean as possible. On the renewable natural gas side, this is a real opportunity for our industry. So I would call the short to medium term is the biogenic focus there. It's already happening. We got Senate Bill 98 passed here in Oregon. Is the most aggressive renewable natural gas bill in the country. Many states are looking, and utilities are looking to model that differently. But I'm old enough, Camilo, when I started in the electric business back in the 80s, when the wind farms came out and the solar farm came out, we would not be where we are today without help, whether it's federal help, state help, permitting help, support. And that's one of the things that we're trying to drive at the state level, and then frankly through the AGA trying to drive at the federal level. And I think in order for us to meet the states and ultimately President Biden's what appears to be very aggressive climate goals, it's really an all of the above strategy. We had E3 come in. I know the rest of us have had some of these folks. I know Mary's had a study done. And it really just shows you've got to do renewables in every facet. Energy efficiency has to happen across the board. And it is doable to decarbonize the system. And Mary and I were both in an AGA board meeting the other day where Secretary of the Department of Energy, Janet Granholm, came and talked to us. And hydrogen was talked about more than I thought. In fact, I think, Mary, the term she used is we need a moonshot on hydrogen. So the Biden administration appears, whether it's going to be through the infrastructure bill, or we're starting to, at some point he will talk about a tax bill. I know he doesn't talk about it now, but we know it's coming, or through his budget reconciliation. There's going to be a lot of dollars available for our industry, I believe, to continue the transition. So it's an exciting time. It's a nerve-wracking time because I think a lot of people have made a simple conclusion. And I think our energy literacy as a country is not good. And I think our energy literacy at the leadership levels of our states and our cities and our country are not as good either. And it's up to all of us to educate them and basically say, why does a gas LDC exist? What can electric do well? What can gas do well? And I think the February cold events that we experienced, not only in our part of the country, but in Texas, has been a real eye-opening experience, because I think this group of individuals on this and the people in this room have always talked about reliability. Resiliency is a different discussion. And I think my home state of Texas, the gas LDCs actually did quite well. When they heard the gas system failed, it wasn't the gas LDCs, and the people that had gas fireplaces and had hot water heaters with gas were okay for the most part, right? And then in our part of the country, there were people in Portland that were without power for 8 to 10 days because of the snowstorm. So I think it also shows you don't put all your eggs in one basket. It's important to have resiliency, redundancy, and we can do that in a way that's the most cost-effective way to decarbonize.
Yeah, thank you for that, David. And I really appreciate two things. One, the reference to State Bill 98. We'll talk a little bit about that when we kind of discuss some of the regulatory efforts underway in Washington and Oregon, but also, and this leads into the question for Jason, and that's around, resiliency and resource adequacy and some of the challenges that we've seen. And obviously being here in Texas and in February, it was quite an eye opener for many of the citizens and the residents in this area, just the challenges that we see associated with a weather event like that. But Jason, can you share your thoughts on resource adequacy to support, and this is really what's critical for Avista, because you're a gas and an electric utility, and where do you see resource adequacy, and then also where does natural gas play into that in the future as you look at your portfolio?
Sure. Well, resource adequacy is something that we're all spending a lot of time talking about, and I like the idea of incorporating resiliency into it as well, David. As a Vista, I think for each of us as individual utilities, we're first and foremost looking out into the future and making sure that we have the right blend of resources on the electric side of generation resources, to ensure that for us, our peaking usage on the electric side is, say, 6 p.m. on a January or February night. And there's not much wind blowing necessarily. There isn't any sun shining. And a lot of the rivers aren't sending a lot of water down the river through our dams because they're still in the form of snow. So we think a lot about resource adequacy. We all do. And so that's why, as I talk about with our employees and with community leaders and policymakers, when I talk about what it looks like to be serving customers 5, 10, 15, 20. We're counting on natural gas generation, for example, as part of that mix to make sure that we have sufficient resources to serve our customers on that 6 p.m. night, on a January night. And we also talk about how the natural gas business, the direct use of natural gas, fits into all of that as well. And the example of what we saw in February in Texas is fresh in a lot of people's minds, and we can talk about the benefits of that diversity of energy fuel or energy source. The other thing that we like to talk about is that we have to be careful about unintended consequences of policy decisions. And if we just go down this path of eliminating all fossil fuel generation, for example, and all fossil fuel use, what that means in terms of the customer's impact. It can mean much higher bills. It could mean that some of my neighbors start burning wood in their wood stoves again, or getting heating oil, and the unintended consequence of on the environment associated with that. So we really try to bring a lot of information into the picture, a lot of into the conversation, to help them understand how integrated and how important it is to have that diverse set of fuels serving our customers' needs.
Great, thank you for that, Jason. And Mary, I'll turn to you a little bit also with Puget having the electric side, and given the situation that was experienced in Texas in February with the winter storm, do you think the Pacific Northwest, and then more specifically in your home state of Washington, do we have similarities associated with reliability and resiliency of the transmission grid?
I think the differences outweigh the similarities. Obviously, there are going to be some commonalities. And interestingly, just by way of background, before coming to PSE, I was the CEO of El Paso Electric, which is in Texas, but it is not part of the ERCOT grid. And El Paso actually kept the power on. I always have to give a plug, but that's largely it's a different grid, a different way of regulating. But I think, for one, Texas is set up, ERCOT is set up to be an energy only market. So perhaps that doesn't incent enough capacity to be built. And then, secondly, I think that a lot of the entities in ERCOT, unlike all of us here, they don't have an obligation to serve. They're market players. We all have not only a right to serve customers in our areas, but we have an obligation, which, like El Paso Electric, that shares that same obligation, it means we have to be there for them when they need us, which makes a really big difference. But resource adequacy, as Jason said, is a big issue up here. I was actually speaking at NWEC this morning, and I commented that someone asked, can we decarbonize the gas system fast enough? And I said, no, not if what you want to do is do it immediately, because these things take time. But similarly, we can't electrify everything immediately either. And I tend to think that using our existing infrastructure, our pipes and our people to flow natural gas or a combination of natural gas and hydrogen or whatever may be the case ultimately is a lot better play. And that's how we're going to keep the power and the heat from going off up here in the Pacific Northwest. So I really I forget which of my fellow panelists it was, but who talked about kind of all of the above and having redundancy, if you will, or as well as resiliency. I think it's really, really important.
Great. Yeah, thank you for that, Mary. And it's great that you're so knowledgeable on ERCOT and some of the challenges that we saw here in the state, because I got a lot of questions from peers and coworkers and other folks in different states that were watching this situation and trying to identify what was the root cause. And it wasn't just one single root cause. It was a whole host of things that happened. And it really highlighted some of the inefficiencies that are in place in Texas. Nicole, talking a little bit about, you mentioned MDU, very broad company across 8 states, and really, the Northwest Gas Association, a lot of the focus is around Washington and Oregon, and you have responsibilities for Washington and Oregon. When you're thinking about public opposition, and we'll shift a little bit on the outreach effort, do you utilize a different outreach strategy in dealing with these states, regulators and legislators, and the public opinion in Washington and Oregon, as opposed to maybe Montana and Idaho and some of the other service areas that you have? And what are some of those strategies?
Yeah, so maybe start with the premise, regardless of the state we're doing business in, I share the same objectives that my fellow colleagues have already brought up, and that is clean, safe, affordable, reliable. And so I think we got to make sure that we're sticking to our base core values for our customers and what we're trying to deliver here. And it is a balancing act. Now, I will tell you, depending on the state I'm in, sometimes clean may come before affordable, sometimes affordable tops everything else. And we do operate in very diverse states. I would say as you look to Washington State, and you would compare that to North Dakota as an example, and public policy decisions in those 2 states, where the state of North Dakota, certainly a big industry in the state was coal mining, and the production of coal feeding into electric generation. And so there's different places that these states are in, and so overarching those values, I have to pay attention to the public policies in each of those states. So in direct answer to your question, we certainly do have to navigate differently in the state of Washington and work with different outreach groups, because what my customers want to know in the state of Washington is very different than what my customers want to know in the state of North Dakota. But I will echo, Dave, what you said earlier, and I just couldn't agree with you more in terms of the literacy of, what do our customers really understand about this movement and what's going on. I just give one example. My boys graduated from high school this year, and I had an open house at my house, and one of my relatives that was nice enough to travel to our state to come to the event asked me, "Oh, how's the job going? What challenges are you facing?" Well, do you have time? No. But anyway, I brought up the whole push against gas, and I mean, literally this person like, what? Like anti-gas, like they absolutely had no idea that people were moved to this next point of, that gas, in some people's minds is, kind of that next dirty fossil fuel, right? And so I think we got to make sure that we're continuing the dialogue around, again, the 4 objectives, because I think we can meet them all. And, I echo what Karen said earlier on the panel today. I mean, we can decarbonize our gas infrastructure and what we're delivering to our customer. Decarbonization can mean something in the gas business. It doesn't have to mean electrification automatically, right? And so there are ways to meet those 4 objectives as we move through, but I will tell you in direct response to your question that the priorities do shift depending on the state in which I'm operating. So hopefully that gives you a little flavor and answers your question directly. So.
No, that was very helpful, Nicole. Thank you for that. And David, I'll kind of tap into your thoughts from an AGA standpoint. Now it's no longer just the Pacific Northwest, but looking at the entire, the U.S. and thinking about your role in AGA, and then what are some of the kind of the focus areas that AGA is taking on this year, and really maybe frame it around outreach. We had Tisha Schuler kind of present and talk a little bit about the Game Changers playbook and just kind of the mindset around our strategy was around education and engagement of the public on opposition, and it seems like we've had a change because it's really, some of that has fallen hollow or it's not as effective as it used to be. The education and just kind of the communication and telling our side of the story. It seems more around, relationship building and trust. And part of that is education and awareness, but part of it is also looking at things differently. Can you share with us a little bit about kind of AGA's view around, public outreach and some of the things that they're trying to do to advance, the natural gas industry?
Yeah, it's along various factors than what we're talking about here. It's protect the people, picture the potential, and think about the future overall. But the some recent ones that have popped up is the cybersecurity is back up again with the Colonial Pipeline situation. So all the operational things that Nicole talked about is still very front and center on the AGA to make sure that we get pipeline safety legislation correct, which we've been waiting forever for, and along that line. But on the other side of that equation, AGA has evolved in this process too. I think for those of us in the Pacific Northwest and the West Coast have been living and breathing the environmental side of this equation for quite a while. I mean, it's just where we live, right? And it's important for us that if we don't embrace that the figuratively green movement, not only do you not survive, you don't thrive, right? And so I think our companies are a little bit different than, I would argue, a little bit of the rest of the country. And that really affected most of us when President Trump got into office 4 years ago. I think you saw the states here really push back against the things he was saying. And I'm not trying to be political with you, I'm just trying to be factual with you. And so you started seeing the cities and states take things into their own hands. That started going across the country, and more AGA members saw this taking place. And of course, with the Biden administration coming in full bore now, you have a lot of alignment that there's a tremendous amount of education that needs to take place. I think the gas ban movement has probably moved quicker than anybody thought it was going to move. I think those of us on the West Coast have been warning about this for quite a period of time. And I think there's a little bit of catch up going on at this point, but I'm happy to announce there's a very good alignment. It's also very, when we talk about this, Camilo, it's the other side, whatever you want to call that, is very well orchestrated, and there is a tremendous amount of funding. And it's an easy message. It's what I call the electrification two-step. It's let's electrify everything and then we clean up the grid and we'll be done. And it just ignores a lot of things. I do believe the February event woke a lot of people up, including the investor community, that if you would have looked at the stocks of some of our companies during the last year, were directly showing the worry that people had about the longevity. There's a lot of effort right now with the Biden administration to try to get this messaging across. We're getting some traction on that front, but I will tell you, it's still right at this stage an uphill battle, but we're in the first 100 days. And the Biden administration is, there are lots of executive orders out there right now. There's lots of spending going on, and I think it's a once in a lifetime opportunity, I believe, for our industry to help with this transition. And I think not only is the electric side going to get more help along this side, I'm hoping that we get more help on our side too, on the gas side.
Great, thank you for that, David. And I'll build a little bit on kind of, as you're mentioning, a lot of the states had to take action on their own, and really thinking about Washington and Oregon. And this question's for Jason with the Vista operating in both states. And that's really around, the cap and trade that Washington has as a bill, and then the executive order that Governor Brown signed in March in the state of Oregon, and really pushing forward on a cap and reduce. So what are your thoughts around kind of that effort? There's Washington that already has a bill out there. There's Oregon that it's in a proposed rulemaking, and I know many of our organizations or your organizations are involved in that proposed rulemaking. What else can we be doing? Either the Northwest Gas Association as members, as folks that have facilities in the state. What else can we be doing to help out, as far as kind of proposed rulemaking? And then in Washington, do you feel like the cap and trade is a done deal, or is that something that can still be opened up through litigation? That's a lot in one sentence.
That is a lot. I probably won't answer that last question, but I think if we take a step back and talk about, in Washington State, there was House Bill 1084, which would have effectively banned natural gas very shortly in new construction and ultimately over a period of time entirely. And what we learned from that, I think, is the value of collaboration with other stakeholders who have interests in these issues. So we engaged with our fellow utilities, we engaged with industrial users, we engaged with commercial customers, and we engaged with labor interests. And I think it was the combination of all of that where we helped our policymakers appreciate the impact on each of them and collectively all of us that caused that legislation to end up being killed. And I think that's the effort that we need to engage in on an ongoing basis and going forward with these rulemakings. I was just in a meeting yesterday internally talking about the executive order in Oregon. We are very concerned about it, and we don't know how to get common sense injected into the conversation. And the only solution we can find is to continue to find others who would be impacted by this and get them involved. So large industrial gas users, transport customers need to appreciate and understand how that executive order affects them. It's not a Vista, it's not the utilities, it's our customers. And so finding ways that we can get the hook in with all of them to get them involved, I think will make a difference. Because if it's just us, they think we're just trying to protect our business model, which is not the case at all. This is really about our customers and the ultimate impact on them.
Yeah, and that's a great point, and I think that's something that gets lost in the rhetoric is really the loser in all of this is the ratepayer and the customer, and their story is not being told. So I'll talk a little bit about just some of the challenges that we have, and this question's for Mary. Around just kind of the targeting of the energy industry. And so in May, we had the May Day bingo by some green anti-capitalist groups. There's been some closer to home demonstrations around definitely in Puget's area around the Tacoma LNG project. Can you share some of your experiences with these protests and kind of what strategies have been effective and which have not? And part of this, Mary, I think, when we talked earlier is the concern that many of us are starting to have now in a highly polarized state like Washington and Oregon with our employees, and some of the perception that folks may have on our employees working in a natural gas industry or a electric utility, and the safety risk associated with maybe them identifying themselves as in the industry and being stuck in a situation where there may be a protest or something like that. What are your thoughts from Puget around that?
Yeah, so by way of background, for those of you who aren't familiar with our LNG facility, it's a permitted facility. The permit's under appeal, and it's located in the Port of Tacoma. Two uses. One is essentially to provide storage for our customers in case the Enbridge pipeline has another issue. And then the second one is to clean up maritime traffic between Tacoma and Alaska. Really excited about that because Tacoma has high levels of particulate matter. It's going to clean up to 85% of those. And then, of course, consistent with the UN mandate on maritime traffic, it's going to replace bunker fuel. And there's few things dirtier than bunker fuel. So we think this is a win-win. This has been the subject of controversy for the last 2 years before I got here. Our folks who work at the plant and are trying to commission it have been harassed. There have been protests at the plant. And I am embarrassed to say I didn't really realize the extent of it until it literally came into my backyard. Well, I don't have a backyard because I live on a houseboat, but I had kayaktivists who came up right to my back deck. And for those of you not familiar with houseboats, they're small. Mine has a lot of glass. It's right there in your living room with you. Fortunately, the protest was very peaceful, but it went on for a long time. And it was disconcerting to me because I feel like historically we don't go to people's homes to do these kinds of things. People have families, but I think we've seen kind of the breaching of that this year. But it woke me up to a lot of things. One infrastructure project that to me, and I pride myself on having been talking about decarbonization for years now, should be at the forefront of bringing positive benefits to the environment. It is instead subject of controversy because for a variety of reasons, but largely because it involves natural gas. And so I think we're going to have to think about safety in a different way. We tend to think about safety as operational safety. We also need to think about safety of our employees because all of us should be able to go to work, go home, stay home, and be safe. So I'm a believer in collaboration and dialogue, and that's one of the reasons in connection with our Beyond Net Zero project, we're actually convening a group of diverse stakeholders from all different parts of communities, including environmental, low income, other advocates, and technical experts to try to help solve the problems. But I think that we need to have listening and collaboration and civility prevail. We're not going to get anywhere because this is a very complicated problem, solving climate change. Is there anything more obvious I could state? And if we don't work together on it, none of us are going to get anywhere.
Yeah, and thank you for that, Mary. And that is a scary thought with how close some of those protests can get. Where you're right, in the past you watch it on television and it's right here in your backyard. But thank you for sharing that. I guess on a time check, we got about 15 minutes. So these will be kind of the last questions, and then we'll move into the Q&A. So I'll start with Nicole and maybe a little bit lighter topic. So now we're in a post-pandemic. And here at Williams, this is something that we're struggling with also, and that's kind of the lessons learned that we've seen over the past year in a virtual world. And then what do we do going forward? So, can you share with us maybe some of the analysis if a decision has been made, or if MDU is still evaluating kind of a hybrid work environment for their employees? And if you have made a decision, what were some of the things that you looked at that pushed your decision?
Yeah, so we have made a decision as a utility group to offer permanent work from home. And I guess there were a couple reasons and factors that went into that. Certainly, I'm stating the obvious, kind of like Mary just said, we have a certain subset of our employees this does not work for. But for those that we can make it work, we did go ahead and offer that as a solution. There were a couple of reasons. One, I think it is what we're going to see in the future. And if we want to continue to attract and retain a qualified workforce, I think it's a move we got to make in terms of flexibility. Now that can mean different things for different companies, different things for different positions, but we did feel like it was a move we needed to make. Secondly, as you look at our territories and where we live and work today, we're across an 8-state territory, but we operate our company as one utility. And so today I have managers that supervise people in 8 states. I've got officers that have people in all 8 states. And so it became a hard argument for me to say that, well, you can't work from home if you can work in an office, but nobody that reports to you works in the same office as you. And so we already had kind of initiatives underway in terms of how do you collaborate better when you've got people that aren't in your localized office. In addition to that, we serve a lot of rural communities. And so unlike some of my peers on the panel here, we in some cases will have a harder time as we face retirements and looming retirements in pockets of our territory, attracting people to those locations. So for a variety of reasons, we did decide to move forward with that. Interestingly enough, we got a little more participation than actually I was expecting. I would say a good portion of that, though, came out of our call center. And certainly our call center agents, we have KPIs, just like I'm assuming all the utilities on the phone do. So we can monitor productivity, we can monitor call time, we can monitor response. And so we felt very comfortable with that movement. Frees up some real estate, of course, and there are a variety of other benefits that you get from that. But then beyond that subset of the population that chose the permanent work from home, it really was spread out across a lot of our different areas of discipline. So accounting, engineering, quality control. So I can't really even say there was a second pocket that took second place in terms of where we're seeing the big movement. IT would have been another area where we got several people interested. So there was an application process. You had to get authority, obviously, through your supervision, and there were various things that were being considered, right? I mean, if you're having to meet with your team on a regular basis, you're probably not a good candidate for permanent work from home. So without getting into all the details, we had a very thorough process, vetted that through, and we've already implemented that. And so, we'll see how it goes from here. I can report back a year from now, but we've moved forward with it.
No, that's great. It sounds like a pretty thorough review and a lot of the weighings of the pros and cons. So really congratulate MDU for establishing a path forward. David, I'll visit with you a little bit about ESG and really focusing around kind of the diversity, equity, and inclusion portion of the social in ESG. Just wanted to get your thoughts as a leader of Northwest Natural. What are some of the things that you guys have pushed forward or your organization has pushed forward that is starting to move the needle as far as DE&I?
Yeah, I think we're all familiar with the new moniker of ESG, and I would suggest that every company on this panel has always been very ESG focused. I think this is, I think just because it's got a new name to it, and of course the governance goes back to the Enron and the WorldCom debacles in the early 2000s. And the environmental is pretty straightforward. And I think where we live has been driving a lot of our behaviors there. But obviously, for all of us, it starts at the top. I mean, you've got two diverse candidates on this panel right here. I think that's an excellent sign of the movement in this industry. It's at the board level, and that we have to make sure that we have diversity, not only in terms of color and ethnicity, et cetera, but thought, because that's what makes us stronger and makes us better. And for our company, we've been at this for a long period of time, but I have to admit, I do believe the events of this summer highlighted to me we're not doing enough. If you had talked to me earlier that we're working hard, we're doing what we need to do. But I think for all of us, it is probably, as it should, rejuvenate what we need to do to ensure that we're not only diverse, but the equity and inclusion are incredibly important. I think sometimes it takes different thinking. The small example I have that's been very successful is we still have construction crews in our company just because there's not a lot of outsourced construction capability in our part of town. And as you can imagine, it was mainly male dominated and white male dominated people because we were typically pulling from other trades, including our service techs that would come from the HVAC side of the equation that were mainly white males. So we did an intern program for minority candidates. It's been incredibly successful to bring people in that don't have construction experience, put them through the training. They still have to pass the test. They still have to be able to do the job. We worked with our union to make sure, because union's all about seniority. How do they play? How does it work through the process? So that's one small example. But I think what for me this summer highlighted, it's top of mind every day. I heard, I was on another panel earlier today, and the head of Levi Strauss was talking that when he took over the company, it was in dire straits. So he had to put DEI on the back burner because he had to save the company. And he realizes that was the wrong thing to do. I needed to save the company, but I didn't have to put DEI on the back burner. And I think that's something for all of us to remember. Hopefully we won't get into trouble, but I think it's something that's got to be top of mind every day, just like we do with safety, reliability, and those other things that Nicole listed on her, affordability on her hand.
Great. Yeah. Thank you for that, David. I agree with you. It seems many of us have had a lot of successful programs that really furthered our ESG, but it is amazing, now the the visibility around, the ratings and our scores, and, the board, receiving more specific updates, and really formulating a lot of that into our individual goals or the goals for our departments on an annual basis. So really glad to see that, just the visibility that the ESG effort is getting. Jason, one last question for you, and really it's similar to Nicole. I don't know where Avista is as far as kind of post-pandemic, the lessons learned, things that went well, and kind of how will you transition into a post-pandemic environment?
Well, it's interesting. For me, I think there's a blending of both the prior answers. One, Nicole's answer about how they're moving forward, and then David's conversation about diversity, equity, and inclusion. Because one of the things that, well, I'll start with what our plans are. We are planning on having about a 6-month pilot where we, most of our call center, all of our CSRs will have the opportunity to continue working from home for the reasons that Nicole described. That's probably one of the easiest places to have metrics to follow. There are lots of metrics already in place to measure productivity. And then for the rest of our employees, we will offer a hybrid opportunity where we would expect them to be in the office at least 2 days a week. And the reason that we're not going all in on a larger percentage of our employees working outside the office entirely is this concern about inclusion and the impacts on diversity, equity, and inclusion. I'll give you an example. When you think about if I was doing this panel with everybody else here and I was on the screen, but you were all in a room together, I wouldn't be able to see each of their faces. They wouldn't be able to all see my face. You really don't have the same inclusive experience being the one who's not in the room. And that's not a reason to not move forward, but it means that we need to be really intentional about how we create a structure that does allow everybody to be included in the same ways in the conversation, the decision-making process, and make sure that they're afforded the same opportunities for growth in the company and exposure and visibility, things like that. So we really want to be intentional as we go through this pilot it's one thing when we're all in the office. It's another over the last 15 months where we're all out of the office and we're all doing this together, those that are working from home. It's another when you're blending those two. And we want to really be thoughtful about how we move forward with that. So that's our plan, about a 6-month pilot. And then we'll take lessons learned from that and make sure that we're moving forward in the right way.
Great, thank you for that, Jason. And last question for Mary, and part of this is going back into David in the state of Oregon with Senate Bill 98. What we've seen really a lot of incentive for development around renewable natural gas and just a lot of opportunities for the utility. Do you see the state of Washington moving forward on that, or is that something that Puget would like to push forward within the state legislature in order to get something like that passed?
So I think the state of Washington is very supportive of renewable natural gas. In fact, we have a voluntary customer program that provides renewable natural gas blended with conventional natural gas to our customers. And then we had just signed a deal with Klickitat PUD to buy more renewable natural gas through June of 2040. And then on the hydrogen front, we signed a deal with Mitsubishi where we're going to be partnering with them to help us explore and study how our generating facilities can be used to produce and store alternative fuels like hydrogen. So I think part of the framework for Washington supporting it is there. I also think SB 5295, which is the regulatory reform bill, which was passed and signed by the governor this past legislature. This helps reduce regulatory lag and uncertainty through multi-year rate proposals. And obviously that's going to help all of us because we're going to have a better sense up front of what we can and cannot do. But I think we're seeing growing support for the all of the above strategy. And I look forward to working with all of my colleagues on this panel today in getting there.
That's great. Definitely, you see a lot of alignment from the organizations on this panel. I'm going to move forward on the Q&A, and the question that has the most votes, and I'll throw this out and maybe give everyone a chance to provide an answer if they'd like. In the Northwest, electric utilities have shared costs and risks of large power plants like Boardman and Centralia? Have LDCs talked about jointly investing with sister utilities in the RNG hydrogen area to reduce customer risk? David, do you want to take a stab at that as far as Northwest
Yeah,
Natural?
I think there's been some discussion out there. I don't think there's anything, but I do think on hydrogen specifically, it's expensive and it needs to be big. I think we're going to do a pilot project down here with Eugene, so we're partnering with EWEB, the electric water and Eugene Electric and Water and Electric Board. Easy for me to say, but anyways, we're partnering with them. But I do think it's a really good question because I think partnerships are good in terms of managing your risk as a company too, not just the customer's risk, but your risk as a company. And I think when you have a bunch of like-minded individuals like you have on this panel, I think it opens yourself up for those partnership capabilities. So it wouldn't surprise me if you saw more of those going forward.
Okay, great. Thank you for that. Jason, any thoughts on that on Avista, having electricity also?
Sure. Well, what wasn't mentioned was Colstrip, which is also a shared ownership. And I won't speak for Mary, but I have lots of scars from that shared ownership facility over the last several years. So that's an example of one that isn't ending up in such a good spot. But I'll give you an example of one that has worked well for more than 50 years, and that is the Jackson Prairie Storage Facility, which we co-own with Northwest Pipeline and with Puget. And that has been a very successful shared ownership model since the 1960s. And I would rather focus on that as an example for opportunities as we look at new technology, I guess not so new from the panel we heard before us around hydrogen, that it does make sense to explore together for a variety of reasons. The shared costs, but also the common messaging that we can have in front of our regulators and with our customers. I think that there might be some opportunities on that front.
Yeah, great point. Really glad you brought up Jackson Prairie because that is a very good working model that we can all learn from. Mary or Nicole, any thoughts on that as far as the partnerships or joint ventures or joint efforts around RNG and hydrogen?
I love the idea, especially around hydrogen development, because if we can get it to scale, it's going to make it more affordable. We tend to have small to mid-sized utilities up here. And so if we get together with a trusted partner on this kind of stuff, it's always better than going it alone.
Yeah, great point. And Nicole?
My fellow panelists covered it so well. I have nothing additional to add.
Okay, great. This one specifically for David. Has anyone done the cost comparison of a marketing campaign convincing consumers that we really do only have 9 years left and they should just live up to vs spending money on new resources?
Well, you must have been at my board meeting last week. But, so what we've been talking about, we've been doing the education, there's been marketing. Actually, the word campaign is exactly right. And a campaign is broader than marketing. And so think about it as a political campaign. And so our team, at least here in Oregon, and I know everybody's got a different situation, but we are actually rolling out a campaign to kind of make sure not only do we touch everybody in person, but if you live in Portland, you're about to see some ads on your television very soon that I think you're going to like, that clearly lays out. And I think it's important because what we see is about an 85% product preference numbers down here. So in a very environmentally friendly part of the country, the product preference numbers for the product that all of us serve is incredibly high. And so building off of that, making sure that message gets back. But I think it's broader than marketing. It's a campaign that has to be all faceted across the board. And yes, we are doing that. I don't know what the versus spending money on other resources, but we are spending more money in this area, at least on my company's side. And I will tell you, AGA has beefed up their side of the equation too for the bigger campaign on a national basis.
Great, thank you for that, David. This question's interesting because I kind of, I got my opinion, but we'll put it to this panel. It sounds as though the message is that climate targets are out of reach, both practically and economically. Is that correct? And I'm struggling with that a little bit because our company, much like your companies, have set interim goals, at least of the 2030, and recognizing that we can start taking corrective action today to meet these interim goals because 2030 is within our reach. 2050 is more of an aspirational, and it will take time, and it will be significant efforts that are needed by all of our organizations, as well as developing technology to meet that. But I don't feel like the targets are out of reach. And I heard an earlier presentation that made it seem like they, no matter what we do, barring some, significant effort, we're not going to hit our targets. But just wanted to get y'all's thoughts. Maybe, Mary, you were nodding a little bit. Puget has an interim goal of 2030 by 30%. What are your thoughts?
Well, similar to what David said, we wouldn't put our goals out there, if we didn't believe there was a path forward. And we have a white paper around how we plan to attain the first two prongs of it. The third prong, the one around decarbonizing natural gas, is the one that we say we don't have all the answers, and we got to work together on that one. But we're starting things like leak reduction, talking to our upstream partners, things like that. So I think these goals are attainable with a few caveats. One, I don't think they're attainable if we say we're just going to electrify everything. Yeah. Because for any of you who have ever been involved in developing transmission, electric transmission, not even speaking about over the Cascades like we'd have to do here, I think that that's going to take longer than probably coming up with a hydrogen solution. So I think it's really about talking honestly, openly. It sounds sappy, but really listening to people and having an open mind so that we can collectively solve these problems, because we've got to try. We cannot prejudge that we can't do this. And I'm a firm believer that if we put a lot of smart heads together, we can get this thing done. And I think we already see some pretty good outlines for paths forward on this.
Camilo, I agree. Let me tap into that. I think they are achievable, and I practically economic. Is it easy? No. That's what Mary is saying, right? And I think help needs to be along the way. On the affordable, or what we say economically, I think a lot of times when our industry says affordable, it's comparing to the conventional price of natural gas right now, and that's not the right comparison. The right comparison is if you're going to put price of carbon. So now we have a cap and trade bill up in Washington. We were going to have one in Washington or in Oregon, but it didn't go through. What's the price of electricity going to be as we go up? I mean, the reality is, energy is not, this energy transition is going to come with cost. How we do that, who bears that cost is going to be important. But these are very reachable. I think we've all done studies showing that you can do it, and you can do it economically and reliably. Like Mary said earlier, though, it doesn't happen overnight. I do think in our instant world we're in right now, where people want to flip a button and make things happen, it's not going to be like that. And I think that's the other thing that folks are getting used to, is the transition that's going to take place. But if anybody can do it, it's this group, right? We have access to capital. We have access to low cost capital. And that's going to be important as we transition through. So I don't know. I know Mary's all in. I am all in. Everybody on this panel is all in. I would argue we have to do it.
Yeah, I agree with you, David. And Nicole, before we hear from Jason, what are your thoughts on that question?
Yeah, so as I mentioned in my introductory remarks, as a corporation, we're a little more complicated. And so we have not come out with, net zero by XYZ, or as they're describing, some view as aspirational goals. What we have done on our electric business is establish interim goals. We are talking very actively with our gas transmission subsidiaries. So again, on our regulated energy delivery side of the business, at looking at methane emission reduction targets, basically interim targets on the gas side of our business. So as Dave, I think you mentioned earlier, there's, from an ESG perspective, we have been, talking these things, doing these things for numerous years because it was the right thing to do, right? What's happening now, though, is the dialogue has expanded, and certainly we were starting to feel like we were just, the flavor of the day, right? Grabbing at whichever topic was getting brought up, and we better go ahead and present that to our E&S committee of our board of directors. Most recently, what we've decided to do is we really have to look at what's most important to our business's sustainability, and then what's most important to our external stakeholders, what's most important to our internal stakeholders, our employees. And when you look at all those things together, you can clearly see some priorities that rise to the surface, because it's hard to capture all of them. It's hard to do them all. And so recently we've performed that gap analysis. We've elevated some of these things. One of the things that has been elevated is we've got to get a better handle on corporately what we're doing with respect to some of these things. It's just taken a little bit more of a thoughtful approach for us, because on the construction side of our business, as you can imagine, they're not getting the same level of feedback as our energy industry is. And so we got to get our arms around, is this what we're going to do corporately? Are we going to do it just on the gas side of our business or not? So overall, as an industry, I would echo what Mary and Dave are saying. We've got to make progress. But we have to also do it in a measured approach so that we're balancing all of those objectives. And so that's what I would add to the conversation. Jason probably wants to weigh in as well.
Great. Thank you, Nicole. Jason?
Just a couple of things to add. The first is just acknowledging that our industry is one that is comprised of a lot of employees who want to get things done perfectly figured out before we roll it out. And we understand why. I mean, you don't want to experiment on the pipeline or the electric grid. And at the same time, if we wait until we've got it all figured out and we know exactly how we'll achieve these goals based on the cost of technology and the maturity of the technology today, we'll never put a goal out there. So it's finding that space where we can put these goals out there, point to them, and then work toward them, acknowledging that things are going to change. The costs are going to change with the technology, hopefully in our favor, that the maturity of the technology will continue. The other reason that I think it's important for us to have goals, even if we don't have it exactly mapped out right now, is it gives us a seat at the table in conversations that we otherwise wouldn't necessarily be able to have a seat at the table. Recently, I had a conversation with our city council president here in Spokane. Some of you may have heard or seen that even in Eastern Washington, Spokane, there's a recommendation by a subcommittee to ban natural gas. It's not in front of the council yet, but it's going there. And so I was able to have a conversation with our council president to talk about the goals that we've established and how we're working toward achieving those goals and the steps we're taking now and what we hope we'll see in the future, so that we could demonstrate that we have a commitment to a cleaner portfolio of resources. And I think that having the goals there, even if they're not perfect, even if we don't have it exactly mapped out today, gives us that access that we otherwise wouldn't have.
Yeah, great. Thank you for that, Jason. And really, I think this we're going to wind down the panel. I'm going to turn it over to Dan. But really, I just want to thank y'all for the very honest, the very transparent, and very thoughtful responses to these questions. And I think I'm very proud to be part of the Northwest Gas Association and work very intimately with your organizations from a Northwest Pipeline standpoint, because the messaging and the alignment that I heard today is really solid. And as leaders of these organizations, we're on a very positive trajectory on our efforts around embracing the future in a clean energy economy. So with that, I'll turn it over to Dan. And thanks again, Dan.
Camilo. Terrific job moderating. Thank you, David, Jason, Mary, and Nicole, for your time today and your engagement in this discussion and bringing what I hope our audience thinks was a valuable day spent receiving content and networking. So really good stuff. Let me just take a minute to kind of capture what I think I heard from the day, and we're closing out, folks. So we're going to give you a few minutes back at the end of the day. I think we'll be done in about the next 5 minutes here, and so you'll have an extra 15 minutes in your day. But we started with Grant Forsyth, Chief Economist at Avista, talking about really U.S. and Canadian, and particularly our region's economic outlook. And one phrase that I took out of there, which I really loved, is when it comes to inflation, because I don't know about you all, but I'm thinking about it right now when you've got $6 trillion being injected into the economy over the last several months. Inflation is something we got to think about. And I'm one of those mature people that Grant referenced that remembers the late 70s and early 80s. I wasn't ready to buy a house yet, but I remember interest rates at 18 and 20% back then. Anyway, as he referenced inflation, he said, well, it's going to be elevated, but not unhinged. That was encouraging. That was an encouraging comment to hear. And we heard from Josh McCall, BP, IGI, and basically talking the fundamentals of the natural gas market. And I don't know, one word that comes to mind is steady as she goes. I didn't see a lot of big inflections in what Josh presented to us. We heard from Ben Kuyala of the Northwest Power and Conservation Council some really interesting stuff that's coming out of the 2021 power plan. from my perspective, I was intrigued by their assessment that resource adequacy is that the loss of load probability is different than what we were even hearing from the council, say 6 months ago. And I want to look into that more and see what's going on there. We heard from from a handful of national trade association leaders talking about how all of the elements of the value chain from the midstream, maybe we didn't really have a producer voice, although I'll remind you all that Marty Durbin at one point in time represented the natural gas producers. So he had some insights to bring to us there. But talking about how the desire of these industries, which I think you also heard reflected in this last panel, to be a part of the solution and their conviction that they must be a part of the solution of taking really effective climate action and doing so in rational and affordable ways. We heard from David Brown and Ken Dragoon about hydrogen and some of the elements that are going on there, and some of their David shared with us a couple of his big thoughts, the notion of a hydrogen industrial park and a hydrogen ammonia or a hydrogen pipeline that would parallel perhaps the Columbia River. That was a really great presentation, and I think super timely because we heard hydrogen referenced in a number of different conversations throughout the day. And then this last capstone panel. Terrific job moderating, Camilo, and really, again, just want to say these are the people that are charged with navigating this future, with really, as the title of their panel suggests, embracing this future and finding a way to make it happen. And I hope that you all heard, as I did, from every one of them, that there is a commitment to real action and moving this region and in that direction. So again, I hope you found it a useful time today, productive. I hope you made good new friends and reestablished connections or connected with other friends that you're accustomed to seeing at this event. And with that, I'll turn it over to John for the last word.
Oh, thanks, Dan. Well, on behalf of the Alliance of Western Energy Consumers, I really want to thank you for attending and participating in this conference. I learned a lot of new things today and gained some real food for thought. And I hope you did too. We enjoy as an organization co-hosting this conference with Dan and the Northwest Gas Association. Feel it's one of the best energy conferences around, and really appreciate the really good working relationship we have with it between the two organizations. And we're hoping we'll see you next year. The dates are June 8th and 9th. I'm very hopeful that it'll be in person, and it'll probably be somewhere around the Bend area. And so with that, I hope to see you next year, and everyone be well.